Yeah, and very casually saying, yes, 25% tariffs on Mexico and Canada.
Yeah, Zelensky wants to make a deal.
Yeah.
And Putin should make a deal because the war is destroying Russia. And the way that he was speaking about it,
Yeah,
it was
and everything is moving. So by the way, internally we've put someone on Trump watch, at least till he goes to sleep in a few hours from now, hopefully. And so we'll have to track what he keeps saying and tweeting. But that's what it is. Very quick wrap. And we have a star cast of a lineup for you today. It's just in a few minutes from now, you'll be hearing from Ramesh Damani. You'll be hearing from Samir Arora to break down what Trump 2.0, the dawn of a new era, means for India and the world, of course. And by dawn, I mean D-O-N.
I wondered.
But let's start off with a quick recap. Now, U.S. markets were, of course, shut to commemorate Martin Luther King. Dow Futures, though, is what you need to watch. So let me pull up Dow Futures live right now. They flattened out after Trump says he's considering that 25% tariff on Canada and Mexico by Feb 1st. So he's given a date as well in sync with our own union budget, strangely enough. So about 0.25% up on Dow Futures. Come off. It was higher earlier in the day, as high as about 0.5% up. Crude has slipped because remember what he's done, and I'll go through all the key points of what Trump 2.0 could look like on minute one. He's speaking now of new energy action, Brent at about $80. Asian markets have opened higher, but now trading mixed as Trump is not saying anything clearly on tariffs. It's a little bit out there. So no one really knows what's going to happen. Shanghai in the red now. Nikkei has come off its gains. Hang Seng still up in the green. So what is Trump saying? And he says it's going to be a golden age. He has signed a slew of executive orders on taking oath. He's reversed 78 orders of his predecessor, Joe Biden. There are no executive orders on tariffs yet, but hints at tariffs on Mexico and Canada from the 1st of Feb, as much as 25%. He's also announced a national emergency to increase fossil fuels. So an energy emergency is what he's saying that the U.S. is in. He's withdrawn the United States from the Paris Agreement, which, remember, is a voluntary agreement between all nations of the world that we will keep the increase in global temperatures to 1.5 degrees a year. He's come out of that. He says he will scrap any mandatory EV program. He signed an order to end some birthright citizenship. Action on immigration is already on. So this is just the beginning. But let me welcome on board Ramesh Damani, joining us today, market veteran, and Samir Arora, founder and fund manager at Helios Capital. Welcome to both of you, and great to speak with you on day one of the times of Trump. So, Mr. Damani, I'm going to start with you because, you track this election so closely. And I think is everything that you've seen on day one exactly what was anticipated?
Yeah, thank you, Tamanna. Good morning. Yeah, it's fascinating to watch the U.S. elections and the swearing in unfold. It is one of those great transfers of power. Typically, American presidents, when they come in, have a honeymoon period where the markets, the people, the institutions get behind the president and applaud him before he comes into reality, which are domestic geopolitical differences. I think Trump will be the same way. He had a lot of bluster in his speech, a lot of grievances against generally America's role, America decline, as he calls it out here. So there will be typical pushback against that after the honeymoon period is over. But he was true to form in his inaugural speech.
Right. Ramesh, good morning. And Samir, good morning as well. What did you make of the first few measures that were taken? I think to a certain extent for us here in India and a lot of markets around the world, no news on tariffs is good news. And so to that extent, we've seen a bit of a breather. The dollar has come off quite substantially. What do you make of the latest?
So if you're asking me, basically this I thought was predictable in the sense that about a few days ago, he said that he first wants to visit China in the first 3 months. He actively took steps to try and save TikTok, and in a place where people are talking about TikTok being a arm of the Chinese government, inviting the CEO to the inauguration, and also because he's surrounded by a fund manager, hedge fund manager as a finance treasury secretary. So I thought initially also that this part will not happen so easily. And now again, after seeing that he's not done it after announcing it or after campaigning on it, because he said that he will do it on Mexico and Canada on Feb 1st. The market is again reacting. I think market is overly reacting. I was amazed to see interviews, even on Indian TV, television, guys saying, we have taken this 60% tariff across the board, and therefore because of this, the inflation will be high and this much will be high and trade will come down. I mean, absolutely random over analysis of campaign things, which clearly were not or had a very, very low probability of being implemented on day one, and making projections from that. So I think overall, what he has done so far is quite harmless as far as markets are concerned.
But like we said, it's literally day one and the first few hours. So I think the uncertainty is the name of the game. In fact, Agam Vakil also with us in the studios this morning. And Agam, I think everyone was waiting to see what he's going to say on tariffs, because he didn't sign an executive order, but then he did talk about as high as 25% tariffs on Mexico and on Canada.
Right. Well, and it's going to be interesting as to how the renewables sector also pans out, specifically on account of this. And, it's a little bit of a mixed bag when it comes to electric vehicles.
I'm also just noticing you're in US flag colors this
morning.
Actually,
the attempt was to not do that, but it just turned out that way for now.
I'm the only one that's clearly non-aligned.
I'm in Democrat colors this morning for some reason, but
no, and as I was saying, we are going to keep an eye on the renewable sector and what happens in electric vehicles as well.
So just let's listen in to what Donald Trump said.
I put on large tariffs on China, and they've really been forced to leave them. And if we didn't leave them, you wouldn't have one steel mill that's open in this country, because they were dumping massive amounts of steel. We've taken in hundreds of billions of dollars from China because they were unable to terminate the tariffs I put on China because it was too much money and the budgets didn't work, and other reasons too. No, I mean, we're going to have meetings and calls with President Xi. I spoke to President Xi last week, as you know.
Okay, so that's the latest, and this is what I was referring to. He was signing executive orders, his aide was explaining what he was signing, and he was answering questions that were posed by reporters. Ramesh, it's his inimitable style. That's how he operates and the way he speaks. You never know what's coming. And so, to a certain extent, what we saw today was, as Samir pointed out, relatively harmless. What do you make of what he said on energy, though? What are the implications? He's said, in his words, drill, baby, drill.
Yeah, thanks, Alex. Couple of points. First, the US already produces 13 million barrels of oil a day. They want to increase it by 3 million barrels. It's going to be an extremely tall order to increase it by 3 million barrels. What will it do to the price? What will it do to the existing producers? So I think that's a bit of wishful thinking. But let me explain why I think Trump's economic policies are a bit muddled. He campaigned against China and against TikTok, against it, till he became for it, because one of his campaign financiers is for TikTok. But on the same hand, an ally of the US, Japan, the strongest ally of the United States has probably in the region today, they wanted to make a bid to take over US steel. And he has said he will refuse that bid taking place in America. Though the bid is at $53, then the price is $35 currently, so shareholders will make money, though the unemployment is very minimal, citing national security risks. Now, it's hard for me to understand how Japan poses a national security risk, but China does not. So his economic policies are muddled to begin with. And I think as he moves into the reality of governing, as they say in America, that you elect in prose, in poetry, but you govern in prose, the reality of everyday governing is probably going to get to him with tariffs and the zero reduction game that he's talking about. America does not become great by diminishing other countries. America becomes great by pushing other countries along.
Samir, in terms of impact going forward, and from what Trump is saying so far, it seems pretty clear that the best deal for America, very broadly speaking, is what he thinks is in his interest. Here in India, markets have been celebrating, right? And everyone you speak to, and you talked about some Indian commentators you heard, everyone is celebrating, saying that yes, the stick of tariffs is going to hit China. But why are we assuming there's going to be no impact on us? Or how do you look at that?
So first of all, I don't think that it'll hit anybody. There'll be a deal. And also, by the way, although I agree that he rejected the Japanese takeover, but actually even he was not the president, and it was formally rejected by the Democrats. He has just said that he also goes along with that. It's not that he has actually done it. So in that sense, it is US both parties' policy or whatever, or at least in this particular case. But talking about this thing, that's what I'm saying. Don't take every word of his literally in these areas. And this idea that you said that this is only day one. Well, the whole story is on day one. If on day one you are signing 100 orders, and in that the tariff orders are not there, that means that it is not being taken right at the top of the agenda. If you do it as a 101st order 10 days later, when the visibility and the noise around that is less, if at all he does it that day, it anyway means that it is still a ploy to play with or bargain with Mexico and Canada on drug and basically immigration issues. So if it is not on day one, and if you had asked before this on what is Trump running, he was running on immigrants and tariff. And now you say in the first 100, whatever he signs today, it's not there. Then that is a very big signal, according to me.
Okay. Just, inflation and focus on inflation is the big thing. Withdrawing from EV, the energy push is the one big thing that we can see now, apart from immigration. But Mr. Damani, the other thing that he wants to do is free up trade, which is why bank stocks have been running in the US. What is the kind of outlook and picture now we can see in terms of bond yields? What's happening with inflation, and where that movement and the dollar will move, because that's really the direct and very obvious impact for us.
Well, I think if you take him at his word, I guess Samir is right. You don't take him very seriously or very literally. You take him seriously, but not literally. Okay. But if he follows through on his economic policy, and I think at some point he's going to follow through on tariffs and tax cuts, these are the things that he's been running on. They are both inflationary. And I think the bond yields are suggesting that it will be an inflationary environment in America to begin with. Now, you can't go against the law of economics and say that these policies are inflationary, but I'll ask the Fed to reduce interest rates. I don't think that's going to happen. So I think we're going to come into a brave new world. I think since World War II, and particularly since 1989, the US has led the world forward. The march has been long and narrow, straight path. But for the first time, I think the world is making economically a U-turn. We're going back to a mercantilist policy, a protectionist policy, anti-global policy. And if I can only paraphrase Rudyard Kipling, what does he know of America who only America knows? I think he understands the pulse of the American people, but my sense is that Trump doesn't understand the role that America has played in shaping the world we live in today. And I think there'll be a price to pay for it down the road.
As we wrap up the conversation, I must ask Samir Arora about the other big event. I mean, in a few days, our focus will turn to the budget and more on what's happening in India. It's a bit of a shaky time for Indian equities, Samir. No one's quite sure. And so far, frankly, we've been blaming it on Trump, but it's most likely our own corporate results, which is a bigger pain point. I think you agree with that.
So I think the good thing is that this is the first time in many years we are going into the budget thinking that there is zero probability of a capital gains tax hike. Actually, this is a negative thing in the sense, previously we would have these old stories that now capital gains tax is coming or a bigger number is coming. And then whatever happened in the budget, we would all say, oh, thank God this did not happen. Now it's the other way around. But that is a positive. But beyond that, I don't expect much from the budget, but it also need not be in any way negative. So it'll be like in other countries where you don't talk about the budget. Even in India, the budget focus has come down because of GST, where you now can't randomly increase and reduce taxes in different sectors. So there's less scope of big ups and downs, unless somebody did something on this big picture, capital gains tax, corporate tax, and all those have been done. So maybe there is a small relief to the middle class or to the taxpayer by changing the brackets a little bit, which could land up giving everybody some 6,000-8,000 rupees a year. If you see the amount that can be played with, and assuming all of it goes for a tax cut.
Amir, thanks so much for that view, and look forward to getting your view post the event as well. Ramesh, as always, thank you so much for joining in this morning and giving us a perspective you did.
Thank you.
All right, now, so that gives you some sense of the interpretation of everything that happened overnight. But let me remind you of what happened at the start of the week for the Indian equity markets. And you saw green on the screen. It was, in fact, I'm told, the second best session in 2025. It just goes to show the fact that we're scraping for the best at this juncture, right? You're not easy to find. 0.6% for the Nifty 50. Better performance by the broader markets, they've outperformed. And you had two gainers for every losers in trade on Monday. Markets were buoyed by the banking index. The Nifty Bank gained quite substantially around noontime and held on to gains and more or less ended at the high point of the day, 1.75% higher or thereabouts for the Nifty Bank, or 1.7% higher, led higher, of course, by Kotak Mahindra Bank. Markets are continuing to give a lot of credence to good results, and the bad results are being punished very badly. And that was evident in trade yesterday. The likes of Kotak Mahindra Bank as well as Wipro being rewarded quite substantially in trade. Most of the sectors ended in the green. You had IT that also ended in the green. Auto and FMCG on the other end of the spectrum were the underperformers, and that is something to watch. Of course, a few other stocks were in focus, the likes of Tata Tele as well as Vodafone and MTNL on the back of a potential waiver of AGR dues. No real update coming through. In fact, Vodafone saying that there was no communication on AGR by the government. Let's talk about trade today, though, and Agam is the perfect person to tell you what to look forward to. Agam?
So Alex, the thing that stands out at the moment is that over the last 6 sessions, we have seen the Nifty to remain range bound. There's been no movement about 23,500 on the lower end. We've tested 23,000, but we haven't broken that. And on a closing basis, as long as we maintain that particular mark, it's all sorted. Now, at this point in time, considering we've seen that correction come through for the Nifty as well as the other benchmarks, it does seem like the markets are going to take their time to consolidate at this point in time before they determine a direction. And at that point in time, well, the hope is that the direction will be upwards. As far as your FII standpoint is concerned, at least in index futures, they're stuck at 16-17% longs and 83% shorts. Even if you move forward, the month of January has been a tough one, and should we end in the red, it would be the 4th straight month where the Nifty will give you a negative return. And this hasn't happened in a really, really long time. The last time it happened, I'm told, is well over a decade, if not more. And even in terms of your overall fund flow action, FIs have sold stock worth 50,000 crores, and while DIs have come in and bought a little more than that, around 53,000 crores, there is always the danger of FIS selling, which is a little bit more concentrated, to perhaps weigh in on the markets. But as I was mentioning, FII positioning in index futures stands at just about 17%, and it is on the lower end, which means that if things were to take a direction, it would most likely, in terms of probability, be upwards. But the question really is that when do we see an end to this consolidation? That's something that's going to be a wait and watch, and I reckon that will also be determined over the next 2 weeks based on the kind of earnings that we get.
Just because you were speaking about Vodafone earlier, so there could be another fillip to the stock today, and that's a story that we've got from the Supreme Court. Our colleague Varun Gakar got it, that the Supreme Court has upheld the 1,600 crore tax refund to Vodafone and dismissed a special leave petition to reverse that. So that is definitely going to be one big booster for Vodafone. But I reckon Trump stocks could be in focus this morning more than anything else. So I'm just going to start with that, and of course we'll get to the other. So on my list of 3 stocks, Trump stocks, a mix of up and down depending on which sector. So let's talk about the IT sector. IT sector for now maybe limited impact because they're insulated from anti-immigration policies. They have more and more localized workforce, but watch on what is happening with your entire IT pack today. Remember, Wipro was firing yesterday. But in terms of dependence, you have TCS, which has 52.7% of its revenues coming in from America. For Infosys, it's 58.4%. For HCL Tech, it's 64.5%. For Wipro, it's nearly 63%. And Wipro, so a very robust move yesterday. For LTI Mindtree, it's nearly 75%, and for Tech Mahindra, about 22%. For pharma, now, if he's going to crack down on China in terms of pharma, you could see some impact there. So look at pharma stocks in focus and their, dependence on the US. Dr. Reddy is to watch today, 45% of revenues coming in from the US, and then followed by Lupin and Sun Pharma there. I would also look at solar module makers, and this is uncertain. Higher tariffs to China would technically benefit Indian players, but then is he interested in importing from India? Would that be part of a deal? That we can't really say so far. But Wari Energies, for one, over 50% of their FY24 revenues came from the US, and for Premier Energies as well, they are a large solar cell exporter to the US. So watch out for some of these plays today. You've seen no real action on currency bond deals so far, but I would say IT Pharma, one to watch. The other one is, of course, Dixon. Dixon numbers came in and really have been a positive surprise. The stock was up 2% yesterday, a thumbs up on Dixon's Q3 numbers coming in. They've beaten estimates. Mobile segment has driven revenues and margins. Mobile segment, in fact, is 89% of revenues for the third quarter. And just a quick reminder, we will be speaking with Dixon at 9:45 this morning as well. Their revenues are up 117% at 10,461 crores. EBITDA is up 116% at 398 crores. Margins are pretty much flat for Dixon. Net profit is up 126% as well. But I think what's going to maybe excite the street is a possible foray into semiconductor components, because in their conference call, they said that they're looking at a fabrication capex for, for the business going ahead, which could be about $3 billion. And this capex, 75% of it will be subsidized by central and state governments. Because remember, Dixon is the company which has been a huge beneficiary of of the Make in India program, and semiconductors is something that the Indian government wants to move forward on. So I'd watch out for Dixon, despite a fair bit of run-up and valuations which look rich, but numbers at least have been good, and that's sometimes a rarity in this quarterly season. Just Paytm, because yes, Paytm reported yesterday, but I thought what the CFO has said in the conference call was noteworthy, which is why I'm adding it. He says we're very close to profitability. Brokerages have been positive as well on losses narrowing. Losses have narrowed, and some of it was expected because they did sell an important unit, so that has gone into their cash flow, but their loan portfolio has seen a bump up in revenues. CLSA, in fact, has maintained hold with a target price of 820. Target prices have gone as high as 1200, so I'm not even going into that. You have a Bernstein at 1100, you have some others which have gone as high as 1200. So there you have the entire range over there. It says, CLSA at least says that you have seen an EBITDA break even. It's a mixed quarter, close to the core. The heavy reliance on lending is something which CLSA is not too happy about. They say pick up in GMV, but some moderation in net take rate. I think the narrowing of losses more than was expected is what will be seen as a positive, perhaps, for Paytm. So watch out for Paytm as well. So those are my first three.
Yeah, on the note of Paytm, apparently Group Chief Financial Officer Madhur Deora talking about the plan to turn profitable in the next 1 or 2 quarters.
That's the point.
Apology, I thought you were okay. So prime, okay. Let me move straight to my list of stocks. I was focusing on this list, which is why I missed what Tamanna said right at the start of the Paytm update. But Oberoi Realty is the first stock that I'm picking today. And according to me, it is a thumbs up, purely based on the numbers that the company has reported. Of course, I know that there's going to be quite a bit of focus on pre-sales. I'll come to that in just a bit, but let's wrap up the numbers for the quarter gone by first. Revenue increase of 34%, coming in at 1,411 crore rupees. A significant expansion in margin during the quarter, coming in at 61% versus 48.3%. The EBITDA is up as much as 68%. PAT is up 72%. There's also a small update in the form of a merger of the arm Nirmal Lifestyle with the company. But really, the conversation is going to be about pre-sales. And Pre-sales have increased by about 33% sequentially, 144% year on year. The concern that a few brokerages have pointed out to is that it was lower than their expectations. It's come in at 1,920 crore rupees for the quarter gone by. It was expected to come in at about 2,500 crore rupees, a large part of this pre-sales being driven by their Thane project and their existing projects not resulting in too much in the way of pre-sales, which according to them is a bit of a negative, but they've all said that there are more positives than negatives, so watch out for this in trade today. The second stock Tamanna has actually told you about, Vodafone Idea, on the back of the news update that we had on NDTV Profit. The Supreme Court has in fact upheld a Bombay High Court order, and the IT department has been directed to refund 1,128 crore rupees with interest. The stock was up yesterday. Watch out for it in trade today. Of course, experts have already pointed out to us on your channel, on this channel, that you should be wary of trading in Vodafone Idea. The last stock that I'll pick is 6,000 crore market capitalization or thereabouts, AGI Greenpack. It's a bottling company, packaging company, primarily focused on the alco-bev or the alcohol beverage industry. It's had a strong quarter, revenue up as much as 7%, 658 crore rupees, but the margins have expanded on a year-on-year basis. They've managed to retain the margins where they are sequentially at about 27.5%, 27.9%. There you go. The net profit as a result has risen as much as 34% year-on-year. Remember, the stock has done particularly well over the last 3 months, bearing in mind what's happened with the rest of the market. And so watch out for that start in trade today.
Okay, and with that, I take over with 3 stocks on my radar. And the first one is going to be Zomato. I know that the earnings came during market hours, but we had plenty of updates coming in post-market in the conference call. So I thought it would be worthwhile to point them out as to what the management is saying. And they are, in fact, saying that capital expenditure will remain elevated over the next few quarters. And based on that, there could be pressure on operating margins. Do remember that the earnings of Zomato came in the last half an hour of trade yesterday, and we saw a sharp drop on the back of that because we saw a contraction in operating margins. And it does seem like it's going to will stay like this for the next few quarters as well. But the management is suggesting, to be fair to them, that once they're out of this expansion phase, profitability could sharply turn upwards. But until then, there's going to be a little bit of pressure. Now, the question really is, does this mean that Zomato could potentially will stay where it is? Remember that a handful of brokerages on the street have cut their price targets for Zomato, even though they are currently higher than where its current market price is. CLSA comes to mind. That is the one which has had a price target of 400 rupees per share, but we have not seen a cut there. We move on to MCX. It's been a very steady quarter, something on expected lines as well. The stock has done phenomenally well over the last 12 months as well, one of the biggest gainers coming through. We have revenue rising around 5% sequentially. We've seen an improvement in operating margins coming at around 64% sequentially against 62.8, and profit also consequentially going up by around 4% quarter on quarter. Next up, we have L&T Finance. This is where we have a little bit of a mixed quarter, but more towards the negative. So your net interest income sequentially has risen 2.5%, year on year 15%, but the provisioning has moved up substantially, sequentially up 32%, and that's the reason why we may just see a little bit of pressure coming through for L&T Finance. And consequently, because of the higher provisioning, we've seen profit decline by nearly 10% quarter on quarter, and it's going to be about asset quality going forward for L&T Finance, but it's going to be a thumbs down this morning for me. On that note, we slip into a short break, and on the other side, we get you all the market voices and set you up for today's Day of Trader.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? Welcome. This is India Market Open. We're looking at the futures and options space and how things are faring as far as the Indian markets are concerned. Yesterday was a day of trade where it was a quiet one, in fact. And, we didn't see too much happening. It was a relatively quiet start to the trading week. The question really is, what can we expect as we move into trade today? As far as the benchmarks are concerned, moving into the respective futures, coming down to the Nifty, sure, we did see a marginal up move there, 0.6%, and a very little change in open interest. As has been the case over the last few days, we have not seen any major commitment when it comes to when it comes to index futures, specifically for the Nifty or the Bank Nifty. The Bank Nifty, even though it advanced by around 1.7%, there was only short covering. There was no amount of addition in open interest. That brings us to your overall open interest distribution picture. And when it comes to that, while the Nifty can suggest that it's a roughly 500-point range, and we've seen a little bit of strengthening of the 23,000 mark as a support, as a base in the near term, based on the writing of puts. On the higher end, one might argue that 23,500 could be the upper end, but we have a considerable amount of calls being written at 23,600, which means that traders are just a tad bit wary of the fact that 23,500 in the near term could be tested. Let's talk about stocks then. And again, it was a day of trade where it was very evenly poised between advances and declines, but we did see longs in UBL and Wipro. On the other hand, pressure for Supreme Industries and India Mart Intermesh to a certain extent. We also had a lot of short covering for Canfin Homes, Vodafone Idea looking at a whopping up 9% up move, along with Havells and HDFC AMC. SBI Life, on the other hand, again reacting to earnings, is where we saw some longs unwind. All in all, it was a mixed day of trade and a continuation of what we have been used to of late.
All right. Thank you for that, Agam. But let's get on to our budget breaking. Now, Budget 2025 is expected to tweak customs duties on certain items, including consumer electronics, medical devices, and it's a move to promote domestic manufacturing, ease trade, and make export further competitive. Shimi joins in with the exclusive details.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices. Sources telling us that, electronic items such as washing machine, dishwasher, which currently attracts basic custom duty of 10%, may see, a change in the duty, and it may go up. And in fact, in the medical devices and equipment, which is being mainly imported from Vietnam, such as BP machine, oximeter, could also see increase in the custom duty. Meanwhile, government is also sort of examining to lower the custom duty on the components and the input materials of these, items. And we've been given to understand that the intent of the government is to sort of support domestic manufacturing, and at the same time, with higher custom duty, it will help to increase the entire investment, ease of doing business, and also the export competitiveness is what the government is looking at this point of time. Meanwhile, the review of the custom duty structure is also underway. In fact, rate rationalization of the custom duty is being considered. They are talking about how to sort of reduce the rate slabs to maximum 5 from the current 12 to 13 slabs at this point of time. Besides, they are also sort of discussing and deliberating upon to having a tax settlement, system to reduce the custom related pending matters. So overall, the review of the custom duty structure is there, which we will see some sort of announcement there as far as the plan goes. And on the duty side of it, we will see some modification and tweaking in clutch of items in the upcoming budget.
Thanks so much, Shrimi, for that. And something you should keep on your radar. We're days away now from the presentation of the budget for the new financial year. Let's talk about Zomato. In fact, it was one of Agam's stocks to watch and trade today. It fell off a cliff towards the end of the session, and that's because of the earnings. They disappointed the street, and that's largely on account of a miss on the Blinkit business, where the losses were higher than expected. Let's bring in Mahima at the start to set the context, because we've going to speak to a couple of experts on this. Mahima, what stood out? So I've already talked about the Blinkit business, but what more?
Right. So, in terms of the key takeaways as to, what went wrong with Q3 earnings of Zomato, the key highlight was that they've kind of, raised their guidance. First, they were going to do 2,000 dark stores by 2026, but now they've said they'll do it by 2025. So, high capex is going to lead to losses and margin contraction for the next few quarters is what the management has said. Now, once they're out of expansion phase, they've said that business will turn sharply towards profitability. However, going through slowdown was also started to, kind of was seen in November, and this will recover soon, however, is what the management has said. And monthly retention of core customers has sustained despite the competition. So the market share remains remains stable. Now, in terms of employee costs going up, well, the war for talent is there to stay is what the management has said, and they expect employee costs to remain elevated going forward as well. One more thing that stood out was that they've said that opening of new store in the same neighborhood will impact margins for a shorter term perspective. In terms of the numbers, revenue was up around 12.6% QOQ, EBITDA was down 28%, margins stood at 3% versus that of 4.7%, and net profit was down over 67%. Now, in terms of the segmental performance, food delivery, the gross order value growth slowed down to around 2.3% quarter on quarter. Margins expanded, however, to 4.3%, and margin improvement was basically led by the higher platform fees. Now, quick commerce, the gross order value grew by 27%. The margins, on the other hand, declined to almost negligible from 1.3%, and overall take rate also came lower. So, and brokerages on the back of this have kind of reduced their target prices but maintained buy. So, this is the overall view as to what has happened with Zomato.
Thanks so much, Mahima, for getting us those details. Let's listen in to what the management had to say on the earnings con call, because he spoke about some of these elements.
As we are seeing the share of products where there is the delta between MRP and what the brand and seller is selling at is increasing in our business. I think we are considering disclosing more data from next quarter onwards, which can help shareholders and investors understand the actual customer paid AOV as well as the gross GOV that we are currently reporting. There we do expect the investments in Blinkit to go up, and as a result, the losses on an absolute basis go up in the next 1 or 2 quarters.
Okay, Rahul Jain is joining us now. He's Director Research at Daulat Capital to break down the Zomato story for us. I mean, we saw some reaction on the stock yesterday itself, Rahul, but I think one overarching concern or question mark, if I were to put it that way, is competition beginning to show on Zomato's numbers now?
Yeah, of course. The entire strategy of expediting the expansion plan on the dark store seems to be an urgency, which is function of how the competition has raised the money and how competition is turning aggressive on various offer or enticing the customer. And there was a lot of conversation around how the retention portfolio has worked for Blinkit on its stabilized longish customer base. So yes, the competition is intensifying in this space, and some of the action which are taken by the players are a function of that, which is driving both capex as well as operating matrix in terms of what could be the losses that happened in this quarter and what they are trying to commit that they will continue to invest irrespective of a little bit of expansion of losses in the near term. I think all of this, that is a function of how competition is behaving in the space.
In terms of profitability, we saw margins below estimates at about 3%. Estimates were about 4.9%. PAT was also, frankly, quite below estimates. Now, the company is putting down to the pace of addition of dark stores. As someone who analyzes the company so closely, Rahul, are you feeling comfortable with the hit on profitability that we will continue to see for some time at the cost of expansion?
Yeah, I think one good thing that is happening with this consistent, faster pace of store expansion is that we are seeing a significant higher revenue growth, and even the current thought process of the management is that doubling of revenue is possible on an annualized basis. So that clearly talks about what is the appetite for this particular market. So that's a positive surprise for all of us. Of course, the estimate on the streets were suggesting that there would be consistent EBITDA improvement on a QoQ basis going over next couple of quarters despite this expansion plan. And once this hurdle has come in where the losses have extended in this quarter and it may stay for there for a couple of quarters, and there could be a lot of ambiguity that whether that is going to be there only for next 2-3 quarters, or this could be a much more longish trend, given that there could be even further expansion plan beyond this 2000 dark store count, which they said they would probably review once they reach 1600-1700 count. So we may probably hear about that in Q3 of next fiscal or Q2 of next fiscal. So I think to that.
So 1 minute, Rahul. So your assessment is best case scenario Q2 FY26, where you could see profitability. Is that correct?
This I'm specifically talking. Yeah, this I was specifically referring to the quick commerce business. The food delivery business would continue to trend slightly better on the EBITDA front. But yes, on the quick commerce business, it is difficult to imagine at this point that it would turn EBITDA positive on FY26 full year basis.
Okay.
It should stay in losses.
Okay, so on full year FY26, losses for quick commerce continue. Food delivery should relatively be okay. Now, Rahul, let's look at a Zomato versus a Swiggy. We don't know if Zepto is listing or not, but in the listed space, when you're looking at these two players and what the trade should be on Zomato right now, you already saw quite a dip on the stock, about 4% down yesterday. You've heard the con call. What would be your take today?
Yeah, I mean, even prior to this result, we kind of have a much lower valuation view on the stock because we were anticipating this kind of an impact to eventually play out at some point, and we had a sell view. So to that extent, we would it's playing out to our expected thought process. So there should be some cool off that may happen, and we may see the stock to get some further slide in today's trade and subsequent period. And there would be renewed thought process on how the profitability would evolve in this business. So I think that would be a consistent pressure, not just today, but maybe in coming period.
Sell on Zomato, Rahul, short answer, short version. Sell on Zomato, and what about Swiggy?
So Swiggy, of course, some of this trend are industry for the industry, right? So the QC expansion would also have a similar trait on the Swiggy, so it won't be good for Swiggy either. One ray of hope for Swiggy could be the fact that the food business has also seen some slowdown for Zomato. If they happen to deliver better on the food delivery business, which we expect, then probably there could be some valuation gap narrowing opportunity that may happen. So both should see pressure, but Swiggy should see lesser pressure, is how I would like to term it.
Minutes. Sorry, I'm just adding on because this comes to mind. Despite the 10-minute pressure, everyone now wants to deliver in 10 minutes. How do you see that on the balance sheet?
I mean, in India now everything has to happen in 10 minutes. So it's not going to work very economically in a lot of use cases. And even management reiterated that how profitable that proposition would be, they would learn over time. So I think all of this thing only adds to the near-term worries to the companies.
Okay, thank you so much for that, Rahul Jain. Analyzing Zomato's number, saying Swiggy relatively looking okay right now. I think the dialogue of that entire interview. Everything in India should now happen in 10 minutes, Alex.
I think that it's going to be an interesting proposition because I think these companies will realize that by incentivizing people to wait for a little bit, either by bunching orders or providing more discounts or something off, they might actually improve some of their metrics by doing that. So you might see more of this happening, in my opinion. Yeah. Let's see how that pans out. In fact, let's move on and talk about quite a few more stocks before the start of trade. We're just a few minutes away from the initial levels that you will see on your screen, but we're joined by Sunny Agarwal, who's the head of fundamental equity research at SBI Cap Securities, and Kunal Rambia, founder of The Street. Morning, gentlemen, and thanks so much as always for taking the time. Kunal, I'll come to you first. Initial thoughts on how we see trade today. Of course, we're seeing quite a few global equity markets trading positive, and it's indicating just a very narrow uptick. That's what we saw in trade yesterday as well, but we built momentum through the day, and the Nifty Bank also lent quite a bit of velocity and momentum towards the end of the session. What is your opinion about today's trade?
Morning, Alex. Morning to all our viewers and everyone. So if you look at the Nifty overall, definitely the downtrend continues for now. But at the same time, if I just draw, try to connect the maximum touch points in the downtrend, it's looking like a falling wedge formation. And the support, which we had discussed previous week, was near to 23,100. And we saw actually the decent bounce coming in, and Nifty is right now trading at 23,350. So I think this momentum might just continue for a while. On the higher side, we can expect the levels of 23,600 to 650 in the near term. That's on the Nifty. And when it comes to Bank Nifty, a strong support, which was placed at around 49,750, was actually broken. We saw the downtick till 47,800 kind of levels. We are back to 49,750, which was the earlier support. So now on, we need to watch out whether Bank Nifty takes out this level, because change in polarity is something which we consider in technicals. So resistance right now is on Bank Nifty at around 49,750. Above that, we can expect 1,500 points rally, positive rally. But for now, it's near to the resistance.
Would traders like yourself point out that trading the Bank Nifty at this juncture is fraught with danger? Do you ascribe to that view, and would you suggest caution? And also, can you give us the picks that you have at the start today?
So I agree, Alex. Now again, trading on Bank Nifty is literally risky at this point in time. The only reason being it's near to the resistance. But if I'm a trend follower, for me, these are the good opportunities to buy the dip, because the overall trend remains positive on last 3.5 years, the data chart. Okay, now we come to the first pick of the day, and that's Bajaj Finserv. I'm very bullish on Bajaj Finserv. This counter has made a good consolidation of last 15 to 20 days, and now it's showing the momentum again. Yesterday, it was a win trade by around 3%. So I think considering the stop of 1,700, one can go long on Bajaj Finserv, and the target can be 1,800. Again, keep trailing the stop loss rather than booking the profit near 1,800. The second is IOB. After a good set of numbers yesterday, counter was in momentum. It was up by 4% approximately, and the closing was near to the high itself. Considering the stop of 50-50, one can initiate a long on IOB also, and the targets can be 60. And the third counter is HDFC Bank. Now, this is an exceptional one because on one side, we are looking at the resistance on the Bank Nifty, but on the other side, we are looking at the buying opportunity on HDFC Bank. But yeah, it's looking good. Consolidation base has already been formed with the stop of 1620. One can go long on HDFC Bank, and the targets can be 1750. So these are the three picks for the week and for next 15 days.
Okay. All right. Let's bring in Sunny as well. Sunny, interesting that there was Bajaj Finserv and IOB and HDFC Bank, all from the financial pack from Kunal's list. And in fact, that pack was buzzing in trade yesterday. Did you see anything in the, of course, we've already spoke about Kotak numbers, but L&T Finance and also J&K Bank. I'm curious about whether you've seen those numbers. Did asset quality worry you at all? I've been told that for J&K Bank at least, the impact is not on the provisions.
Yeah, good morning, everyone. I think, yes, both the, L&T Finance and J&K Bank, we have seen some worry as far as asset quality is concerned. And I believe that was something anticipated, and that is the reason we are seeing a stock trading at quite a cut lower levels since last 3 to 4 months. I think all the negatives are already in the price as far as both L&T Finance and J&K Bank is concerned. So J&K Bank trading below 1 price to book again. Led by lackluster growth as far as advances and deposit is concerned, and at the same time asset quality issue. But we have of late seen a change in management in a J&K Bank, and we are hopeful that maybe next year could be a good year as far as J&K Bank is concerned in terms of recovery as well as growth on advances front. So J&K Bank, I don't feel that the street will react negatively to the results. At the same time, the same is the case with L&T Finance, as everyone was aware that unsecured book, rural as well as MFI is under pressure, and that was the case with L&T Finance, where they have used an buffer from an provision or earlier provision which they have made to report a decent set of numbers. So again, I would like to remain neutral on both the names in a short term.
Right. Sunny, thanks for that view. Do stay with us, Kunal, as well. We have to slip into a very quick break. Just a quick reminder, we are heading towards what could be a positive open. Narrow positive open is indicated right now, but let's see if momentum is built through the day. We'll be back in a very short while. Do stay tuned.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect
Welcome back. Just about 35 seconds for markets to start trading in the pre-open session. But before we track all of that for you, remember, it's such a power-packed day. You have corporate results, you have Trump taking oath, and you have world leaders all together at the World Economic Forum in Davos, where our very own Neeraj Shah is. And here is his update on Davos Diaries.
Well, it's really cold on day 2 of the World Economic Forum at Davos, and good morning to all of you. But it's piping hot on the NDTV network, really, because of the slew of voices that we have lined up today. We start off the day with a conversation with Geeta Gopinath, none other, and it's important, especially at a point of time when a lot of countries are saddled with very high debt in what is presumably not a lower interest rate regime in 2025. Then, while the president and global CEO of ABB, Martin Weyrauch, and the global CEO of Hitachi Energy, Andreas Schierenbeck, are two of the biggest voices that we have on NDTV Profit, I think the panel discussion on AI with Matt Renner of Google and Rajiv Shah of Rockefeller Foundation also assumes a lot of significance considering the topic to be discussed at hand. We also speak to Kasim Kutay of Novo Holdings. It's a 150 billion euro investing firm, as well as Rishi Kapoor, $50 billion investing firm called InvestCorp, and ask both of them about the flow of money from various nations to emerging markets and India in particular. And we round off the day with a conversation with JSW Sajjan Jindal on how does he see the response to Indian states and Indian corporates right here at the WEF. So promises to be a very exciting day. You don't want to miss any of the coverage on NDTV Profit. Back to you.
All right, let's pull up the first rates as we move. Nifty up 0.5%. This will settle, but overall not looking half bad on day 1 of Trump. But listen, Trump results, Davos, all of that coming in. I want to see what Dixon is doing this morning. I want to see what Zomato is doing this morning. I want to see what 197 is doing. Dixon about mildly in the red, bumper results, but maybe valuations in pain. Zomato, as we said, I mean, that con call making it very clear, Blinkit is not going to be profitable even till FY26. 10% down, 10 minutes comes at a huge price. Let's see 197 and what's happening there. And 190, Paytm is what I mean, 197 communications. Let's check that as well. That's mildly in the green. Suntech Realty is moving in the first couple of minutes of trades. I'm seeing Honasa Consumer showing some movement. Kalyan Jewellers, you should keep in mind, already up yesterday as well. Promoters have had to pledge more shares, but that's, you know, sort of working in lag because the stock had fallen. But you've seen the continuation of uptick of Kalyan Jewellers. I think a day after Motilal Oswal came out with its clarifications on rumors in the market on why they had put that much money in Kalyan Jewellers. But I think the stock of the morning to talk about is Zomato. We've already had one conversation, but I'm going to continue with Sunny Agarwal with us this morning as well. Sunny, great to speak with you. What is your take on Zomato? I want to pull up Swiggy while we're at it. The quick commerce shine, is this just one day's pain that we might see today? Swiggy also mildly down, 1% down right now. Or is there more coming? Because these are stocks that have run up massively, especially a Zomato. And today you're seeing some pain there.
I feel maybe a knee-jerk reaction today, but one has to keep in mind that the kind of expansion which Zomato is doing on quick commerce front, so they have added close to 30-40% of their stores during the last 6 months. Again, on the top of 1,000 stores, new 1,000 stores will be added over the period of next 12 months. So I think whenever there is an increase in competition, I think that's the best strategy which we have seen even in the QSR, in the QSR industry, where the companies go aggressive on the store addition. And then when the competition recedes, the top 2-3 players are those that gain massively as far as the revenue share as well as margins are concerned. So maybe a temporary blip in a growth story as far as the profitability is concerned. But again, I feel it's a good time where one can accumulate the stock if somebody has got an investment horizon of more than 2 years. So both Zomato and Swiggy, we like the business and the opportunity is pretty large.
Okay, so Sunny, can you tell me, in your opinion, based on your valuation metrics, what is fair value for Zomato and what is fair value for Swiggy at this juncture?
I think we continue to remain constructive on Zomato with a price target of 300, and for Swiggy, our price target is close to 600.
300 on Swiggy, 300 on Zomato. Buying opportunity today, Kunal, in your view?
So, Zomato is been successfully holding up this 240 mark, but now looking at the pre-opening, if at all it breaks that level decisively, then the next level to think of initiating a buy would be near 205 to 200 zone. I will not be in a hurry to catch the falling knife. I'll wait for the price to settle near 200. We can think of initiating a buy then.
Okay, so Zomato, hold on. L&T Finance is the other one that we need to talk about, and we're going to speak with the management. But L&T Finance has been also in a world of pain after its numbers. Alembic also falling today. But Harsh is joining us to talk not about L&T Finance, but about the top brokerage call this morning. Harsh, and you've picked Hindalco.
Right. So Citi's reinitiated coverage on Hindalco, 725 being the target price, 17% upside from here. They're saying that most concerns are priced in. You're looking at the stock trading at 5 times EV to EBITDA, which according to them will be reasonable even by that stretch. They're saying that concerns, first one, weakening scrap spreads, tempered EV demand growth, alumina price correction, implication of potential US tariffs, as well as aggressive Bay Minute capex. All of those are largely priced in currently, is what they are saying, and therefore the constructive reinitiating note. They're saying that the stock has underperformed domestic non-ferrous, global and domestic non-ferrous as well as global aluminium producers and LME over the last 6 months, and that underperformance gives this the kind of upside that it does. It's positioned likely for tailwinds as well. LME upside over maybe the second half of calendar year 25 is what they're building in. They're also seeing Novelis's efforts to diversify scrap inputs as a possible positive. Overall, you're looking at long-term India costs. That should also fall. Alumina expansion, captive coal, as well as Novelis's profitability from the Bay Minute project. All of those should aid the numbers. Novelis should be able to contain the debt to EBITDA to below 3 times is what they are saying, and this is despite aggressive capex. Hindalco is their top pick. They're valuing Novelis at 6 times, the India business at 5 times, and giving it a target price of 725, which is 15% plus upside from here.
Thanks, Harsh, for getting us that. I just want to very quickly, not to draw too much attention away from the equity markets, because we're going to get the numbers for pre-open very soon. The rupee has moved quite sharply this morning. It has opened in the green, in that it has advanced against the US dollar quite dramatically. And this is in line with what we already told you at the start today. You had the dollar index that dropped about 1% or so. Of course, it moved slightly higher when Donald Trump was talking about those 25% tariffs that he's contemplating against Canada and Mexico. But it has settled at around that 108.2 mark. And dollar index, of course, measures its strength against a raft of currencies. The rupee is moving sharply against the dollar. And you also have bond yields come off just a tad bit, 3 basis points lower on the 10-year yield. So something to watch for.
Okay, so this is great. Rupee strengthens as Trump comes in and was weakening in anticipation.
Yes.
Maybe some relief on no clear tariff calls right now. And whatever he said also, he's mentioned Mexico, he's mentioned Canada, and he's mentioned China as well. But he's not...
Not very clearly.
Not very clearly, of course, with the TikTok band sitting with him. But another stock that I want to focus on very quickly, and yes, we've settled with pre-open race. Let's just pull up Suntech Realty. Bumper numbers came in a couple of hours after markets closed yesterday. And a really good set of numbers. Revenues are up nearly 300%, 281% to be precise. They've gone from 42.4 crores to 162 crores. EBITDA is at 48.4 crores versus a loss of 15 crores. So they've gone into the black there on that figure, and margins close to 30%. Net profit also, it's a good number, 42.52 crores versus a loss of 9.72, nearly 10 crores last time. So 8% up on a Suntech Realty. Sunny Agarwal, real estate overall, but Suntech Realty, because real estate has been a bit of a question mark, right? Some players doing really well, some players not so much. Where does Suntech Realty sit in that spectrum for you?
Yeah, definitely. I think Mumbai market has been relatively resilient in a challenging environment. And Suntec, again, being a pure play Mumbai player, we have seen a very good set of pre-sales. In fact, pre-sales growth has been 40% in this quarter. At the same time, the new project launch adds close to 2,500 crore of GDV. I think a pretty strong set of number from Suntec. And we continue to remain bullish on Mumbai-based real estate player, whether it is Suntec, a Macrotech again, which has got a significant exposure as far as Mumbai market is concerned. Marathon Realty. So these are the few players which are predominantly have a presence in Mumbai and looks good from a short to medium term perspective.
Okay. While we're at it, Sunny, let's also talk about Oberoi Realty because it stood out to me. Of course, I'm reading notes that are talking about the pre-sales number, which came in at 1,920 crore rupees. Expectations I've read were around the 2,500 mark. So are you disappointed at all? Because the numbers per se, the headline numbers and the margin expansion were very strong in the third quarter.
No, not really disappointed because what I believe is that real estate business are not to be looked upon quarter on quarter. Ultimately, it is there may be some shifting of number from one quarter to other depending upon the launch of the project and ongoing demand environment. So I think again Oberoi continue to remain the darling stock as far as real estate entire industry is concerned. Debt-free balance sheet, robust growth, very good corporate governance practice. So no doubt, I mean, in case there is any negative reaction in the stock, I think it will be soon lapped up by all the investors.
Okay, so that's the take on Oberoi Realty. Where are we looking at the top trades this morning? Kunal, let me come to you now that we have seen the pre-open settle. First, I want to take on a Suntec Realty from you. I want to take on Kalyan Jewellers, and then I'll come back to where you think the indices will move. Kunal.
So, on Suntec Realty, the typical observation is that this counter has always shown us corrections of 20%, and that's been 5 times since 2020. Recently, also, we saw the correction from 640 levels to as low as 440, and it has really bounced sharply in last 3 to 4 sessions where, it actually reclaimed the lost ground of 500 mark. And today we are seeing a gap of open. I think the trend remains very, very clear. Rather than buying at this elevated level with this announcement, the result reaction, I think one should wait for the price to settle down. Good support is near 500 level itself. With that level in mind, one can strategize the entry onto this counter. Coming to Kalyan Jewellers, if I'm not mistaken, you asked me for that also, right? So can I just share the view on that?
Yes, please, Kunal.
Yeah, absolutely. So Kalyan Jewellers, this counter started the final uptick somewhere in August 2024. And that base formation was near 515 mark. We saw the correction coming in from 750, 780 back to 525 levels. If this counter manages to hold the levels of 525 decisively for a week or two, consolidates at this level, and then if it gives a breakout, then I'll be keen to watch out for this counter because it's offering good risk reward ratio. But for now, I'll avoid this counter.
Okay, so you'll avoid Kalyan Jewellers. Suntec Realty on your radar. You've said you'll wait to see better levels when it comes to a Zomato as well, Kunal. But now what about the indices? Let me get your view on the indices today, because you're seeing the Nifty settle in the green, decent enough, above the 23,400 mark.
Absolutely. So Nifty and Bank Nifty both are looking good. I think Nifty has a space till 23,600 to 650 kind of levels. In next 10 to 15 days, we can expect those levels. And on Bank Nifty, yesterday's high was right onto the resistance, which is 49,650, 700 kind of levels. So if Bank Nifty manages to surpass and close above 49,750 mark, then I expect further 1,000 points rally even in Bank Nifty. But for now, I'll stay cautious on Bank Nifty and comfortable with Nifty.
Okay. Very quickly then, Sunny, your quick view on, so we've already spoken about several, Zomato as well, but Vodafone Idea, would you touch that at all? Or would you stay away and wait for durable information to come through, Sunny?
Yeah, I would like to wait because I think everything is purely basis media reports. So better to wait for, sorry. for actual outcome.
Let me allow you to catch your breath a little bit. In the meanwhile, Kunal, would you also stay cautious on Vodafone? We saw a big move yesterday. It's flat today.
So, Vodafone actually has bounced from the extreme support level of 6.5. Consolidation breakout was near to 8.5, and right now it's trading near to 9.5. So, considering that 8.5 is a good level, one can strategize the entry. If someone has already initiated a buy, then the trailing stop loss on this counter is 7.5. Rather than buying at this 9.9.
Okay, I'm gonna have to just, sorry Kunal, cut you there. Vodafone, we'll wait and see how it opens. Just about 3 seconds to go. Day one of Trump 2.0. How are markets reacting at this point? Let's just take a quick look at it. Not bad. The Nifty opening nearly 60 points up, at least in the green. Will it manage to stay above the 23,400 mark? No, doesn't look like it. Bit of pressure coming in the first few seconds of trade right now. Bank Nifty is doing okay. I want to just pull up Nifty IT if we can very, very quickly, and that also looking muted. Range bound, muted trade. The key indices giving up their gains quite quickly right at the get-go. Let's pull up the heat map for you before we get to the broader end of the indices and what's happening here. Oil and gas under a bit of pressure. Remember, in the Trump regime, you are going to be seeing more focus on energy. Expect crude prices to be under pressure. Maybe that's why you're seeing ONGC about 1% down. He's made it very clear that America needs to drill and have its own oil and export its own oil. So more supplies there. Trent looking muted, NTPC as well, but not half bad because I'm seeing much more green. And what's on the green side? Apollo Hospitals, a bit of a defensive play there, about 2.5% up. Ultratech looking okay. Tech Mahindra actually doing decently after yesterday's take on the numbers. IT is doing fine. IT is in the middle ground today, I would say, because TCS not bad either. Remember, auto got beaten down yesterday, so auto seeing a bit of a comeback. I'll just pull the broader markets very quickly before I hand off to Alex for specific stocks that he's tracking this morning. And you're seeing the mid cap mildly in the red, but flat. It's a flat market with a consolidation phase and a very small range of trade that you're seeing. Even the small cap 250 completely flat. It's all about specific stocks this morning, isn't it, Alex? And down to the core of results at the end of the day.
Absolutely, and you're seeing even mild disappointments being punished very, very heavily. So let's talk about some of these, right? So you've already got a very quickly moving picture. Realty is down in the dumps, and I'll tell you why in just a bit. But let's pull up Dixon Tech, because you thought that it would be a stellar set of numbers, over 100% growth in PAT, and revenue is doing well as well. But the stock is under tremendous pressure today, 7.5%. Perhaps to a certain extent, you can attribute that to the expenses that the company will have to bear, the pivot that it's having. It's announced that it's interested in the semiconductor space. We'll have to watch and wait and see how that pans out. L&T Finance was on my radar on account of asset quality. The stock is under pressure, 1.7% or so. J&K Bank as well, the other way. J&K Bank as well is more or less flat at this juncture. It saw a weakening in asset quality, but not as problematic as certain other lenders, and so as a result of which the street is looking at it in a benign fashion. PTM, let's pull that up as well. You had the management speak about the return to profitability in a quarter or two, and you've had several positive notes come through, of course, but the stock is under just a little bit of pressure at the start, down about 1/3% or so. AGI Greenpack, I'm curious about this one because it was a solid set of numbers. There you go. The stock is up as much as 6%, over 30% growth in net profit, and the company has managed to keep its margins steady at over 27%, in fact heading closer to 28%, which is looked at as a very positive sign. Vodafone Idea, let's see how that one is doing in trade today. Remember, yesterday it was up as much as 10%. It's down about 2.3% today. It has clarified that it has heard nothing from the government on the AGR dues. And there's also that small update from the Supreme Court where you've seen that it will get an IT refund from the IT department. Zomato, it was under pressure at the start. It was under pressure in trade yesterday. It continues to be under pressure today. Down about 7%, and that 10-minute delivery causing a bleed in the numbers and in fact in the stock price as well. You have analysts that are still bullish on the stock. In fact, Sunny Agarwal, who's speaking to us right now, has got a target of 300, so watch out for that one. Let's talk about the real estate pack. Oberoi Realty, I really thought that this would be a thumbs up. I hold on to that view, despite the fact that it's a 5% downtick. Of course, what is worrying investors and upsetting the street is the pre-sales number, despite the fact that it's up over 30% sequentially. What was problematic is that it all came from one property, which is the Thane property, and the other properties did not contribute too much. The expectation was for 2,500 crore in pre-sales. It is coming at 1,900 crore rupees, as a result of which it is being beaten down quite substantially. Sunteck Realty, on the other hand, a return to profitability in the third quarter from a loss in the comparable quarter, is being given a big thumbs up from the street. And so, Tamanna, what really I can see is that any minor disappointments are cause for a major beatdown, and positives are rewarded handsomely.
Absolutely. That is what we're seeing. Auto stocks on recovery mode. Kunal, just quick view, and I want to get a view from you on the index, the Nifty IT, because that's, I think, the only space where I can see some kind of positivity in the key indices. If you have a Nifty call, do add that as well.
Absolutely. So on the index front, on the IT front, I think, yeah, the trend remains absolutely intact. 41,675 is something to watch out for. Yesterday, we saw the level of 690. So 675 is a good support. Considering that, one can initiate a buy on that. And when, on the index front, again, Nifty is looking attractive, comfortable. Bank Nifty is looking a little weak. I'll wait for clarity.
Right. Thank you so much, Kunal and Sunny, for joining us this morning as we track just, where the markets have opened. I think Zomato, one standout story. Dixon, one standout story. Dixon, great set of numbers, but the street really punishing it today. Maybe some question marks about where their margins are, because everything else looks good, but margins completely flat and slightly dipped as well. So perhaps that's the reason, but the level of punishment seems a little extreme. Sunteck Realty, though, the hero this morning. So those are some of the standouts. But we're speaking about what the impact of Trump 2.0 is for India in various sectors. We have a very special conversation right now with Umang Nahata. He's the CEO at Mastech. Umang, great to speak with you this morning on NDTV Profit, and thank you for your time. I'm sure you, like all of us, listened very, very carefully to what POTUS was saying, what President of the United States was saying consistently. And I think one of the things that caught my eye is that while signing orders and speaking to reporters, he says, I'm not against legal immigration. We need people. Does that give you some relief?
Yeah, it does, but we've still to watch and see. Last time when Trump came to power, the immigration rejection rates really skyrocketed from 4.5%. It went up to more than 15%. So I think we are expecting that there will be a little more strictness on the immigration side. Having said that, the business also is gradually again tilting towards more offshore. A lot of GCCs coming in, which are the global competency centers, which are based in offshore. A lot of AI-driven work is coming in, which also reduces the amount of skilled people. So it's a bit of a balance, but we're watching it with caution. There could be a reduction in people moving from India to US, which will also mean I think we're looking at it. Hiring local US teams is also a part of the strategy that we're looking at. So it's with a little bit of caution that I'm looking at it right now.
Fair enough, and it should be a fair amount of caution. Just help me understand that for you, what are the kind of revenues which come in from the US, and if you have to localize talent, what is the impact on margins, for example?
So currently, approximately 110, which is around 25-30% of our business comes out of North America. So it's a pretty balanced, although our ambitions are to definitely grow it phenomenally to 50% and more. And we have a decent on-site team already. So we have a pretty heavy on-site offshore, or pretty balanced on-site offshore model with our US business. So I don't see a severe challenge for our business right now in terms of the on-site offshore mix and the people that we need. Having said that, as we grow forward, I mean, the adoption of technology, especially AI, in terms of delivering activities and delivering work, will decide the amount of on-site resources or more local hiring that one has to do. So I'm putting the two on the balance between adoption of AI as well as the offshoring of work to decide how much impact will it have on local hiring.
Okay, Umang, hi. Just wanted to know what you think about the business that is going to emerge from the US based on everything that you're seeing, right? And perhaps also clue us in on the conversations that you've had with clients on how they're spending. Were they maybe holding on to their purse strings and saying, we'll see how things go, which way the winds will blow, and maybe then in the fourth quarter you can anticipate some more spending?
Yeah, I think we are looking at it quite optimistically here. So there are three important aspects to the whole thing, right? One, clearly, President Trump has been a pro-economy, pro-business kind of a leader in his previous stint also. So we're expecting some healthy macro environment with interest rate adjustments, tax cuts on the corporate and things like that, which will allow more discrete spend, and any discrete spend really is very healthy from an IT industry point of view. So that's one overall macro trend that I'm thinking that will really help the whole position. The second is very clearly with the amount of technocrats, supporting Elon Musk very much in the government, and a lot of business leaders in and around the president's government and his advisory council. I think a lot of IT innovation spend, that is especially around AI, especially around new tech that is happening, will get a lot of promotion, a lot of policies which will be balancing the regulations to allow more spend on tech is also expected. So given the two together, our clients are really looking forward to having increase in their discretionary spend. Although right now, I would still say there was a little wait and watch. But I think as we go forward into Q4, it should turn into a much more positive year ahead.
Sorry.
So just a quick follow-up to that then. I'm just wondering what kind of spending do you anticipate will take place initially? And do you expect that in the new year that will change? Because already over the last year, Umang, and I'm talking about FY25, there have been very large strides that have been made, particularly over the last couple of years in generative AI, in the way that people are doing business. They're incorporating a lot more into their regular activities. So from your perspective as well, will your mix also change?
Yeah, I think generative AI as a wave will phenomenally change the IT services industry. I mean, what we have seen is still, not even the tip of the iceberg yet in terms of the amount of change that it is going to drive. So all the work that we execute, a lot of, especially coding or, documentations or testing, a lot of other stuff, a significant portion of it is already automated. And that changes the mix in terms of the way we execute our business. So a lot of balance has to be done in terms of the kind of resource pool that we have and their awareness of using these tools and technologies to deliver. So the expected rate of delivery will definitely change phenomenally. So that's one change that we are anticipating. The second change that is going to come up is the kind of solutions the client have. So if you look at the traditional model where we were looking at a lot of business logic built in between the UI and the database, a lot of that business logic will now go away and will be replaced by agents who will be taking care of that business logic, which will require an upgrade of software. So an initial space, it will be, the initial wave will be AI engineering wave, where you will have a lot of AI engineering work required to, develop or rebuild the applications that the clients have with AI agents embedded in it. And then as we go forward, it will be more about, really building more SLMs and much more data driven as we, take it forward from there.
Okay, just some new orders. I mean, Donald Trump is on a signing spree. This is just updates from the last hour. He signed an executive order to change name of the Gulf of Mexico to the Gulf of America. He signed an executive order on the death penalty, directing all necessary and lawful actions so that states have enough lethal injection drugs to carry out executions. He signed an executive order requiring that within 60 days there should be an end to all DEI government programs, that's diversity and inclusion programs. So a whole host of stuff happening. Nothing on tariffs so far, Umang. I'm just trying to understand, in all of the things that Trump could do, what would be the best case scenario and the worst case scenario for an Indian IT company like you?
Yeah, I mean, a lot of unexpected or, it's a little unprecedented, right? And the kind of change, the general feeling is a little, you don't know what to expect. So things are changing so fast, and a lot of quick decisions, and then maybe little adjustments going forward with them and things like that. And many of these were things that were developing over the years, right? For example, DEI or environment, or many of these areas have been very strong human issues that the society in general has been really vouting for, whereas President Trump has really taken a contrary view to many of those. So it's an interesting scenario in terms of where things are. A lot of unprecedented things may happen. My guess in terms of what could be the best case scenario for us as Indian IT services is where we look at good opening up of economy with the macros factor really running well, a lot of discrete spend coming back into the picture, and good healthy adoption of technology for driving the kind of goals that we really have to drive in terms of delivering value to our end businesses, especially using AI and a lot of other new tech that is really coming up. So that's the best possible case scenario. The worst case scenario would be we get into a geopolitical turmoil. And once you get into a geopolitical turmoil, then a lot of uncertainty creeps in. Everybody starts holding back discretionary spend. People want to be cautioned about
Saying the reverse, Umang. He's saying the reverse. He's saying Putin wants to talk to me, Zelensky wants to talk to me. There's a ceasefire before I've taken office. So then does the reverse work?
Yeah, but on the same breath, he's talking about expanding the land that US has, asking Canada to join US, asking the Greenland should be acquired by him. So there is stands that he makes, right? And therefore, like I said, these are two extremes. The positive side, yes, we all hope that it continues to be peaceful and the economy does well, and we'll all be. That's the best case scenario. And I'm just talking about the worst case scenario. I'm really hoping that we don't go there. But it's a degree of uncertainty that at least I look at.
Uncertainty, I agree. Uncertainty, I agree. And that's I think what we're seeing in the markets today as well. Umang, thank you so much for coming in and this excellent conversation on what the world of Trump for the next 4 years means for IT companies specifically from an Indian perspective. But meanwhile, that's the talk of the town all the way in Davos as well. Listen in to some of the commentary coming in.
So I know the time's uncertain and we don't know what's going to happen, but I think definitely India would be in a positive light that I feel very, very optimistic about. And you spoke about the tariffs and the impact on inflation. Well, I think there is an opportunity there to work with our global retail partners to see how we can get that under control. But I think overall, I would say compared to the other countries and other democracies and China, of course, India holds itself in a good stead.
For us, India is the key growth market. We have more than 24,000 people in India, 2 major innovation hubs. Essentially, every product today that Siemens is shipping is software enabled, and that software has been most likely touched by Indian engineers that do software development. So pretty much India is going through all the offerings that we have at Siemens. Okay. But more importantly it is a huge growth market. India wants to be, or has the power to become the 3rd largest economy by 2030, wants to increase the manufacturing share from 15 to 25%. And we say that, Siemens needs India for the growth, but India needs Siemens in order to bring the tech that you need to make that leap in productivity and technology. The world is not about technology. The world is about outcomes, that actually people get more prosperous, more healthy. And so we have to see the benefits of that technology coming through. And as everybody says, 2025 is the year of reckoning, where we see some of these use cases showing their true value.
All right. Let's move our focus to corporate numbers and L&T Finance first in view. Harsh Saita joining in. Harsh, you spoke with the management a short while ago. We're going to be hearing the interview, but I just want you to quickly set it up for us. The 2 or 3 key points that we should focus on when we hear that interview.
Well, yes, first off, Tamanna, with regard to margins, margin picture not looking pretty. Margins plus other income is what they club. And they give us a number, and that number should be around 10.5% to 11%. That number has fallen to 10.3%. So to try and understand more on that is what I've attempted to do. The other one is with regard to credit cost. Now, credit cost has come at 2.5%. but another 100 crore rupees of provisions, contingent provisions, which was lying as a buffer, has been utilized. And what the management said, they're going to use another 350 in Q4. So the end in terms of the pain does not seem to be in sight, at least in Q3. Q4 is likely where the pain is going to be. They're hopeful of a recovery in 2026, FY26.
Okay, thanks you so much for Harsh, but let's go across to the management and see what they're saying. Listen in.
Let me first sort of give you how our disbursements panned out in Q3, and in spite of some of the difficulties that we have seen in some of the sectoral difficulties, L&T Finance actually disbursed 15,210 crores in the festive quarter, which is actually our highest disbursement ever. And our AUM growth rate also has been reasonably okay at about 23% on a year-on-year basis. However, yes, you are right. There were two things. The first and foremost thing, we saw certain ongoing challenges in the microfinance sector in terms of asset quality. And because we are a significant microfinance player, we cannot be immune to the same, though our sort of pain actually came from more of the macro-related disturbances like heat waves, etc., and the floods. Actually, we had floods in Q3. Wherein, in the month of October, we had very, very bad floods in Bihar, right? And that displaced a lot of people and also impacted a lot of our collections efficiency. So some of those macro-related challenges actually continued through Q3, and some of the sort of the flows that we had seen emanating in the beginning of Q1 and Q2, actually those flows started actually, coming into the sort of the final provisioning stage. So obviously that has given to a rise in credit costs during this quarter. Also, what we have done is that we have tempered down some of our disbursements and taken the guardrails up, especially in the microfinance sector. Also in the two-wheeler business, for example, we focused on tightening our throughput quality, etc. So overall, we have been doing a lot of work on the credit side just to make sure that while we grow, we navigate the environment effectively by taking the guardrails up, and because of the reason to sort of temper down our microfinance business, that has sort of given an impact on the overall NIMs and fees, because the composition of the disbursement as well as composition of the book has slightly changed. And as you know, microfinance is a high yield, business. So as the microfinance disbursement has got tempered down this quarter, there has been a little bit of a sort of a tempering down of our NIMs and fees trajectory as well as I have told earlier, there has been an increase on the credit cost trajectory as well. So overall, a tough quarter, but I'm quite and as we said in the press release, that we are quite happy that our teams have managed to navigate this difficult situation quite effectively.
Fair point. Okay. How long do you expect this pain on the credit cost front? Let me just cap off that point. Couple of quick questions on that. So how long do you expect that pain to continue for?
See, one of the things is that we have seen, especially in the microfinance sector, we have seen some green shoots in December, and we continue to see a holding pattern in the month of January. We saw our collections efficiencies go up in the month of December because the situation in many of those flood affected areas in Bihar improved, and so collection efficiencies came back. But overall across the country, collections efficiencies in most of the geographies seem to be on a sort of a stabilizing or an upward trend. Obviously, we have had very good Kharif crop. The Rabi sowing has been good, especially in the rural sector. So we expect that the Rabi crop will also be good. So we expect that the rural liquidity and the rural incomes will have a positive trajectory in Q4 FY25, which augurs well for the rural sector. We had a record month in October and November in terms of tractor disbursements. So there has been very, very good tractor disbursements. So that is also another green shoot which gives us a bit of comfort. However, it is very difficult to put an absolute pulse on whether this entire situation is fully over. We are optimistic that we are seeing the first signs of the bottoming up of the microfinance credit crisis for especially the players that have very well-run franchises and have bought strong credit guardrails. And we are hopeful that things will continue improving from here, leading us to a much more normalized trajectory probably in Q2 FY26.
Okay, so point taken. So you've spoken about MFI, you've spoken about Bihar. So those are two key two key areas which are dragging your numbers. Any other area, sector which is currently a possible concern currently as of Q3 or going forward that you are starting to see concerns in?
Concerns, see,
from an asset quality
say,
standpoint, yeah, from a collections.
No, from an asset quality standpoint, we remain focused on what we call our rural business finance, or otherwise known as the microfinance segment. That is the segment that we are focused on. We have been doing a lot of work on the credit quality side through our digital credit engines introduction, in Q1 and Q2. So more or less, I would say that the credit profile of the other lines of business are in line with industry parameters or better than industry parameters. So that the details of which we have put it in our analyst deck. So as of now, we remain focused on stabilizing the sort of the credit trajectory in our microfinance business. All our businesses, other lines of businesses, more or less are sort of pairing close to the industry performance or better than industry performance.
Fair. And with regard to microfinance, you've toned down on the disbursements and therefore you suggested that margins have come off. Do you expect this to be the normalized margin plus other income kind of trajectory, which you are currently sitting at 10.3% versus the nearly 10.9% number same time last quarter? What's the sense like? Is there going to be further calibration here?
So we had guided saying that during normal times, that means in times where we do not have stress on any lines of business, we will try to keep our NIMs plus fees in the range of 10.5 to 11%. Now, obviously, these are times when where there is some sort of macro headwinds in certain lines of business. So obviously that has led to the tempering of the NIMs and fees. As and when, while we are doing this, we are also trying to sort of expand our business in the non-leveraged customer segment as well as in new geographies like AP and Telangana, Western Maharashtra, Eastern UP. So in the microfinance business as well, we are also trying to make sure that, we do not slow down the engine so much that it has a meaningful impact even on our go-forward trajectory. So what we are trying to judiciously balance between, quality and growth, right? With a focus on quality. Right now, but also keeping an eye on growth as well. We are hopeful that, if the sort of the current sort of trajectory of stabilization that has been visible for the last 45 days, if this continues, then probably, we probably can get to a normal growth trajectory sometime in the latter part of QI FY26 or, Q2 FY26. So obviously, we do expect that as things normalize, our NIMs and fees trajectory to come back to the guided trajectory of 10.5 to 11%. We are also working on several fee-generating initiatives. As you know, we have now got a insurance distributor license wherein, we can now sell insurance to the entire sort of life cycle of the customer, which we could only previously do at origination stage. So we are also looking at diversifying our fee profile as well. And I do believe that as things normalize, we will get back to that guided trajectory of 10.5 to 11%.
And this is, so the recovery that you might or you are anticipating in Q1, Q2, FY26 is a function of microfinance recovering. Just trying to clarify for viewer
It's a
perspective.
majorly a function of the microfinance recovery because it's a very large line of our business.
And that will bring down credit cost as well. So it will be a double positive for you if that were to play out.
Yes, from a bottom line perspective, it should be a double positive. But as I said, we have to see how the numbers are panning out in Jan, Feb, March in terms of collection efficiency and probably in the early parts of Q1 FY26.
Fair point. Okay. Your ROA number has been slightly volatile as a result of all of these moving parts. Would you want to give a more steadier ROA in terms of the way in which ROA QOQ moves? And what will you do in that sense to try and bring it, and how quickly can you bring it to that steady state number? Whether it is 2.5, whether it is 2.3, whether it is 2.8, whatever that number is, you guided for 2.8 to 3, but is there some way in which you all are going to bring more steadiness to the numbers?
See, there are only, obviously, given the fact that, disbursement is something that which we have in your control and your disbursement engines can be easily, easily fired up or sort of calibrated according to the credit environment. I think the two sort of major sort of lines which have a outsized impact on the ROA trajectory is first, obviously, your credit cost, and secondly, your cost of funds profile. Now, the fact is that if you see our cost of funds profile has been very, very stable for many quarters. Currently, this quarter, it's only a 3 basis points growth over last quarter at 7.83%. So I think the real sort of the big block that we as an organization are going behind is a credit cost block. And we are doing lots of things to make sure that the credit cost trajectory becomes more predictable and more stabler in going forward, right? And it is not only in the microfinance business, but in all lines of business, we are doing a lot of work to make sure that the credit cost trajectory becomes more and more stable. As the credit cost trajectory becomes more and more stable, the ROA trajectory will also become more and more stable, and the volatility in ROA that you referred to will probably be a thing of the past as the credit cost trajectory becomes more stable. So obviously we are going through a little bit of a challenging macro phase right now, and I do hope that as things stabilize, the credit cost trajectory will come back to its normal sort of guided pathway of 2.8 to 3% as we have taken as per the Lakshya 2026 targets.
Right. And, you've utilized around 100 crores of macro provisions. Could you give us the rationale for that, and therefore how much of macro provisions are you now sitting on as a result of this utilization?
So overall, we had created a macro-prudential provision of about 975 crores during the COVID period out of operating profits. And we had told ourselves very clearly that this is specifically for the microfinance business and to be utilized during situations which are macro situations and which probably is not part of BAU business. So we've seen some of those macro situations play out during this year in the preceding 3 quarters, and so our board was satisfied that the condition precedents were met for utilization of some part of the macroprudential provisions. What we have given a guidance is that this quarter we have used 100 crores and we have released 100 crores of macroprudential provisions. And next quarter we have given a guidance that the macroprudential provision utilization will be between 300 to 350 crores. Obviously, our endeavor will be to see if we can use less. But the fact is that this is the ballpark range. So about 450 crores of macroprudential provisions will be used between this quarter and next quarter. So obviously, our overall provisions were about 975 crores. So,
all right. So that's Sudipta Roy of L&T Finance speaking about the numbers. The numbers have been less than exciting, but the stock is up nearly 2%. He's talking about pain points in the MFI microfinance segment. On the other hand, you have a Dixon Tech. Profit has more than doubled. Revenue has jumped 117%. Margins were flat, but you have the stock down nearly 10%. We're going to be speaking to the CFO shortly, but before that, let me go across to Mihika. Mihika, why is Dixon hurting this morning? What is the street seeing?
Yeah. So up first we have, brokerages that have trimmed the FY25 estimates. We have MOSL that has lowered its FY25 earnings estimates by 8%, Novama to the same degree. And, all the growth that we've been seeing is from the mobile segment, which is a significant revenue contributor, but their consumer electronic division has been facing weakness in terms of demand due to seasonality. We've seen revenues and operating profit contribution from the consumer electronics segment, which includes your LED TVs and refrigerators, dropped to 6% versus 17 to 19% a year ago. And this is a segment that is the second highest contributor to Dixon's revenues, and it's overall seen a 32% degrowth this quarter. And the street is also cautious on valuations. The stock is up 2.7 times in the past 1 year. Their current PE is at 262 times as per Bloomberg versus the 5-year average that averaged around 97 times. We've also seen an increase in debt. It's at 361 crores total debt in Q3 FY25 versus 155 crores at the end of FY24. The company's also announced a new JV in terms of a fabrication display setup. Now, while it does, it's a wait and watch from the PLI subsidies for the government, there is, the street may not be taking this very positively because it could hold up a lot of their working capital in. And lastly, while their mobile this segment has been seeing strong growth. It's seen higher revenue contribution. The street has been saying that they could have an impact on margins because of rising competition from the Tata Group.
Factors there, Mihika. Thank you for that setup. Saurabh Gupta joining us now, Chief Financial Officer at Dixon Technology. Saurabh, very good morning to you. And we were just trying to figure out what the street is seeing in your numbers, because in the face of it, it's been a fantastic quarter. A beat on estimates on most earning drivers. Margins, yes, is flat. So let's start with the fabrication foray and the $3 billion that it will cost. How will you fund it? Let me start right there.
Yeah, good morning. I think so. Display fab is in line with the strategy for backward integration. You know that we have a big play in LED TVs, in mobile phones, and now going forward in IT hardware products. So the display fab will be basically used across all these three categories, and we have a large play, large volumes. So it is basically we plan to get into that, so create more strength and moat around these businesses. Yeah, so the total capex deployment, which will happen over a period of next 2.5 to 3 years, the total capex is around 2.7 to $3 billion, out of which we believe that as per the government guidelines, as per the ISM policy of the government, almost 70% will be funded both by the central and the state governments. So our outlay should be closer to $800-900 million, which will be done over a period of 3 years. And we also have a technology partner in place. Of course, those numbers will be worked out on clearly what is investments the partner would make, or so that is something that will be worked out over the next few months. But I feel that the company has strong internal accruals, strong earnings visibility. We still have a very low debt to equity in the company, so we can always manage to take some more debt. And also we also have an ESOP program running. So we also are expected to get a lot of ESOP proceeds over the next 2-3 years from our stakeholders, which is the employees. So I think so. I feel confident that large part of this or a significant part of this capex can be funded over a period of 2-3 years through all this mechanism.
So, Saurabh, no plans to raise funds through equity as far as this particular capital expenditure over the next 3 years is concerned, not through equity, not through debt, right?
Yeah, so I feel that not as of now. We don't see a reason. I feel confident that it can be funded from internal accruals, because a lot of our capex on the other verticals has been done, like on mobiles, other PLI committed capexes across other verticals. So now the large part of the capex out of the earnings will go towards this only. And I feel confident that since the gestation period of the project will be like 2.5-3 years, I think so we'll have that earnings also and to fund the capex, because that will happen gradually over that period.
Saurabh, the other factor I think is the mobile division. Of course, again, mobile and EMS division has seen a good year-on-year boost in terms of margins. The revenue split has seen also great growth. You have good growth coming in there. And then there's talk of maybe competition on the horizon. Could be the Tata Group, could be something else. How does competition pan out for you?
I think competition will always be there, but we have been able to get a large market share in the Android ecosystem. So pretty much all the brands which are there on Android ecosystem are our customers. And so if you look at, so all the brands, so Tatas have a play on the iOS ecosystem, the Apple ecosystem, where we are not present today. But pretty much all the brands which are there on the Android ecosystem are our customers. And Android definitely is a much larger market as compared to the Apple ecosystem market in India. Now, as part of a strategy, we are deeply investing into the components, backward integration, which is the display assembly, where we have already tied up with HKC. We're looking for partnerships on precision components, mechanicals, battery packs, so that will further add to our strength and create a moat in the business. And now the largest piece that we have now looking is to get into the display fab. So clearly, mobile is the largest trigger for our growth, and followed by telecom and IT hardware, which are also looking very promising.
Saurabh, I want you to come in on consumer electronics and appliances as well. You know, the revenue distribution from that particular segment has also come off as much as over 30% year on year. What could be the potential reasons here?
See, TV has been under a structural slowdown, I would say, because definitely the younger generation, they're not buying as much TVs as generally that was the case earlier. They're consuming more entertainment on mobiles, tablets, on the go. So clearly TV, not only in India, but globally, it's going through a structural slowdown. So what we are trying to do in TV is to get into other categories of industrial, automotive, industrial displays, automotive displays, signages, and so that is there. We're trying to do some more backward integration there. But clearly, we don't see much growth happening in TV business. As far as the home appliances business are concerned, there are two categories. One is the semi-automatic, where we are now already achieved a large market share, and we have now come back to a scenario where we are continue to achieve a single-digit kind of a growth. But our fully automatic top loader portfolio continues to have a large growth, more than 40-45% growth on a lower base, because continuously we are adding more customers there. And at some point of time, we are now looking at getting into more categories of robotic vacuum cleaners, chimneys, your hair dryers, some kitchen appliances, and also at some point of time, we may look into get into the front loading category as well. So clearly,
What is the timeline for that, Saurabh? Because what you're saying is a very true sort of cyclical point, right? The demand for TVs has come down, and you are transitioning to other products with those facilities, but what is the timeline you see for this kind of a transition?
So my sense is you will get to see those announcements in next 6 to 15 months, I would say. So we are already working on that. We already have working with some customers on that categories. So this piece, I'm absolutely sure about that the home appliances piece will continue to show a good growth along with the mobile, telecom and IT hardware piece.
Just want to get a sense on, the kind of growth you've seen in the mobile and EMS division and scorching pace in the last 1 year. Do you see this now tapering off? Is it hit its peak, close to its peak?
No, I think so. We will, we do a volume of almost 30 million smartphones. Last year, we were at 5.5, 6 million smartphones. So we have grown like almost 5 times this year. And I assure you that in next 2 years, we should be doing volumes of 6 to 6.5. 60 to 65 million, because we have a large order book from all our customers. Some of the customers are looking to do exports from India, and some of the partnerships that we have announced will also start reflecting in our numbers from H2 of next financial year. So clearly in 2 years time, we expect to double these numbers, and not only double these numbers, because of the backward integration strategy, we're also looking to expand our margins. So we think that by doing all those backward integration projects, we should be able to expand our margins by at least 100, 120 bips over the next 24 to 28 odd months.
Just one point on your margins as well. With this, I think one thing that stands out is you have defended margins, but having said that, with the scorching pace of growth, margins haven't moved at all. Do you see this range being maintained, Saurabh?
No, I see the margins now from here onwards getting expanded because of our play on the backward integration in mobile. So like the partnership with on display assembly with HKC should start getting reflected in the numbers from Q2 of next financial year. And similarly, we are pursuing aggressively partnerships on precision components, mechanicals. Now, all these backward integration projects that we are planning to do in mobiles will come at a double-digit margins for us. So presently, the mobile margins are hovering between 3.5, 3.3 to 3.5%. So once they start reflecting, the margin profile will continue to increase. See, what is happening at an overall level, the operating leverage benefit is kicking in. The designing benefits, wherever possible, are reflecting in better margins. But since a large part of the growth is coming in mobiles as of now, which is kind of pulling down the margins because it's a relatively low gross margin, low EBITDA margin business. But the things will start to change as we get into backward integration. So you will see that margin expansion happening in mobiles, which will have a positive impact on the overall company margins.
And when do you see that happening by, Saurabh?
So by Q2 of next financial year, you should start seeing those numbers.
Sorry.
Just wanted to reiterate that by Q2 of next financial year, you see an improvement of margins to what extent? What are you penciling in when you say that backward integration will boost?
Over 2 years, I expect 100 to 120 bips improvement. Okay. But from Q2, so by next financial year, yeah, it should be around 30 to 40 bips kind of an improvement, which is possible.
That's as clear as you can get. Yeah.
And Saurabh, but just to reconfirm from the last conversation that we had, was in fact when I was in your facility, you had suggested a 35% growth CAGR for revenues over the next few years. You maintain that?
Yeah, definitely. I think that should be doable. We should be, I think so, kind of order book that we have in mobiles.
Right.
From a large base this year, I think so we can grow by almost 50% next financial year.
Okay. All right, Saurabh, we'll leave it at that. Thank you so much for joining us and giving us all that clarity with respect to the business going forward. So among the key takeaways, one is that they're expected to do nearly 50% CAGR over in terms of revenues over the next few years. They are expecting an expansion in EBITDA margins, which should come into play on the back of backward integration in the second quarter of this upcoming financial year. And maybe in 2 years, they will likely see about 100 to 120 basis points improvement in your EBITDA margins. So these are the two factors which are playing in favor of the company. In terms of your fabrication unit as well, where they are expecting a $3 billion worth of investments to go in. They are not looking to raise any debt or equity at the moment. So at this point in time, it does seem like there is nothing wrong except valuations.
No,
now,
but my question would be,
yes,
valuations were a problem yesterday, day before yesterday, and a week before that as well.
Yes.
You've had a bumper set of numbers by all parameters.
Yeah.
And today, valuations comes into picture.
So oftentimes investors wait for the earnings that they want to see, and after that they decide, and then maybe they want to partially move out. We also have to remember that Dixon has not corrected as much as a lot of the other counters in the markets in the mid-cap space. We've seen a correction about well over 25-30%. Dixon, on the other hand, especially given the kind of valuations, it has not corrected that much. And I'm not suggesting that this correction is only because of valuations, but it is a large part of it.
Makes sense. I mean, he's saying, the CFO has just told us 30 to 40 basis point improvement in margins by Q2 of the next financial year.
Yeah.
No real competition coming in from the Tata Group getting into this segment because they work on iOS, these guys work on Android.
Right.
70% of their costs on the fabrication unit are going to be borne by the government. So I can't get a handle on what exactly has been the pain point, but we'll keep an eye on it. Very short break. We're coming back with all the top buzzing stocks.
I present the budget for a historic
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Welcome back to India Market Open. We're actually talking about how many of us actually use televisions at this point in time. I know you're watching us on one, but
hopefully.
Yes.
No, but listen, you can watch us on YouTube, you can watch us on your phone. As long as you watch us, we don't care where.
Right. Well, in any case, let's get the conversation on renewables up, because that's clearly one of the sectors which is in focus, even as we see Donald Trump come back, and make several proclaimments. The question is how many of these will actually come through. But we do have Mihika joining us to give us an update on how the sector's panned out for now and how the valuations come through, especially after given the kind of correction that we've seen of late. Mika, over to you.
Yeah. So let me just give you a kind of backstory. At the start of FY25, renewable stocks were trading at high valuations, and these valuations was due to a strong rally over the past 2 years, and the rally was on order wins, robust execution, a strong financial performance, and overall euphoria surrounding the theme. But now we've seen a steep correction in the past 1 to 3 months. If you could just get the chart of how stocks have corrected in the past 3 months, you have a range from 7% all the way to 37%. These are your renewable power and developers, from a Tata Power to a Torrent Power, JSW Energy, SJVN LLC, Adani Green, NHPC. All of these counters have corrected. But now that's where the valuation picture comes. There are now stocks that are trading below their 5-year historical average, and this is your EV to EBITDA ratio that we've taken into consideration. You have an NLC, India, Adani Green, and SJVN. All these 3 counters are trading below the 5-year historical average valuations. There are also some stocks in the renewable energy developing space that are trading close to the historical valuations, such as a Tata Power, a JSW Energy, NTPC, and NHPC. A few, metrics here and there, but they're very close to their 5-year average. And as per Elara Securities Vice President and Senior Analyst for Power, there are some counters where the risk reward now seems favorable. That's a JSW Energy, a Tata Power, a CESC, an SJVN, and NHPC, as well as an NLC India. Even in the wind turbine manufacturing space, you have seen Inox Wind and Suzlon Energy see a downtick of 23 to 30% in the last 3 months. For Inox Wind, their 12-month forward EV to EBITDA does still stand higher than the historical average at 38.5x. But for Suzlon Energy, it stands lower than the historical average, and currently it trades at an EV to EBITDA forward ratio of 34 times. And lastly, we have the solar module manufacturers. Recently listed Warrior Energies, Prem Energies, listed with strong gains, had seen a very good up move in the first few days of listing, but stocks have corrected 11 to 18% in the past month, and Kotak is optimistic on the industry demand but bearish on the stocks due to high valuations. And lastly, post the corrections, as per Bloomberg consensus target ratings, there are some companies with the highest upside potential. Up first, we have Adani Green, as per the 12-month target price, and 84% upside potential. Inox Wind at 49%, NTPC at 36%, Suzlon Energy at 33.6%, Tata Power at 21%, NHPC and JSW at 21% as well. Obviously, we still have to watch out for how the Q3 numbers play out, but this is the picture post the correction.
Renewables to charge up. I mean, now that America is not interested in renewables, what's the picture in India? Because Trump is saying drill, baby, drill. But Suntec Realty. All right, let's get some details on a stock that's really performing well. Suntec Realty has reported a consolidated net profit of 42.5 odd crores. Stock is up 8% this morning after the Q3 numbers. There were 40% growth in sales bookings. In the latest quarter, there's been bullish housing demand as well. Anushi, what's working with the numbers for Suntec?
Right, Tamanda. So we are looking at a bumper set of numbers as far as Suntec Realty is concerned. We are looking at a 4x, almost a 4x jumps in their revenues at 162 crore. This is against 42.4 crore last year. So we are looking at higher revenue recognition this quarter on the completion of some of the projects. Do note that Suntec Realty follows project completion method instead of percentage completion method. The EBITDA stands at 48 crore versus a loss of 15 crore. And with this, their margins stand at 29.9%, which is last year couldn't be accounted because of the EBITDA loss which took place, and net profit at 43 crore. If you look at what is working out for Suntec Realty is its key operational metrics. We've seen a pre-sales growth of 40% on a YOY basis. in the third quarter, they have sustained a similar growth trajectory in the previous quarters as well. So pre-sales up over 48%. Collections, however, were in a mixed picture this quarter. They were down about 23%. So commentary on on collections is something we should continue to focus on for the upcoming quarters as well. But on a QoQ basis and a sequential basis, we are looking at a 53% of an improvement. What is working out for us? The company has now identified 9 growth engines to expedite their pre-sales numbers by FY25 to 26. In fact, if you look at the project pipeline, the GDV stands at about 38,000 crores. So this is a significant jump up from where the current levels are concerned, and that is why a very strong outlook going forward for the business in FY25 and 26 on the back of the project completions and the new launches that are there. So Sunteck Realty in focus on basis of that.
Okay, all right. Kalyan Jewellers also in focus this morning. That we're looking at. The stock has, been all over the place. Today trading lower, and this is something that, Samit, you had mentioned this morning. This is promoters pledging an additional 3.6 crore shares. Yesterday, what an up and down for Kalyan Jewellers. Yesterday, Kalyan saw a big upside. Today, getting hammered once again, Samit.
BSE disclosure shows that the promoters of Kalyan Jewellers have pledged additional 3.6 crore shares with lenders. Now, do remember that earlier promoter had pledged close to around 12.5 crore shares, and given the sharp fall in the share prices that we have seen of late, we believe that the promoters might have been asked by lenders to provide additional security, and hence this additional pledge of around 3.6 crore shares has been done by the promoters with their existing lenders. Now, as of December 2024, around 12.5 crore shares were pledged by the promoters, and post this, the total number of shares that stand pledged currently with of Kalyan Jewellers promoters stands at close to 16.1 crore, which is nearly 15.6% equity and nearly 25% of the stake that promoter owns in Kalyan Jewellers, which means that nearly 1/4 of their ownership has been now pledged with lenders. Now, from its peak of around 800 rupees, we have seen a sharp fall in the share price of Kalyan Jewellers, down by nearly 37%. The stock had briefly touched below 500 rupees, which is the lowest level that we have seen since July 2024. Now, this fall in the share prices that we had seen was largely around concerns which had come up related to corporate governance issues of Kalyan Jewellers. However, nothing has come in so far. In fact, management also had conducted one investor call to clarify on this issue, but despite that, we have continuously seen a fall in the share prices. However, the analyst community continue to remain bullish on Kalyan Jewellers. The consensus target price, as shown on the Bloomberg terminal, stands at close to 763 rupees, which shows a return potential or a potential upside of more than 40%. Yes, the share prices were up yesterday, but it seemed like one kind of a relief rally that had come on in Kalyan Jewellers. But again, today the share prices are down around 2.5% in trade, and this is after the latest disclosure, which shows additional pledged shares by the promoters.
All right, Samit, thank you so much for joining us and giving us that update. And now we know why Kalyan is also dropping and just continues to show more and more weakness. And every time there's a little bit of resurgence in the stock, over the past 2 weeks, we've seen just further weakness coming through. Let's move on and talk about Mankind Pharma then, because we do have Macquarie Research was initiated an underperform rating on the company. We have Varsha joining us to tell us what this report entails. Varsha, over to you.
Thank you, Agam. Let's see why Macquarie has given underperform rating to the company. Now, the concerns stem from weaker domestic performance, challenges in the BSV acquisition that they did recently, and slowing down the exports. The domestic formulations make up almost 65% of the revenue, have shown slower growth due to weaker acute therapies demand, and H1 FY25 domestic business grew by 10%, but Q3 is expected to remain weak with just 5% year-on-year growth when it comes to domestic demand. The revenue growth forecast for domestic formulation is revised down to 10% versus 11% from 24 to 27 on a CAGR basis. The acquisition of Bharat Serum and Vaccine adds to the top line growth, but is expected to dilute bottom line growth. So this is one of the concerns that the company is facing. Despite management's optimism, sales data suggests that slower growth has seen in when it comes to Bharat, that is BSV products. products. Margin expansion for BSV faces hurdles due to lower gross margin and differing sales channels, and also there have been concerns when it comes to exports. So exports have shown significant growth in the past few years, that is from FY20 to 24, driving overall revenue. But however, export appears to be plateauing, with Q3 FY25 exports at $32 million compared to $39 million in Q2 FY25. All in summary, Mankind Pharma faces challenges when it comes to weaker domestic growth, then difficulties in integration of BSV acquisition, and of course the plateauing growth of exports.
Thank you for that, Varsha. So a downgrade on Mankind Pharma by Macquarie. But let's get our talking point speaker on for the day. Sanjeev Prasad joining in, MD and co-head Kotak Institutional Equity. Sanjeev, great to have you on the show today, and what a good day to hear from you. So much going on. I'm sure Trump has kept you mentally busy since this morning as well. But then you have the whole host of numbers and results as well, apart from the budget. So let's start with your view on where you think Indian markets are going and what's the next big trigger point that we're looking for.
Well, something looks like the market is going to be fairly range bound. And when I say the market, I'm talking about large cap indices. It looks like there is, I guess, a fight going on between the FPIs on the one side, who seem to be fairly cautious in the market, looking at the kind of FPI selling we have seen since October, which continues into January also. And the DIs who seem to be fairly bullish, who have been continuously buying. But that's only for the large caps. The mid cap and small cap, some of the narrative names, we continue to be fairly cautious. Valuations are extremely high over there. And I would assume over time, as and when the fundamentals start to assert themselves on these names, you could see a fairly steep correction in some of the stocks in the mid cap, small cap, and what I call the narrative space. So just to give you some further context, if you look at the valuation of the broader market, it's not very cheap. Most of the large cap names in consumer outsourcing investment names on the higher side. If you compare the valuations with, let's say, the pre-pandemic levels, in most cases, valuations are definitely higher. And more important, valuation higher at a time when you're seeing cyclical slowdown in most part of the economy, barring the investment part. And also a lot of structural challenges which have started to emerge in many sectors, disruption risk, and so on and so forth. So I don't know whether the argument for higher multiples really hold in that case. And if you look at the mid-cap, small-cap narrative names, I just struggle to relate their valuation with the fundamentals of many of the stocks which have correlated sharply over the last 1.5 to 2 years. I think there could be a lot more correction over there.
Okay, so a couple of things that I want to sort of follow up on, Sanjeev. One is that you said DIIs are buying in good quantity, and that's true. Still not able to sort of negate the quantum of selling from foreign investors. Are you saying that DIIs are largely looking at large caps? Are you largely looking at large caps and avoiding the broader space? And if it's large caps that is interesting you, what within it?
Been buying. If you look at the last, the month of January, more than $5 billion purchases. Time when FPIs have sold almost $4 billion. Now, of course, the DIs are getting a lot of money from the retail investors who continue to pour money into domestic equity mutual funds. If you look at the month of December alone, you saw about roughly 420 billion rupees of money going into domestic equity mutual fund, and that's been a trend. And last year, you had somewhere about almost 4 trillion rupees of equity flows into equity mutual funds. So I guess the DIs have no option but to deploy the money. In a way, they become forced buyers in the market. They're getting inflows. What option do they have but to deploy? And you have retail investors who seem to be pretty price agnostic for now. I guess based on their experience with the last 3-4 years, which has been pretty good. We have seen pretty decent returns in the market for the last 3-4 years. Barring the last 6-9 months, we have seen significant correction in the parts of the market. Even though the broad indices haven't come down that much, many stocks and and sectors have come up pretty sharply. So I don't know whether that is sufficient to change the mood of the retail investors, but for now they continue to be, I guess, still optimistic in the market, looking at the amount of money they are putting into domestic equity mutual funds, and on the back of that, the DIs continue to buy.
Sanjeev, I was looking at the Nifty 500 stocks, and among them, well over 350 odd numbers have corrected by as much as 25-30% from their tops. A lot of them have, of course, corrected even more. But, considering you are still suggesting that even this point in time, broader markets in general still look expensive. What are those areas which potentially still have some headway to correct from here on in the broader markets? Or are they, or is this a little bit more stock specific in this case?
Say beyond the financial space, pretty much everything is looking on the higher side. I mean, you look at the multiples of any of the large cap consumption names. So, in general, they are similar or higher to the pre-pandemic levels. A very simple fact is that before the pandemic, let's say 517, 18, 19, the volume growth of these companies was much higher. The profitability of these companies was, pretty decent. Now you roll forward to currently, you have pretty, tepid volume growth for most parts of the consumption space. Low single digits, most of the staple names, and in fact, a decline in the paint volumes, etc. And more importantly, if you look at the structural issues which are emerging across the consumption space, and you're starting to see more competition within every category of the broader consumption space. Earlier the market used to be fairly concentrated around 2-3 players in most categories. Now you have more players in every category. You're seeing competition coming from private label brands. You're seeing competition coming from D2C brands, and so on and so forth. So in the context of the fact that, the incremental volumes would probably get split across more number of players now, and the profitability, which has in general been on the higher side, should logically come down given more competition. I just struggle to understand how we are giving higher multiples for the same sectors or stocks. And this is pretty much across the board. Everywhere we are seeing the same issues, on the broader consumption side. If you look at the IT space, there's a lot of excitement around recovery into FY 2026, some dollar protection and so on and so forth. But again, the multiples, if we compare with the pre-pandemic levels on the higher side, the challenge is before the pandemic, most of the IT names were growing much faster, barring a few names in the tier 2, tier 3 category. And there also we are starting to see a lot more headwinds going forward. So that is where we are, it's just a struggle to find value in the market given where valuations are relative to fundamentals.
Sanjeev, in that case, could talk about the concerns around growth as well. In terms of earnings, from your expectations right now, do you think that the earnings for FY26 are lower as compared to what you were perhaps penciling in about 6 to 9 months ago?
Yeah, as of now, we have about 16% growth for the Nifty 50 index. It's come down a little bit, but I think over time this could get cut a little bit more given the challenges we are seeing in growth for some of the sectors, namely the entire consumption basket. And I suspect profitability in autos, cement, etc. could be on the lower side. So let's see, how it evolves. As of now, looks like the analyst community has been cutting FY 2025 numbers, but sort of keeping FY 2025 numbers intact on the back of expected recovery in volumes and sustenance of profitability. That remains to be seen. If you look at a broader coverage universe, which we cover about 280 stocks, that's about 18% growth. So it's not as if we are stingy on earnings growth. My worry is I think we are probably a bit on the higher side, and you could see earnings downgrade during the course of the year if you don't see any significant recovery in the consumption part of the economy, which has been on the weaker side.
Sanjeev, in the broader markets then, are there areas in which if you do see about 10 to 20% further correction from here on, then you wouldn't mind, start placing bets in some of these names. Based on that, what are the themes that you are watching out for at the moment where you've already seen a good amount of correction, and well, even if when you suggest that your valuations are not conducive just yet, they could get with a little bit more of a correction?
Yeah, I don't know whether little correction would put you into buying zone for the market. If you think 10-20% correction for the market as a whole, I would assume you would probably see more significant correction in some parts of the market. So maybe that is where some opportunities would come up. If you look at where we are positive on as of now, most of the financial names, at least on a valuation basis, look pretty attractive on paper. Of course, there are some worries about the asset quality of the banks NBFCs, and particularly the MFI based small finance banks or the MFI loan book of the banks. So that is where the market is grappling currently with the financial space, the banks and NBFC, the lending businesses. Whether whatever we are seeing in terms of the MFI loan book challenge, is that the worst of it, or this problem could spiral into other parts of the loan book. So I think the results would be very critical in terms of either giving you some comfort on the asset quality, or making things worse. So far it's been a mixed bag. One or two banks have reported some weakening on asset quality. Some of the banks have reported fairly stable asset quality. So let's see as some of the larger banks, HDFC Bank, ICICI Bank, SBI, etc., report later on, whether we get a more a better sense on how the asset quality issue is panning out, and that seems to be front, center, left. As far as the analysts and
just Sanjeev, further on that point about results, and you've spoken about banks, and yes, asset quality has become a big issue. If I were to ask you what you're making on IT and some of the other key results that came in today and yesterday, we were speaking about Dixon, Zomato. I know you'd want to not go stock specific, but stocks, companies that have huge potential have run up massively. Now, after the numbers, valuations becomes the big question.
The issue over here is, the companies are sort of failing to meet the very elevated expectations of the market. So that's where the challenge is. The multiples have become very elevated, for the names you mentioned, Zomato, etc. And they've all been priced to perfection. And each disappointment, the stocks are now getting hammered quite significantly. And we have seen this trend starting from the September quarter. The market is no longer forgiving of earning misses that it used to be, let's say, a few quarters back, when bad news used to get ignored and positive news used to get rewarded significantly. I think we have moved to a situation where the market is becoming a lot more rational, more focused on fundamentals, more focused on earnings. Still rewarding good news, but punishing bad news quite significantly. And as I was saying, the analyst community, I guess, has its own compulsions given the fact that stock prices run up, so they have to justify the stock prices somehow. So they have all pulled their, looks like to me, the assumptions over here, whether it is volume, profitability, utilization, etc. So the scope for earning, any sort of disappointment is very, very limited now. And I would think companies will struggle to meet the limited expectations of the analyst community. So that is where we are.
Thank you so much, Sanjeev, for speaking with us. That was a great conversation with Sanjeev Prasad. Meanwhile, look at what's happening to the markets. Nifty below the 23,200 mark, quite a sharp fall from the day's high. And broader markets hurting even more. The mid-cap feeling the pain. We'll have to take a very short break. But up next is Ask Profit, where we answer all of your questions. Stay tuned.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest...
Hi, good morning. Thanks so much for tuning in. This is Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani, and we'll take you through the next 1 hour of trade. It's been a bit of a confusing start, if you can call it that, to trade. And in fact, there's a lot to bake in because overnight you had the inauguration of the Trump presidency. We've spent quite a bit of time this morning talking about the implications, and we've fallen off quite a bit for the benchmark Nifty 50. We are trading with cuts of about 0.8% right now and at the low point of the day. Let's also take a look at the broader markets and see where they are right now. And the mid cap index also trading with cuts of about 1.5%. The small cap index also trading with cuts of 1.5%. And so as a result of which you've seen quite a breakdown in terms of the texture of the market. Let's take a look at the advanced decline ratio because that will drive home the point that we're making right now. And you've seen a complete divergence and a change in the texture that you saw at the start of trade. Towards the end, of course, of yesterday's session, in yesterday's trade, you saw 2 gainers for every loser. It's pretty much the opposite right now. In fact, worse off at this juncture for the texture right now. But let's take a look at the sectoral performers and see where things are moving. All sectors are currently in the red, apart from healthcare, which is just holding out in the green. But the ones that are worst performing, you have realty as a pack that is doing not too well right now. Consumption is a pack that is losing ground, whereas the banking index had gained 1% and 1.6% or thereabouts in trade yesterday. It is losing about 1% right now. So all under pressure, and quite a few stocks are losing ground on the back of earnings. A few that stood out to me, of course, are in the realty pack. You have Oberoi Realty that really got beaten down. And funnily enough, the numbers actually looked reasonably good. The one thing that stood out to the street, of course, was the pre-sales numbers, which have been a bit of a disappointment. So if you hold some of these real estate stocks, perhaps you've got questions about them. Suntec Realty, the one exception to the rule. What else stood out to you, Mahima?
I think Suntec Realty is worth marking. I mean, we were not expecting the street to take it this positively, but the stock is up around 7%. But Dixon Tech is one of those counters which is taking a lot of beating in trade today on the back of its earnings. Earnings were decent, but I think what is not working is the JV for new fabrication business that they have announced. And this is
$3 billion
on the back of, this is going to block working capital, which is why we're seeing negativity on the stock. Zomato is seeing almost 6%. It's almost 10% now. It's not even 6%. It's at its days lows, and this is on the back of course, the results. The management has said the losses will continue going forward for the next 2 quarters. On the back of this, even Swiggy is taking that kind of hit. We're seeing Swiggy also down around 9%. Oh my God, this Swiggy is also down 9.5%. But something that's in green. Let's talk, about some stocks that are in green and adding some positivity to the markets. AGI Green Pack Q3 earnings revenue was up 7%, but net profit was up 34%, which is why the stock is it was doing well in the start of the trade, but that has also cooled off now. Suntec, like we discussed, let's also pull up L&T Finance earnings. The total income was up 14.6%. Net profit, however, was down. Let's pull up the stock. There you go. It's up around 1.3%. So, Alex, these are some of the earnings that have, kind of stood out. But markets are seeing pressure overall today.
Yeah, no doubt. In fact, let's get our experts in for the day. We've got Swati Hodkar, who's AVP Technical Research at Nirmal Bang, as well as Asa Jain, who's Senior Research Analyst at HEM Securities. First, I'll go to you, Swati, on what you're seeing in the markets right now. Quite a dramatic shift in the texture we saw at the start. We were expecting some bit of positivity. At the most, we were expecting consolidation, but we've seen a breakdown. What are the key factors that are leading to this right now?
First of all, good morning, all of you. Definitely, yesterday, whatever the rally we have seen that has been cooled off, the strength is not there into the market. If we look towards the advanced decline ratio, today almost -3 ratio is going on. The two important major factor is the volatility index. India VIX is continuously hitting on the higher side, and the second major concern is the dollar index. These are the two majorly reasons which are taking down the market on the low side. The FI's figure are continuously coming on the selling side. So these are the major concern into the market. As of now, on the technical front, I believe 23,000 can be tested very soon on the Nifty. If it's break down that level, then 22,800, 22,700 can be seen on the Nifty. Positive trend will be convert once the Nifty manages to give the crossover or the breakout of 23,440 levels, which is the gap resistance level which has been created in the last month. Unless and until Nifty trades below that level, the view will remain a bearish to cautious only. But definitely, I will suggest, Alex, that it's a stock specific market. Yesterday, we have seen a very strong momentum into the some mid caps counters. Those were up by 10-15%. So it's we have seen the sectorial rotation in such kind of a volatile market. So better to concentrate on the stock specific investments rather than emphasizing on the Nifty or the bank Nifty trades. The market will continue to remain on a volatile till our budget comes out. So the sentiments will get developed as per the expectations of the budget comes into the markets. So the overall view is little bit cautious. Try to more concentrate on the stock specific trading. That will be the major tip we can give it into the market as such.
All right, so stock-specific markets, it is. That's the view coming in from Swati. The first question for the day is on Dixon Technology. Shankar from Bengaluru wants to know as to what is the outlook for the company going forward fundamentally. Astha, very good morning to you. If you had the time to check Dixon results, how are you reading them? And especially with respect to the fabrication business that they're entering into.
Hi, good morning to everyone out there. So yes, talking about the numbers were not bad. I mean, the numbers they have posted were more or less in line with the expectations. But now what we are seeing that markets are not ready to, accept the fact that if any stock which has already shown a strong rally before the numbers, those stock prices are now not move in the tandem with the northward direction. This is what we are seeing. So I think that is the case with the Dixon also, because we have already seen a sharp run up before their numbers. So now it is correcting a lot. Now talking about their fabrication business, which they are entering into, I think that will be a good business, and definitely that will be a margin accretive, but not in the immediate term, maybe 1 or 2 years down the line. Definitely that margins accretiveness we can see in the financial performance. So it is a good long-term story to bet upon, but yes, in the short term, I think because markets are in not good mood and Dixon has already seen pre-result rally, so that's why we are seeing some sort of downside momentum in the stock prices.
I forgot to mention this at the start. The numbers that you're seeing on your screen, that's where you can reach out to us. The number at the bottom of the screen is the landline number, and you can call us on that number. We'd love to speak to you. If anything, today is the day when you should be calling, because some of the stocks that you've invested in probably are seeing a bit of a battering, and you might want to know what to do with them. Should you hold on? Should you exit? And the number, of course, on the top of the screen is where you can send us your messages. A lot of you have already sent in your messages, and we'll continue to take those questions. NMDC is the name of the counter we're taking next, and Mohit is writing in from Ludhiana. He's got 1,500 shares, and he's got an average price of 45.37 rupees. So he's making a decent profit. His time horizon is 2 years. Asa, I'll come back to you because it's a long enough time horizon. What are the prospects on the fundamentals?
So I think after coming of the Trump, definitely metal prices can see some sort of a positive momentum. And if that will be the case, definitely the hike in the steel prices will definitely go well with this company. So all these things are just future projections, but I think this company is well poised to cater any opportunities which can be present in the metal prices. So right now our stake is just hold the counter with the initial price target of around 75 to 80 range. But I think because of the market mood, this price target can take some time to reach.
All right, that's the view coming in on NMDC. Moving on to the next query. Tata Tech is the counter. Lalita Kumar wants to know, with respect to the kind of loss she's making. She's purchased 200 shares, bought at 1232 a piece. So she's sitting on a loss of around 81,000 rupees, and she wants to know what should be the next course of action for her. She's not mentioned the time period of holding, but Swati, Tata Tech, how does it look on charts right now?
Tata Tech is really a good counter on the fundamental side. But technically, we have seen a very strong sell-off after the listing, profit booking we have seen. But at the current level, the stock is trading in an oversold zone, and the momentum indicator such as RS is showing a positive crossover from that levels. So downside is very limited. I will suggest the investors to at least buy some more quantity at the current market price so that your average price will come down. From here onwards, the risk is very limited, and upside is open up to at least 940 to 960 levels. So more 100, 150 points up more rally we can see once the market stabilized and just see some positive momentum into this particular counter. So I will suggest to hold on for a long-term period. If possible, try to average it out at the current market price. Upside, at least for a 6 to 3 months, I'm looking for a target of 940 to 960 levels. So it's hold from my end.
And do bear in mind that the results announcement for the quarter ended December will be out today on Tata Technologies, and we'll bring you updates as and when we get them. Of course, you'll be able to read the latest updates even post-market hours. I'm not sure if this company, generally post-market hours, I would think, I'm not sure.
Yeah, generally these IT companies.
Yeah, but if it is post-market hours, you'll be able to catch the flash on the screen, or you can check out the website ndtvprofit.com. We've got our first caller for the day. We've got Raju Singh calling us from Mumbai. Raju, good morning, and thanks so much for calling us. How can we help you today?
Very good morning. My question was in regards to the Reliance industry.
Okay.
I wanted to understand what are the long-term prospects for Reliance industry. One should keep, I mean, I've purchased 500 units at 1250 and one should keep it, hold it, or purchase it or sell it. I mean, long-term prospects for this.
Raju, help me with when you purchased these stocks?
Around 10-15 days back.
Okay, so you bought it at a lower level. And what was the thinking when you got into it? You got it on the basis of fundamentals you intend to hold for the long term?
Yeah, my intent is to hold for long term, and I purchased it because I heard there are the listing. I mean, there is a few companies are going to get demerged in this, like Jio and the other companies.
Retail.
So, yeah.
Retail
so,
and Jio.
Retail and Jio. So one thing was that, and they are investing very heavily in energy sector also, green energy also.
Understood.
So can you let me know more about this?
Yes, definitely. Asa, I'll come to you on the fundamentals. A lot of people buying into Reliance Industries, not just over the last 10 days as Raju has done. And it's not too far away from 52-week lows, Reliance Industries. It's been a rank underperformer since August last year. And if anything, it's proven to be a drag on the Nifty 50 as well, right? What would you say about the fundamentals, though? The results were better than expected to a certain extent. But would you hold out on this demerger pop that one would expect, the value unlocking that a lot of investors are seeking?
Yes, and one more thing about the result which I really want to discuss here or bring in the focus is that we have seen in the various segments. First of all, the telecom segment, the hike in the prices, that is the ARPUs, we can really see that, and that will be going to positively impact the earnings in the coming quarters. Secondly, refining segment. So there also what we are seeing that they have seen last 2 quarters of, tough last 2 quarters, and they were challenging. But now in the refining segment also, we believe that this segment will going to show strong or a decent performance in the coming quarters. So, thirdly, I think in fact the retail segment is also will be on the better side. So I mean, all in all, the various segment in which the company is working into, all these segments have seen some sort of in the past muted performance, but now they are set to show strong performance. And in fact, this demerger story will always benefit, and that can be the cherry over the cake. So I think all in all, this is a good long-term story to bet upon, but we cannot ignore the market condition at this point of a time. Just purely on the market condition, the stock is not able to perform. So let it fall more, but if the time horizon is more than 6 to 8 months, definitely this stock will definitely yield strong results on the upper side, because we are believing coming quarters will be a stronger one.
Buy even at these levels, and what is the potential upside according to you?
Not buying at these levels, because what we can see that markets are in not good shape. And in fact, my technical counterpart will agree that if 23,000, which is the major support, if market break that level, then 22,800 are the next level. So if these will be the case, then definitely the Reliance will be showing us some sort of muted performance. So buying on dips is advisable, which is at around 1180 to 1200 zone.
And we're just about 190 points away from that 23,000 mark. We've held so far. We've got a question on HPCL. Refiners have been under pressure. Reliance Industries actually outperforming in the results, performing better in its O2C business than was anticipated. Revenue still declined, by the way. HPCL has been bought by Anu. She's got 100 shares that she's bought at 335, I believe. And she's looking for whether or not to hold or exit. Swati, on the charts, what's the view?
Alex, Definitely, one should hold the long positions because the buying price is at a lower level and the stock has just formed a very cluster support at around 350 and so levels and showing us some sort of a bounce back rally. In this kind of a market also, it's holding a very strong support of a 350 levels. I believe that this bounce back rally can be extended up to at least 390 to 400 levels. So I will suggest to hold on this particular counter for a target of 400 and please keep a stop loss of a profit stop loss of a 350 on a downside and hold your long positions for 400 rupees target.
All right, that's the view coming in on HPCL. Moving on to the next caller, Prasad from Hyderabad is calling in. Prasad, a very good morning to you. How can we help you?
Yeah, good morning. My name is Prasad. Actually, I'm holding the Bajaj Housing Finance.
Okay.
Holding the stocks 1,111 shares. The price at 135.26.
Okay.
So just I want to know that what is the future of this stock and can I hold or sell this stock?
Okay, when did you buy this, Prasad? Was it after the IPO?
Yes, after the IPO.
Okay.
At price at 135.26. Currently it is running 24K loss around.
Right, understood. And what was the thinking behind buying Bajaj Housing Finance? Okay.
Nothing.
Yeah. Go ahead.
Yeah. I'm believing that like the rate cuts and the housing finance will grow. We thought around that. Initially.
Got it, Prasad. Asa, I'll come to you. Bajaj Housing Finance is the counter. What's the view?
So we recommend hold on this counter for Bajaj Housing Finance because in the longer term, I think the company will be able to show strong numbers. And in fact, what we have seen a good jump from the listing price, which we are seeing right now on the screen, that is from the 70 rupees, it has jumped to 113. So at that time also, it was valued at a price to book multiple of more than 3, I suppose. So now, due to the high valuation, the stock is correcting a little bit along with the market mood and sentiment. But in the longer term, we believe that the stock will definitely show some upside momentum. Remain invested in this counter with the price target at the initial level at around 130 to 135.
So that's the view coming in on Bajaj Housing Finance. Hold is the view. Two questions, one from Anwar, who's from Calicut, and one is from Girish. Both have questions on Zomato. Girish has bought it at the levels of 63 and he's holding around 5,750 shares. So he is sitting on a profit of 8.6 lakhs right now. Anwar on the other side has bought 3,700 shares and bought it at 170. So he is also sitting on a profit of roughly 1.56 lakhs. Both of them want to know from a longer term perspective what should be the next course of action. Should they hold more or add at current levels? Asa, I'll come to you first and then let's also take a technical view as to how charts are looking. Asa, your view on Q3 numbers as well as the long term outlook on Zomato.
So the food delivery segment was not able to perform and the numbers were not up to the mark in that segment. Plus the competitive intensity which the company is talking about, I think definitely is now troubling the company, especially if I talk about the financial performance. So I think it will take another 1 or 2 quarters more for the company to set down in the or to settle down in the financial performance. So right now I'm not advising to add to this counter. Let this counter fall more because the numbers were not up to the mark. And I think even before the results also we have seen some sort of upside momentum in the stock prices. So I think by all these factors, definitely it tend to fall more. So maybe at around 200 or 180, 190 odd level, it can be attractive buy. So I will not advise to buy at these levels.
Not too far away from that mark. While we're at it, I believe there's Shiva as well that's asked about Swiggy. Why don't we round that up and say between the two of them, both of them are seeing a knock-in trade today. Asta, would you at all buy Swiggy right now?
No, in fact, if the competitive intensity was the major factor, which was, not keeping the company's financial performance in up to the mark position. So I really need to see how it will be going to behave for Swiggy as well. So not buying right now, maybe a safer strategy I am recommending. So better to wait for some more time, let the results come in and then make entry into this counter.
Right. Swati, quickly, Swiggy and Zomato both on charts.
Zomato has already given a very strong rally from 2023 levels, non-stop from 50 to almost 300. So the profit booking cannot be denied. If you look towards the fundamental reasons, also definitely the correction is likely to be seen into the market. The second client who has the long positions at around 170 levels, he can hold the long positions by maintaining a profit stop loss of a 170. If it's break that level on the lower end, then more selling pressure is likely to be intensified in this particular counters. I will not suggest to book the profits at the current market price because the counter has already shown a fall of almost 20-25% in this month itself, and it's trading in the oversold zone. So the downfall is limited as long as it stays above 170 levels. So maintain the profit stop loss of a 170 and carry your long positions for a target. Again, if we get a bounce back rally towards to 260 to 270 level. So it's a hold from my end.
All right. So that's the view on Zomato. Let's get the next caller in. We've got Adi calling us from Hyderabad and asking about State Bank of India. Adi, morning.
Hi, good morning.
Please go ahead.
So I have SBI shares at a price of 764, 100 shares. I want to ask if I can hold them for long term for more than a year or shift it to some other bank like Bank of Maharashtra.
Oh, just want to confirm, 764, not 783, right?
Yeah, 764. Right.
764. All right. So we've got the price wrong. But that's more or less where the current market price is. Did you buy it recently?
Yeah, I bought it I averaged it. I bought few at 790 and then I averaged it at 733. I bought few at 733 and then.
Okay. And also, Adi, help me with the rationale as to why you bought State Bank of India?
I thought SBI has good fundamentals and everybody was suggesting that it would do better in long term. So.
Got it. Okay, fair enough. Asa, would you hold on to this? State Bank of India, of course, the largest lender. We haven't yet seen the numbers. We haven't seen the asset quality. We've seen a few banks posting higher slippages than were expected. Is that a concern at all, and would you hold on?
So if I see the past performance, especially in the Q2 of FY25, the bank has shown some sort of improvement in the slippages, and on that back, we have seen the improvement in their GNPA and NNPA ratios. So I think that should not be the case for the bank, because now in the past also they have shown improvement in these slippages. Secondly, I think the bank will be able to grow the loan growth at a CAGR of around 15%. So I think the bank will be able to maintain its growth story regarding the credit loan. Apart from that, we believe that they will be able to sustain their NIMs. So all in all, we believe that this bank will show good financial performance. While speaking this, I'm keeping my fingers crossed, but I think it will perform strongly on the financial front, and hence I'm recommending a hold on this counter with a price target of 820 at the initial levels.
820 at the initial levels on State Bank of India. We'll know soon enough when the results come through. Ladies, we have to slip into a very quick break. Do stay with us. And viewers, we'll be back on the other side to take more of your questions, so stay tuned.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit. Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company.
Welcome back. You're watching Ask Profit, a show where we get all your stock related queries answered, whether they're fundamental or technical. For viewers who are just tuning in, you can ask all your stock related queries on the numbers that will be flashing on your screen. You can either call us or WhatsApp us. Moving on to the next caller, Govardhana from Hyderabad is calling in. Govardhana, very good morning to you. How can we help you? Hi Govardhana, I can hear you. Go ahead. Okay, I think we've lost him, but let's take a WhatsApp call instead. WhatsApp query instead. We've got Pradeep from Vijayawada who has a question on Trent, and he wants to know whether what will be the correct levels to enter Trent. So Adi, I'll come to you on this one. He's not mentioned the time horizon, but do you think these levels are the attractive levels to make an entry for Trent?
No, not at all. The correction has just started almost from the current market price. I believe more downfall can be seen into this particular counter, which might take a stocks towards to at least 5,500 to 5,400. That much downfall we might likely to witness in particular counter. So not to create a long positions at the current market price. Definitely, if you're getting any dips towards 250, 400, 300, at that point of time, we can just review the stocks once again, and accordingly, we can give a buy call. But at the current level, my view is little bit cautious not to take any long positions at the current market price.
All right, no long positions on trend is the view coming in from Swati. Moving on to the next caller, Shairja from Hyderabad is calling in. Shairja, a very good morning to you. How can we help you?
Yeah, good morning. Thank you for the call, taking my call. I hold 30 shares of DAM Capital at 388.
Okay.
So I just want to know whether I can accumulate more at this dip, that is at 325.
Okay.
It's current running. So I want to know, can I accumulate at this dip, or else I have to wait for some more downfall and then I have to accumulate.
All right. So
and I want to know some fundamentals regarding this.
Got it, got it. But you want to accumulate them and not, kind of book losses right now. Is that correct?
Yes, yes.
All
I can wait for 6 months to 1 year.
Okay. Asa, 1 year is the time horizon that Shailja has. She wants to know whether she should accumulate more of DAM capital right now.
So it is one of the fastest growing merchant banks if we talk about the revenue terms in FY24. Now talking about this counter, I think when the issue came at around 283 price, it was at around the price to earning multiple of 23x. Although we have seen a good jump from there, but I think the kind of market momentum right now is going on. This stock can show some sort of more, downside. So rather than accumulating at this point of a time, let the stock fall maybe till the level of 305 to 310. So I think at those levels, maybe it is a good entry point. And one more thing I would like to highlight, that please wait for the results as well, because right now what we are seeing, that markets are really reacting very strongly on the basis of numbers, whether positive or negative. So in this kind of market conditions, I think it's better to wait for some more time and then make entry into this counter.
Okay, all right. The next question we're taking is on Indian hotels, and Kanti Bhai is messaged us asking about this particular counter. He'd also asked about State Bank of India, which we've gotten a view on. Indian hotels, incidentally, reported numbers. The stock has been under pressure all of this week, and if I look at the performance in January, it's been quite torrid, down about 12%. What is the outlook on the stock? Since he's not specified the fundamental or technical, let me get a view on the technicals from Swati. Swati, 12% in January itself. Where does the base form, and where, according to you, is a good point to start accumulating?
Yeah, Alex, my view is cautious on this particular counter, because why I'm saying that, because we have already seen a very good amount of a rally in last year, and as of now the weekly chart indicates a negative divergence on the RSI front, which gives some sort of a cautious sign. So profit booking cannot be denied at the current levels. More selling pressure can be intensified once stocks gives the breakdown of a 750 is the immediate support level, but I believe the stock will fall more than that, and which might take a support at around 720. So up to 720 levels, we might find a support nearby that level, and then the stock will enter into some consolidation phase, and thereafter we can see some reversal in this particular counter. So at the current levels, my view is little bit cautious to bearish, not to create major long positions at the current market price, or not to average it out also. If you're getting any dips towards to 720, 730 level at that point of time, the risk reward ratio will be a favorable, and we are likely to witness some sort of a consolidation, then reversal can be seen into this particular stock. So not to create any long positions at the current market price, avoid this particular counter at the CMP.
Okay. Nilesh Dumani, who's calling us from Mumbai right now. Nilesh, I believe your question is on Hinduja Global. Good morning.
Good morning. I have 67 shares of Hinduja Global. I bought it at 1121.
Okay.
For more than a year. So I don't know what I should do. I've been incurring losses for a very long time. So should I book the losses, or should I hold it?
And when you bought it, did you buy it on the basis of the fundamentals, or was it the price action that attracted you, Nilesh?
I bought it on the basis of fundamentals and because of Hinduja and IT services, BPO services.
Understood. So, okay. So let me take your question to Asta then on the fundamentals, because Asta, from my perspective, really, it's a question of the shifting sands in the IT space, right? Because you're talking about BPO businesses that are moving out of India, perhaps into other from their perspective, more cost-effective regions. And you're talking about the IT services industry itself that is in a state of flux. They are moving on to things that are developing as we speak. So from that perspective, Hinduja Global is bearing the brunt of that, one might assume. If you bought at elevated levels, do you continue to hold or do you find other alternatives in the IT space?
So the problem with the counter is that, first of all, the Q2 numbers were not up to the mark, because what we have seen in the Q2 numbers, if I extract basically other income and extraordinary items, the bottom line was not very, very strong. So I think if the numbers were not in the line, definitely markets always punish, and that too in this kind of environment. And yes, we all know that it is into the digital transformation, etc., BPO services. But what I believe, it's better to exit from this counter. I know it's a big call because right now the cost price is very high, or one can just wait for the numbers to come in. And after the numbers, just take a call, because Q2 was not at all very encouraging, and we are even not expecting Q3 to be that great.
So that's the view coming in on Hinduja Global. Moving on to the next query, Satya from Chennai is holding 5,500 shares of Ujjivan Small Finance Bank at an average price of 38 rupees. He wants to hold them for the next 6 to 9 months time frame, and he wants to know as to what is the short-term view with respect to this particular counter on the chart. Swati, I'll come to you. He's sitting on a loss of 19,000 right now. What should be the next course of action?
Not to worry at the current market price, because monthly chart witnessing that the stock is taking a very strong support of a golden ratio, which is a 61.8% of the retracements, whatever the rally we have seen in the past. Now it has formed a very good support at around 32 level. So as long as it sustains that level on the closing basis and trades above that level, I believe the momentum rally can be continued towards at least 42 to 45 levels. So it's a hold from my end at the current market price. Try to maintain the strict stop loss of a 32, and if the stocks comes at around 45 and odd levels, just keep trailing on your stop loss on the higher side. So at the current market price, it's a hold from my end with the strict stop loss.
Hold is the view coming in on Ujjivan Small Finance Bank. Moving on to the next caller, Ravi from Vijayawada is calling in. Ravi, a very good morning to you. I believe your question is on Titagarh.
Yeah, good morning, ma'am. Actually, I'm thinking to invest in Titagarh.
Okay.
Is this right, or Texmaco is better fundamentally for long term?
Okay. All right, your question is crystal clear. Astha, I'll come to you. Titagarh or Texmaco, which counter would you enter into? And, with respect to the railway sector, since the budget is round the corner, any expectations that you have?
Yes, first of all, I'm positive on both the counters, but if I have to pick one, then Texmaco Rail will be a preferred choice. With respect to budget, we are expecting the budget to be a good one for especially the railway sector, and that is why what we are seeing in the stock price momentum also, that most of the railway counter, barring today's movement, they have started showing some sort of positivity on the technical charts as well. So yes, from the budget perspective, we are liking railway counters, and among all the stock, Texmaco Rail is our favorite choice. And in fact, Titagarh Rail is also looking good. But if I have to choose between these two, definitely Texmaco Rail.
All right, Texmaco Rail between the two, Titagarh or Texmaco, is the view coming in from Astha. The next query that we have is Sridhar. His query is on Canada Bank. He's bought at levels of 106, and he's bought 140 shares. So he's sitting on a loss of around 900 odd rupees, and he wants to know whether he should hold them or sell them at this particular loss. So Swati, Canada Bank on the charts?
Yeah, on the charts as of now, it's the view is cautious, but definitely one cannot book the losses at the current market price, because this counter is very moving slowly and steadily on the high side. We are not witnessing a major sell-off at the current market price, so you can hold on. Downside, it has a very good support at around 97 rupees provided by its 20 days moving average. So as long as it holds that level, a positive momentum can be continued, which may take a counter towards 210 or so levels. So it's a hold from my end with a strict stop loss of a 97 rupees on the downside.
Okay. Naman from Kolkata has got a question for us. It's on Shriram Finance, I believe. Naman, please go ahead.
Good morning, first of all.
Good morning, Naman. Good morning.
I was just asking regarding Shriram Finance that the stock has currently made a split of around 5:1 as on 10th of January 2025. And I was just asking, is it the right time to park fresh money in Shriram Finance as the results are coming on 24th of January, this 24th? Or shall I wait till after the results I should make a buy, or after the budget?
Okay.
Or shall I wait till March?
Okay.
So the markets within Feb and March remain high volatile.
Yes,
why
that's
I'm
a
asking.
fair point, Naman. And it's a fair question to ask. Asta, what's the view specifically on this counter, Shriram Finance?
So I think wait for some more time. Although I mean this, if I talk about this company, they have got the stable asset quality if I compare it to their other counterparts. So I think there we have a cushion. Secondly, they have completed the sale of Warburg Pinners. So I think that will also help the company in posting, good numbers in the coming quarters. Thirdly, what I believe about this company is that now they are diversifying their loan book. Previously, I think it was more focused towards CV, but now they are diversifying it. So I think if I look after all these prospects, this is a good counter or a good NBFC to deploy the funds in. But my only concern is that markets are not in good shape. So let's wait for some more downfall to come. I think we'll get some better stock prices on the downside to enter into. So right now, just wait and watch. Maybe 480 to 490 odd levels are the good levels to enter into this counter.
Okay. Lavish has sent this message, and I'm guessing a few of you will also think like this, and I hope that I can change your mind. Lavish is saying that he posted a question at 10:40, but we've not taken it, and he's waited for half an hour. Unfortunately, Lavish, it's not possible to take all of the questions. We do try, and let's take your question nonetheless. Vishal Megamart bought at levels of 110, and he's got 500 shares. He's looking for a 6-month target. The stock is currently trading very close to that mark at 108 or thereabouts. Asta, this is specifically for you. What would you do with this?
Yes, so for Vishal Megawatt, I would really like to wait, because what we believe that this counter has a potential to move till the level of 120. I'm just restricting my price target to those levels, looking after the market conditions. Don't want to give big hopes, but I think this counter has got a very strong potential. The kind of presence they hold, especially in the north side of India, I think it's worth saying. So Vishal Megamart is looking good to us, good same-store sales growth story, and in fact, even we have seen a good rise from the IPO price or the issue price as well. The only concern is that market mood and conditions which we all are seeing right now. So maybe some downfall can be expected, but I think there is no need to worry. Continue to invest in this counter with a price target of 120 at the initial levels.
Okay, interesting. That's an interesting view coming in on Vishal Megamart, especially when retail is doing better in the tier 2 and tier 3 cities. Moving on to the next caller, Dheeraj from Hyderabad is calling in. Dheeraj, a very good morning to you. Tata Motors is the counter. What do you want to know?
Yes, good morning to you as well. So I'm holding Tata Motors, 415 of them at 784. So I want to know whether I can add more at the current levels. I'm actually looking at a short-term target of 820.
Okay.
So whether I should continue to hold or should I sell on rise?
Okay. Can you define short-term for me? 3 months, 6 months?
I'm looking at, a period of 3 months.
A period of 3 months. So, Ati, 3 months, Tata Motor, 820 is possible?
Definitely, 820 will be possible within the span of 3 months if the market shows some sort of a positive rally. And not to create a major long positions at the current market price, whatever the position you have it, hold on. Initial target will be 820. That is the cluster resistance level. The stock is facing at the current market. If it surpasses that level, we can get a non-stop rally towards to 880 level. So that will be my extreme targets on the higher side. If you want to add the fresh long positions, wait for a time being. If we see some sort of a correction nearby to 750 to 740 levels, at that level you can definitely add on. So at the current market price, it's a hold from my end. Initial target 820 and beyond that 880 levels can be seen.
Got it. All right. Shivakumar is calling us from Chennai. Shivakumar, thanks so much for calling us. I believe your question is on HUL.
Yes, sir. Good morning.
Good morning. Please go ahead.
Good morning, Alex. I had bought 50 units of, or rather, I'm holding 50 units of HUL. Bought sometime between 2020 and October 2021. So it's been more than 4 years. I had bought it at 2322 as the average price. And it's just not, I mean, I think it went up to around 3,000 levels and then it has now come down to 2,342 today's current rate.
Yeah. So it's not returned anything.
Some more time, I mean, it's been now 4 years.
Yeah, I can understand that. Let me take your question to Asta. Shivakumar has been a patient investor. He's done all the right things. Unfortunately, he's at where he started 4 years back on HUL. Would you say hold, Asta?
Since the company is driving the major part of its revenue from the rural areas. So I think that is major reason that we are not able to see that sort of performance because of some, the rural story is not working well in this company right now. So that is the major reason. This is what I believe. So you have to keep the patience and just wait in the stock, because I think in the long term, definitely, especially the H2 of this calendar year 25 is looking good to us. So that will really aid the company in showing very good numbers, especially from the rural side. Hold this counter with a price target of around initially 2450.
2450. All right. It's time to hit the rapid fire segment, and there are quite a few questions to take. This is, by the way, the time when we toss as many questions as possible at our experts and ask them to take questions in 2 minutes. The first question is RECPFC. These are two companies that have attractive valuations according to Subhashish. Would you buy right now? Asta, on the fundamentals.
Fundamentals are looking good for both these counters, but buy on dips is advisable, not at the present moment of time.
All right, Tanla Platforms is next counter. Anish wants to know whether he should keep holding at the current levels. He's bought at an average price of 1,200 shares. Your view, Swati?
My view is positive, currently showing a positive divergence. If possible, try to average it out at the current market price. You can keep a strict stop loss of a 660 and hold your long positions for immediate target of 820 levels.
Okay, we've got a viewer looking at Hindalco, and this is a question from Murli. He's looking at a futures trade, but I've told him you'll only give him technical levels to watch. Swati, on the charts?
The chart looks positive because from the last few trading sessions, it's trading in the pattern of the high tops, high bottoms. Upside, I am looking for a target of, initial target will be a 640, beyond that 680 levels can be seen. So downside, it has a very good support of 600. So hold your long positions for the mentioned target.
All right, Aptus Value Housing is the next counter, purchased at 362 a piece. Your outlook, Astha?
Aptus Value is looking right now weaker, numbers on the basis of number. I think hold is a strategy which can be recommended, not buying at the current level.
Varun Beverages, I believe. Let's pull up the chart and see where it's trading. We've got a question from Manu, who's writing in from Delhi. He's bought at levels of 610, looking to hold for 6 to 8 months. On the technical, Swati, what's the view?
My view is cautious. Probably we might see more downfall, which might take a counter towards to 520 to 510 levels. From after that levels, we can see some reversal. But at the current market price, my view is cautious, not to add major long positions. Just hold on for a time period of time. Upside, the initial target will be a 580 to 600. So it's all from my end.
Hold on Varun Beverages, and we managed to take quite a few questions. Thanks so much for joining us, Asta as well as Swati, and always a pleasure speaking with you. Now, we're running down the clock on the big event at the start of the year, which is the presentation of the union budget. What are the startups expecting from the finance minister? My colleague Sam Daniel has this report. Take a look.
Hello and a warm welcome to NDTV Profit Special Budget Coverage. Your budget, your voice. I'm Sam Daniel, and with me a group of articulate startup entrepreneurs and investors to give us their budget expectations. From my right, Padmini Janaki, Prasanna Vasanadu, Pooja Srinivasaraja, Ajmal and Divakar. Ladies and gentlemen, thank you for your time. Padmini, if I can begin with you. You are into healthcare. 3 years into your startup, what are your expectations?
The key expectations from the women health, not just on the women health, but also on the startup ecosystem is, how are we going to make it super easy for the companies or a common man to start a company when it comes to compliance, when it comes to even registering a company or having an access to the funding, having an access to the industry. Though on books, we have everything looked and, we say it starts in 5 days, you can start and register in 7 days. In practical, in reality, it's still very, very difficult for people who just want to start start. So with the budget, I look forward to make it even more easier. Like how about start a company in 24 hours when other countries are doing it? Why not India?
Prasanna, you're into e-commerce and you have your own challenges.
Again, taking from her point, I would say making the compliances and regulations optimized for e-commerce platforms, because now you see a boom in e-commerce companies, startups that has come up. And for us to serve our customers well, we need to be where the customers are. That is to be in multiple cities and states. And so, for example, if I have to go to different states, I have to do GST registration in every single state. I need to renew, and every single thing becomes very, very expensive, that too for a startup.
Pooja, you're into mental health and your key demand is expanding health insurance for mental health.
I think with the previous year budgets, there have been focus which has directed the startup ecosystem in the right direction. But I think focus on the healthcare budget is still very, very limited compared to other global standards. So that being said, but especially when it comes to mental health, right? People are more aware of it. People are more open to reaching out for support. So I think allocating some kind of budget where insurance can also cover mental health services would be of great help. And coming up with certain budget policies where government colleges can also come up with a lot of mental health care educations, even for Tier 2, Tier 3 cities, so that we could also come up with a lot of quality mental health professionals to support our public.
Ajmal, you have a macro level demand in terms of corporate versus personal taxes, or?
Sam, see, India is a mid-income economy, right? So the government collects direct taxes in two forms, your corporate tax and the individual tax. Now, see here, on an individual, you're taxed on the entire salary or the income, whereas in the corporate, you're taxed on the total profits after expenses and depreciation, right? And in the individual contribution is only 2%. So only 2% of the individuals are actually paying taxes. Despite this, the overall tax collection of individuals is higher than the corporate tax. And this is not a good sign for a growing economy like India. India, the government cannot be fueling their tax revenue through individual taxation. Coming to consumption, individuals pay GST on all the products that we consume, and there is no tax rebate, there's no refund. Whereas there is an input credit for corporates. Similarly, in 2019, there was a tax regime for the corporates where they say the corporate tax was reduced, leaving a 1.44 crore deficit in the tax revenues for the government. Whereas the last regime that was seen for the individuals was in the 2012-13 budget, which is over a decade. Right? So the government has to take measures to leave a lot more back with the common man so that he fuels consumption. This should be a consumption-driven economy, bottom-up consumption-driven economy, which is what fuels future growth.
So startup entrepreneurs and investors speaking out on their budget expectations. Hope the finance minister is listening. In Chennai with Suresh, Sam Daniel, Find TV.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
I present the budget for a historic.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? Hello and welcome to KYC, a brand new show at NDTV Profit. In this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is deep, comprehensive understanding of the companies that they invest in. And Know Your Company is a show designed to give regular investors powerful, actionable insights into fundamentals of single NSE listed company every day. And today we're talking about Canfin Homes. Well, Canfin Homes is one of those companies, well, it's an NBFC company which focuses on home loans. And what we eventually have at the moment is well, a borrowing mix in terms of construction, which stands at around 64%. It's followed by another 14%. As far as others are concerned, it also includes about 7% coming in from mortgages. Of course, it's South-based, NBFC, based on housing finance, and what we see is about 60% of its overall branches come in at in the south. It does have a significant standing in the north and the western regions as well. West comes in at around 16% and Worth Not comes in around 14%. I want to very quickly take you through the company's AUM as well, product-wise AUM. You'll see that for FY24, nearly 78% of its assets under management, came from housing, and housing CRE was another 10%. Along with that, L&M and top up, etc., all of them coming in through balance, but most of it, of course, was housing. Now, what we tend to usually do is we try to assess how the company has done in the previous few years in terms of various parameters. So we consider the income statement, the balance sheet. We also talk about several other factors which include the operational metrics, asset quality too, of course, and that becomes important considering it's an NBFC. And then, of course, we look beyond the financial statements and talk about shareholding, valuations, and what the street is looking at as far as the company is concerned, which would include street coverage and street credential. But, to take us through some of these aspects, we are also joined by Harsh, who's going to help us with at least some of these. So, Harsh, welcome to the show and good morning. Thanks, to you as well.
Good morning.
Let's start off with, your income statement. How has that panned out and what are the ratings we're giving it to it?
Yeah, so, Agam, just setting the context, it's around the AUM size is quite small, and hopefully this gives you a breather as well. I hope you're okay. But so the AUM size is roughly 35,000 crores. So it's a fairly small size, right, in terms of AUM. You have larger housing financiers, something like a Bajaj Housing, which is 1 lakh crore plus. You have LIC Housing. And of course, then you have HDFC Limited's book, erstwhile book, which is now part of HDFC Bank, which is the largest at this point. You also have SBI and some other banks which have now started taking sizable positions within the housing finance space. So not only is competition going up, but if you're on a low base, it's fairly easy to grow.
Yeah.
And therefore that number, 16.5% on top line, that's what's not looking very enthusiastic, just from an opportunity size perspective. So while it's a very healthy growth number, and I would ideally maybe have even possibly given it a thumbs up, but the only reason that held me back from giving it a thumbs up and give it a neutral, because the opportunity size is so large,
right?
And therefore you would want a smaller housing financier, sub maybe 30,000, just sub 40,000 crore, to grow at a faster clip. Right. But it's grown at 16%, and that's how it's shaped up over the last 3 years. You're looking at provisioning also largely muted, and that's a big positive in my opinion. And profit after tax therefore has gone up by 18.5% over the last 3 years. So a neutral rating only on the fact that you would want it to grow its top line slightly better than what it has actually done.
Right. Well, for a company this size, as Harsh was mentioning, we usually tend to see well over 20-25% growth in terms of your top line as well as your bottom line. But the company seems to be missing a bit just in this case, which is why we're going to go with a neutral rating here. As once again, Harsh has already mentioned. I'm going to talk about the balance sheet very quickly. And when it comes to the assets under management, as I was mentioning, the majority does come from housing. It has grown from 22,000, a little over 22,100 back in FY21 all the way through FY24. Currently stands at a little less than 35,000 crores. It's not a bad growth. We'll certainly give you that. But given the size and given the low base, it could have been much better. Of course, there are certain challenges when it comes to an NBFC, which is actually a public sector undertaking. And well, if you consider those challenges, sure, you could also, say that this is a reasonable growth rate. But if you do, compare it to several other players which are in the market at the same size, this kind of growth would potentially just give you a neutral rating, which is why we're also giving this a neutral one. But how are things looking when it comes to operational metrics, Harsh?
Yeah, so operational metrics looking decently healthy. So you're looking at yields at just a shade below 10%. Now, what really stands out here is that you're a pure housing finance player, right? And therefore, a large part of the book is housing and mortgage related, but you also have loan against property as a component of the book. But the component is very, very small as part of the AUM. And therefore, to maintain the yield of around 9.8%, a steady spread, and the kind of ROA that it's seen, a slight increase in the ROA trajectory, certainly augurs very well. Even your borrowing cost has actually gone up as a result of the fact that Can Bank has reduced its shareholding in Canfin Homes. And therefore, you're seeing a sharp rise there, likely due to that. But they've still been able to maintain their spreads. They've been able to balance it out well. They've been able to keep their margins decently well. And they've been able to, therefore, do well on the operational side of things, which is why we've given operational metrics. That metric, we've given it a thumbs up. Of course, again, very, very correlative to income statement. But nonetheless, we've given this one a thumbs up, largely borderline to positive on both of those metrics.
Okay, so I just want to make a correction here that I had mentioned that this is a PSU. It isn't, because it's actually held by Canara Bank. It is not held by the President of India, and hence it may be considered as not a PSU entity anymore. But I want to talk about a handful of other aspects as well, and we can perhaps talk about the asset quality metrics too. And in terms of your gross NPA ratios, we have certainly seen an improvement. There's no doubt about that, because we've back in FY 2021, the gross NPA ratio stood at around 0.91. It has gradually improved, and while FY23 and FY22 years were really good, there was a little bit of deterioration, yet as compared to FY21, it's a better ratio, currently standing at around 0.82. Similarly, when it comes to your net NPA ratios, again, it is an improvement if you consider how things have panned out from FY21 through FY24. But there were 2 years where, pardon me, things were considerably better at it, and that's the reason why we'll give this a thumbs up, because we have seen a gradual improvement, even with a little bit of volatility. FY24, of course, will be a year where there could have been some changes. But if there is anything else that you'd like to add in terms of your asset quality metrics, Harsh?
Yeah, it's just the low base, right, Agam?
Yeah.
So when you're looking at the last 3 years, the asset quality has bounced back and normalized off a very, very low base. So that's one. Second is that if you look at the last 5 to 6 years as well, your NPA ratios have been very, very healthy. They've been sub 1%. And therefore gives you that comfort that asset quality, despite everything that's happened with shareholding as well as with regard to the way in which the leadership changes, etc., have panned out, has sustained in that sense. And there's been no deterioration. There's not been any marked deterioration with regard to where asset quality is concerned. That's how I would look at it.
All right. Well, there you have it. So that's as far as your key financial statements are concerned. Let's move on and talk about shareholding now. And in terms of shareholding, when it comes to promoters, that is Canara Bank specifically, that continues to hold around 30%. Moving on, when you consider, institutions specifically, so you have mutual funds, you have, their shareholding stands at around 22%. Besides that, individuals also hold 19%, which is also quite curious. But then foreign corporate bodies and bodies corporate also have a fairly decent holding of Canara Bank. And which is why at this point in time, the reason why we want to give it a thumbs up is because the holding for this particular NBFC, that's Canfin Homes, pardon me, is fairly rounded and fairly diversified, which actually doesn't leave too much room for a lot of manipulation in this case, and which is why we're giving this a thumbs up. But we're coming then down to how the street is viewing this particular company. Harsh, let's talk about valuations.
Well, yeah. So let's talk about it actually. So let's pull up the valuation picture. There you go. You have Canfin Homes at 2.2 times price to book. You have PNB Housing at around 1.6. Of course, PNB Housing yet to turn a corner fully, so maybe that slightly discounted valuation may likely be fair. LIC Housing at one time, and Home First. Then you have those entire bunch of housing financiers, right? You have Aptus, Avas, Home First, all of them growing at a fairly healthy clip. All of them more efficient than some of the tier 2 ones like a Canfin, like a PNB, like an LIC. And all of them doing much better in that sense, even where valuations are concerned, because your ROAs are just a very different picture there. And even your margins are a different picture, and even your growth is a very different picture. So those three metrics take those valuations at 4.4. We're giving this a neutral because it looks like a fair valuation when you're looking at the top rung fast growing housing financiers versus the second from top, something like a Canfin, PNB, LIC. Largely this one looks well placed in terms of its valuations as a result of all of those metrics.
All right, let's move on, talk about street coverage then, and this is the final one which is on our radar with respect to the ratings. Well, we have about 14 analysts out of the 21 which have a coverage on Canfin Homes with a buy rating, and the consensus price target stands around 952, which entails about a 33% upside from current market levels. So all in all, the street is positive. It's bullish on Canfin Homes going in. And that's what we're keeping an eye on. In terms of street credentials too, we have, well, it's been lackluster, but it's been a tough year and tough couple of months for the entire broader markets space. So which is why we're not exactly looking at the best of returns. And while some might argue that it will be more or less in line with the kind of performance that we've seen in the mid-cap and the small-cap indices, maybe a little bit of an underperformance. Overall, that would potentially be something of a thumbs down. So along with that, let's bring all these factors together and talk about the kind of ratings that we have for the company. And based on the several factors that we did address, well, it's been a fairly neutral rating for income statement and balance sheet, operating metrics, and asset quality, on the other hand, looking at a thumbs up. Moving on, we also have an update from shareholding pattern, street coverage, and the valuation picture is neutral, but street credentials is where we're looking at a thumbs down too. And that actually brings us to a total score of around 5.5 out of 8. So not too bad, even though its growth rate could have been certainly better. So that's as far as Canfin Homes is concerned. But I'm going to stop right there, and I am going to, talk about, rather put the spotlight on, the management. In fact, Harsh spoke to the management of the company about the outlook going forward. Mr. Suresh S. Iyer, he's the MD and CEO. Listen in as to what he had to say.
We had guided that we'll be doing about 10,000 crore disbursement for the year. And in the second quarter, we did see a very positive pickup in terms of disbursements. Unfortunately, this e-Khata issue, which has come up in Karnataka, has hurt us in this quarter, because about approximately 400 crores of disbursement we have lost because of this in this quarter. This particular circular came around end of September. And the entire Q3, we've had the impact of this, where we used to do about, currently 30% of our business incremental comes from Karnataka. So we already have a very high reliance on the southern states for our business, which we have already highlighted that it's about 70% plus, and we would like to, in the next couple of years, bring it down to around 60%. So 60-40 is the kind of breakup we would like to have. So this quarter we've had this impact, because of which further the growth, which had inched up from 9 to 10%, has further again come down in Q3. Whereas we would have expected it to, with this 400 crores, this would probably have been about 11% plus in this quarter. And end of this year, we would have again been closer to 10,000 crores. But now looking to the issue that we have faced in Q3, this year, probably if Karnataka issue doesn't get resolved quickly, then we can expect somewhere in the range of 8,500 to 9,000 crore is where we will end up with. But we are sticking to the disbursement target of 12,000 crore for next year. And that will bring us about 15% AUM growth for next financial year. And going forward also, as you rightly said, we would be targeting 15 to 17% growth, because the market, the demand, the property market, they are all positive. The segment that we are also targeting is also quite steady in terms of momentum, in terms of demand. We also, as we have guided in the past, we have taken certain steps also in terms of branch expansion in the north, in the western states. That is giving us some positive results. Like, for example, last year we opened 14 branches. And we are now almost 14 branches have kind of closed about a year. And they've already started doing about 75 lakhs average business per month, close to 75 lakhs. So that's in line with the target of about 2 years to break even and do well. So they are already starting to contribute. Same way, this year we are targeting another 15 branches, all of them mostly in the north and the west. So this will, going forward, help us, achieve our target of 60-40 geographical breakup between the rest of India and southern states. The second thing the second thing we are also looking at is, having our own sales channel, because we have a high reliance on our DSA network. So while the DSAs will continue, but we are also setting up our own sales channel. That also is slowly improving, and month on month we started in June, and month on month we are seeing an improvement in the productivity of the sales staff also. So these are some of the positives. So we are quite confident that at least going forward, we should be targeting and looking at 15 to 17% growth. This year, of course, this third quarter, setback has affected, and we should probably look at around 10%, because if you do around 9,000 crore disbursement, 8,500 to 9,000, we will be in the 10%, closer to 10% kind of a AUM growth in FY25.
Right. You set it up very well, and a few questions on the back of some of the things you've said. So this change in distribution mix, does it somewhere factor in asset quality? How do you expect to ensure that processes will continue to be maintained? Your NPA ratios have always been good, but how do you maintain that when the distribution or the channel mix changes?
See, it's not that we are completely moving out into the newer geographies. Okay, we have had branches in Delhi, in Jaipur, in some of the western places, in Mumbai. So we have we are present actually in 21 states. So it's not that we are looking into new geographies where we don't understand the markets. It is just that we need to look at the periphery areas or the nearby locations where we can look at branches. We also need to look at strengthening the team, because we already have teams which are like having more than 10-15 years of experience with us in these markets. So what we need to do is we need to strengthen the team, and we need to look at expanding in the existing geographies. That's what we are looking at. So we do understand that compared to some of the southern markets, which traditionally also for housing companies have been very good in terms of credit quality, the north is and rest of the country is slightly weaker, but still in terms of our products, in terms of our policies, we have been very, conservative. We have 70% plus of our book. Even today, we have about 85% of our loans which are given to only for pure housing. We don't have much of LAP. We don't have any exposure to the developer segment. Second, we have more than 70% of exposure only to the salaried segment. So considering these kind of conservative policies and lending practices, I think, these are the ones which give us confidence that our credit quality or credit costs will not go up in spite of our expansion into these geographies.
So as you expand, do you plan to change that mix at all? Does it give you comfort to change that? LAP is obviously a slightly higher yielding segment as well, and therefore putting that question to you.
See, actually, we have, in fact, I've highlighted this in the past also. We have a vision document up to for 2028.
Yes.
So we do want to continue our focus on, salaried segment. Presently, it is about 73%. We would like to keep it 70-30. So the focus on salaried will continue. Presently, our non-housing, excluding our CRE, our pure housing is coming to around 75%. So we would be comfortable with, that also being not going below 65% in the next 3 to 5 years. So our focus will continue on pure housing. We will not look at expanding LAP too much. We have about 5%, which has slightly inched up to 6%. Probably it may not go beyond 8% even in the next 2 to 3 years. And so our focus will continue on pure housing and also in the salaried segment.
Okay. And so therefore, this 15 to 17% kind of growth guidance, one, how quickly do you get there? Do you get there in FY26? You've guided for 12,000 crore of disbursements in FY26. But does that get you to that number of 15 to 78% growth?
Yeah, if we are targeting 12,000 crore, with that 12,000 crore and considering the rundown that we are having of about 1,300 crores per quarter, which is about 5,000 crores, 5,200 crores per year, we should be able to have a net addition to our books of about 6,000 crore next year, which will get us to around 15%.
Understood. And thereafter, you can continue to sustain that. And what happens to your capital adequacy? Do you issue fresh equity anytime?
See, even at 15% growth, our ROE is around 17% plus. Right. So I don't think that will put pressure on our capital adequacy or on our requirement for capital. So it's only when we start growing at rates much higher than that we will have to look at bringing in capital. Presently, also we are quite comfortable. Our capital adequacy is 23% plus.
Okay, so your mix remains the same, and therefore your spreads as well as margins largely will remain in this kind of a range.
Yes, in fact, spread we are quite, we are kind of clear that we don't want to go below 2.5% spread. So that keeping that in mind, we will have to, and therefore whatever little we are pushing in terms of ticket size, where we may have to give an offer, attractive rates or competitive rates, that will be offset by a little bit of expansion in the self-employed or a little bit of expansion in the LAP book. So net, we would like to maintain our spread at 2.5% plus.
And that is all that we have for this edition of KYC, but lots more lined up on the other side. Stay tuned to NDTV Profit.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at
Hello and welcome back to NDTV Profit. You're watching Markets at 12 and this is Mihika Barve. Up first, let's just take a quick look at how markets are doing. Well, the Nifty 50 is in the green, not any significant gains. It's up 0.18% right now. In terms of the advance to decline ratio on the Nifty 50, you have 31 advances versus 19 declines, and in terms of the total markets, you do have declines surpassing 1,300 and around 96 declines versus 801 advances, but that's due to the broader markets. In terms of the Nifty 50, you do have strength in Ultratech. It's up over 3% in trade today, followed by an Apollo Hospital and BPCL seeing significant gains. In terms of what's dragging the Nifty 50, well, you have Trent under pressure, down about 3.5% right now, followed by an Adani Ports and an SBI. It's actually the broader markets that is, not doing well, and it is hurting. The Nifty mid cap down about 0.85%, the Nifty small cap 250 down about 1%. In terms of the Nifty small cap, something that's not doing well is an MCX on the back of its Q3 earnings, down about 8%. Tata Teleservices down about 6.5%, followed by Akane's Technologies and Amber Enterprises. A lot of these EMS names, not doing well in trade as well. Something that is doing, fairly well is a Suntech Realty, up about 5.8% in trade today, followed by Global Health, which is seeing gains of 4%. And lastly, if I were to talk about, your sectoral indices, in the green, we have the Nifty FMCG. It's up almost 1% in trade right now, followed by the Healthcare Index and the Nifty IT Pack. Something that's hurting is the Nifty Realty Pack, down about almost 2.5% right now. Something that's not doing well is an Oberoi Realty. It's seeing cuts of over 7% in trade today, followed by a Macrotech and a Phoenix Mills. You only have two companies, Suntech Realty and Godrej Properties in the green, and that also Godrej Properties is fairly flat with a positive bias. But like I said earlier, you do have your EMS stocks in focus, and something that is in focus today is Dixon Technologies. Now it's weird because you saw revenues, EBITDA and net profit almost double on a year-on-year basis. Margins remain flat, yet Dixon Technologies is heavily under pressure. So something that's not working or dragging the Dixon Technologies, brokerages have trimmed their FY25 estimates. You have MOSL and Nuvama, which have both lowered their FY25 estimates by around 8%. And it's the consumer electronics division that is facing weakness in demand on seasonality. You saw revenues get hurt this quarter. Their revenue and operating profit contribution to the total dropped to 6% versus 17 to 19% a year ago. And this segment is something that is the second highest contributor to revenues. And overall, we saw a 32% degrowth in revenues. Brokerages are also cautious on the stock's valuation. Stock is up to 2.7 times in the past 1 year, and their current price to earnings ratio does stand at 262 times versus the historical average of 97 times. Debt is also seen an uptick. It's increased to 361 crores in the third quarter versus 155 crores at the end of FY24. And something that has been announced is a joint venture for its new fabrication business foray. Well, the company is expecting 50% of this to be helped by getting support by the PLI scheme from the government. The street may be taking into consideration how this venture could block working capital going ahead, because it's for a sizable amount, and the competition from the Tata Group in terms of the mobile segment, which is what's been the revenue driver so far, could also have an impact on margins. But this is what the street is looking out for. But we also spoke to Dixon Technology CFO Saurabh Gupta on what impacted earnings in the quarter gone by. Do listen in.
I think so. Display Fab is in line with the strategy for backward integration. You know that we have a big play in LED TVs, in mobile phones, and now going forward in IT hardware products. So the Display Fab will be basically used across all these three categories, and we have a large play, large volumes. So it is basically, we plan to get into that, so create more strength and moat around these businesses. Yeah, so the total capex deployment, which will happen over a period of next 2.5 to 3 years, the total capex is around $2.7 to $3 billion. Out of which we believe that as per the government guidelines, as per the ISM policy of the government, almost 70% will be funded both by the central and the state governments. So our outlay should be closer to $800-900 million, which will be done over a period of 3 years. And we also have a technology partner in place. Of course, those numbers will be worked out on clearly what is the investments the partner would make, or so that is something that will be worked out over the next few months. But I feel that the company has strong internal accruals, strong earnings visibility. We still have a very low debt to equity in the company, so we can always manage to take some more debt. And also we also have an ESOP program running. So we also are expected to get a lot of ESOP proceeds over the next 2-3 years from our stakeholders, which is the employees. So I think so. I feel confident that large part of this or a significant part of this capex can be funded over a period of 2-3 years through all this mechanism.
Well, that was what Dixon Technologies management had to say about their earnings and what's going ahead. But you also have MCX in focus. It's under pressure heavily. It's down about 8%. But this, when you look at the Q3 numbers on overall revenue was up 5% to around 301 crores on a quarter-on-quarter basis. EBITDA has also seen an uptick to 7%. We've also seen almost 200 basis points in terms of your margins that have improved to 64.07% versus 62.83% just a quarter ago. And net profit has also seen an uptick of 4% at around 160 crores versus 154 crores. There is some pressure, but on the top, on a quarter-on-quarter basis, the MCX did have a good set of numbers in terms of, you have your MCX, you've seen an uptick in from a quarter-on-quarter basis as well as a year-on-year basis. So it'll be key to see what's dragging the stock down. We'll dive deep into that and get you that as well. But we do have Somit here, joining us in terms of what are the February expectations for the MSCI indexes.
Well, yes, multiple expectations that have come in when it comes to MSCI Feb 2024. Now, firstly, to start off with, we need to understand that this review will happen on Feb 12th, that is the announcement would come in, but to consider which stocks would actually get included or get excluded out of the MSCI index, the cutoff dates would be anywhere between Jan 28 to 31. Now, this will be completely dependent on MSCI, whichever date they want to consider, and the adjustments regarding this MSCI flows are expected to come in on Feb 2024. So, as per Motilal, there are no fresh inclusion that we'll see in the MSCI index, but two stocks that could move from the standard index to the small cap, from the small cap index to the standard index, and two stocks have a medium probability of getting included in the standard index from the small cap index. Now, firstly, it's Coforge and Paytm, which have a high probability of getting included or moving from the small cap index to the standard index, and because of this move, The inflows expected in Paytm and Co. is anywhere between 185 to 400 million US dollars, which is nearly 2 to 8 times the 20-day moving average. And two stocks that have a medium probability of getting moving from small cap index to the standard index are Coromandel International and Uno Minda. And if that happens, the inflows could be anywhere between 150 to 160 million US dollars in both these stocks, which is nearly 17 to 19 times that 20-day average volume. Now, apart from that, because of the QIP that Zomato had recently done, the weightage on the MSCI index is expected to move up by around 0.11 percentage points. And because of this higher weightage that would come in for Zomato, inflow of around 105 million US dollars is expected in that counter as well. But these adjustments will happen on Feb 28th, and the announcement regarding the MSCI changes is expected to come in on February 12th. But do remember, the cutoff date is anywhere between Jan 20th to 31, and MSCI on its own discretion will choose whichever date they want to decide which stocks get included or get excluded from the MSCI index.
Got it. Thank you so much for giving us all those key details. We now move on to Suntec Realty. It's up and about in trade today, and it's reported a consolidated net profit of 42.52 crore in the quarter 3 of FY25. They also reported a 40% growth in its sales, booking to around 635 crores during the latest December quarter. Now, driven by bullish housing demand, you have a lot of things working for the company, and we have Anushi breaking down the numbers for us.
We are looking at a bumper set of numbers as far as Suntec Realty is concerned. We are looking at a 4x, almost a 4x jumps in their revenues at 162 crore. This is against 42.4 crore last year. So we are looking at higher revenue recognition this quarter on the completion of some of the projects. Do note that Suntec Realty follows project completion method instead of percentage completion method. The EBITDA stands at 48 crore versus a loss of 15 crore. And with this, their margins stand at 29.9%, which is last year couldn't be accounted because of the EBITDA loss which took place, and net profit at 43 crore. If you look at what is working out for Suntec Realty is its key operational metrics. We've seen a pre-sales growth of 40% on a YOY basis. In the third quarter, they have sustained a similar growth trajectory in the previous quarters as well. So pre-sales up over 48%. Collections, however, were in a mixed picture this quarter. They were down about 23%. So commentary on on collections is something we should continue to focus on for the upcoming quarters as well. But on a QoQ basis and a sequential basis, we are looking at a 53% of an improvement. What is working out for us, the company has now identified 9 growth engines to expedite their pre-sales numbers by FY25 to 26. In fact, if you look at the project pipeline, the GDV stands at about 38,000 crores. So this is a significant jump up from where the current levels are concerned, and that is why a very strong outlook going forward for the business in FY25 and 26 on the back of the project completions and the new launches that are there. So Suntec Realty in focus on basis of that.
Thank you, Anushi, for giving us those key details. Up next, I want to talk about Mankind Pharma under pressure, down about 4%. Even in the past 1 month, it's corrected 13%. But today's, downtick is after Macquarie Research has initiated to underperform. It's downgraded the stock's rating and also cut the target price around 7%. We have Varsha bringing us more on the report. Varsha, what's driving the bearish outlook?
So, Amiga, underperformance by Macquarie has been on the basis of weaker domestic performance and challenges in the BSV acquisition that they did recently and slowing exports. Domestic formulations, which make 65% of their revenue, have shown slower growth due to weaker acute therapies demand, and H1 FY25 domestic business grew 10%, but Q3 is expected to be weaker with just 5% year-on-year growth. And the revenue growth for domestic formulation is revised down to 10% CAGR from 24 to 27 versus 11%, which was guided. The acquisition of Bharat Serum and Vaccine adds to the top line, but is expected to dilute bottom line growth. Despite management's optimism, sales data suggests that the slower growth for BSV products and the margin expansion for BSV faces hurdles due to lower gross margin and differing sales channels. Lastly, if you see the slowing exports growth, exports have seen significant growth in the past 2 to 3 years, driving overall revenue. However, export revenue appears to be plateauing, with Q3 FY25 exports at $32 million compared to $39 million in Q2 FY25.
Thank you, Varsha, for giving us all those key details. We now shift focus, and we're going to hear a view coming in from Bharat Forge's Amit Kalyani as well as McKinsey's Asia's Gautam Kumra on the impact of Trump 2.0 and what's ahead. And this is coming straight from the World Economic Forum at Davos.
he's talked about a lot of things that can be very positive for the global economy. The first thing is about getting the geopolitical issues under control. So he's talked about getting Ukraine-Russia resolved. He's talked about, getting the Israel issue under control. I think those two will be a big mood booster for the whole world and reduce a lot of stress in the overall system. I think especially the Russia-Ukraine war will then, the end of that will then normalize the economic situation for a lot of European countries which depend on Russian oil and gas. Secondly, the whole focus on rebuild America, putting infrastructure back in America, focusing on building high quality infrastructure, playing catch up on the hard physical infrastructure, whether it's airports, whether it's better roads, bridges, power. He's talked about bringing a lot of power back into the US because of AI needing huge amounts of power for the data storage. So all these are, infrastructure-led growth, which is going to have a compounding effect on the entire economy. And then when you talk about bringing manufacturing back, it plays very well with that, because if you're going to build infrastructure and you build it with made in America goods, it creates a very positive boost for the overall US economy. And when the US does well, the whole world does well. So that's one part of it. The second part of it is what you talked about of the tariffs. I think, we have to wait and watch, but there are going to be tariffs on multiple geographies. Obviously, we have to see what happens with China tariffs, what happens with us and others. But, we have plants in the US, we have plants in India where we produce, so we have to wait and watch. I'm actually very hopeful and, let's say, watching and waiting to see what happens in India, because we clearly need something that is going to give a boost to our economy. Our economy is not growing at the pace which we need it to grow at,
Right.
And clearly the manufacturing sector is not, because the demand levels are not there. So there is opportunity if you can encash moving of manufacturing either through China Plus One or Europe moving manufacturing in a very focused manner. Like I saw some of the states in India have made a very focused pitch. They have a very good pitch book. They know what the customer wants and they are able to pitch that to them. So it's kudos to them. And, if they're able to do that, I think it's going to be good for India, because at the end of the day, we need to create employment for 5, 6, 700,000 people per month, close to 1 million people per month. And, otherwise we're falling behind. So that's the two things that I think one needs to watch out for.
Okay, all my subsequent questions are follow-ups to this answer that you've given.
Okay.
So I'm going to try and write them out one by one. I just want to get the Trump thing out of the way.
Okay.
So because of that piece that you spoke about, that the US economy might do well because he wants it to do well, but there are tariffs as well. Is Amit Kalyani seeing the glass half full because of the business that comes in out of the US and you have direct and indirect exposure both? Or are you worried, Amit Kalyani, because of what tariffs could do to an exporting powerhouse like yours?
No, I think tariffs will also have to be managed by the US to prevent inflation. Okay?
Sure.
You can't have crazy tariffs because those will lead to massive inflation. So I'm hopeful that, with the kind of people that he has in his government and, him being a businessman first and foremost, he has the knowledge of how these things work. And yes, there may be tariffs, there will be tariffs, but I think they'll be measured and controlled. So I'm not overtly concerned because it affects everyone. It doesn't just affect us. So that's not so much of a concern.
Okay, the opportunity because of a buoyant US economy.
The opportunity of a buoyant American market is very great.
Okay, and you are looking forward to that. Okay. Two questions. One, the world somewhere around June or July 2024 was looking forward to a year of lower interest rates in the US and other countries following suit. Now, if tariffs come in and if it's mildly inflationary or reasonably inflationary, rates might not come down there. Can the Indian policy be divergent to the US Fed policy because of our idiosyncratic factors?
One of the most concerning factors right now is the amount of freebies being doled out by state governments. And quite frankly, I don't know how our states can afford that, especially in a low to medium growth scenario. And with that in place, I don't know how much room there will be to play with interest rates.
Okay.
So that is fairly concerning. But Indian interest rates for good companies are not too high. Yeah,
Okay.
they're not 6% or 5%, but they're 8.5%.
Okay. So you will tide through much better. Okay. That is part one. Part two is the very point that you spoke about in terms of growth. Now, the ever elusive private capex, with reason not coming for. Do you reckon in the near term or even the medium term, the government will have to do the heavy lifting, because private sector will not dole out capex just because it is expected to? There should be an opportunity to do
There
so.
has to be a stimulus. There has to be a reason to spend money. One of the concerns, again, that I have is that a lot of the PLI schemes that have been put out by the government are very well meaning.
Right.
But their impact will be seen 5 to 10 years from now. If you look at the semiconductor, the batteries, those impacts are not going to be seen in 1 year, 2 years, 3 years. I'm not saying we need PLI, but we need something that spurs demand and therefore creates the need to expand capacities.
No, it's certainly going to be an interesting year, and I think contrary to what everyone will tell you, no one quite knows how it's going to turn out.
Exactly.
I wish you think of it as, you got to think about principles, people, and policies. You see, I think we've heard a lot about its principles and firm beliefs. For example, we've heard tariff, certainly. We've heard you got to pay your dues. You heard that. You heard his posture on immigration. We've heard deregulation. And I think we've heard a lot about energy security and, frankly, the need to manage inflation. So I think there's generally enough buzz around those themes that I would say those principles are now known knowns. We've heard quite a bit about people. We've seen the appointments. I think many of them are getting ratified now, but we have a sense for people, and I think it's a combination of known and unknown. What I think is unknown is the policies. And what I mean by that is just take tariffs. It's easy to say that you're going to impose 60% on China and 10 to 25% on everyone else, but what categories of products, in what sequence, over what period of time, what pace, what intensity, none of that is clear.
Okay. So what does Trump 2.0 mean for, let's say, India, to your mind?
Look, I think, firstly, every country, and I think every company, I would argue, has to look at this from a wider lens. It's not just about trade and tariffs. I think first thing I'd say is just keep an open aperture. One has to study at least 4 or 5 different things. One is, for example, local industrial policies. Because, for example, what happens to IRA, CHIPS Act will also have big implications on opportunities in specific sectors. For example, what happens with trade agreements? What happens for example, export-import sanctions? If he goes very hard on export sanctions to China, that has implications for countries like India. So look, by and large, one has to wait and see how many of these things unfold. But look, the general big trend, certainly I think India has been certainly better positioned geopolitically than ever. So I would imagine that but I don't think the answer is as straightforward as just everything goes up and up.
Yeah.
I think there will be things to think through on immigration. There will be things to think through from a trade direct perspective and what does it mean for supply chains. And we have to see what the implications are for all of the other trading partners and therefore what it means for India. But if you ask me a net summary, I think there's probably more opportunity for value creation for Indian entrepreneurs.
And what is one question? What is what are clients really worried about more right now? Is it the uncertainty around what the US does? Is it adaptability to AI and whether AI can disrupt or complement business, or is it something else?
Look, I think these are all big themes. It's hard to say which one people more worry about. I think it's a function of who you are.
Okay.
If you're running
But largely.
Yeah, but I would say, look, the 3 evergreen issues, the 3 or 4 big mega issues are on every CEO's minds. Firstly, certainly geopolitics. If you're running a global organization, it's even a bigger deal. But no one is immune of it. Second is obviously AI. The rate of pace of adoption as the technology is moving very fast, but frankly, humans are becoming the bottleneck. So as a business, how do you reorient your business model? How do you take advantage of technology and how do you deliver value will be top of mind in 2025. Third, I think everything on energy transition. I know it's a different reset now, but it's still on the agenda. What does it mean for you from decarbonization or business building standpoint? I think that's going to remain important. And ultimately, I think it will be about leadership. Because, these times are complex. So how do you lead and navigate in these times is not a playbook that people have seen 20 years ago.
Okay. One final question, and that is on what is it that you heard thus far in the WEF or expect to hear on the WEF around what the balancing act that India is doing as geopolitically as a nation, and how that augurs for companies which are operating out of India and making for the world.
So look, my instinct is I think India is certainly, somebody used the word of strategic opportunism. I think strategic opportunism, I think you can see that we're not necessarily aligning oneself very squarely with one side or the other, but keeping our options open and being flexible. I think that is a path that India has pursued. Now, the question is, time will tell whether we can sustain that or we'll be forced to take more sides. That's always a difficult situation to be in. But I think if India can ride that fine balance, I think it will serve its interest well.
I present the budget for a historic.
Hey everyone, with Budget 2025 right around the corner, there's one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming Union Budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free, with progressive rates ranging from 5% to 30% for higher income tax brackets. As Budget 2025 nears, there are growing expectations for reforms aimed at easing tax compliance, particularly for NRIs, that is non-resident Indians. Here are the key suggestions highlighted by Deloitte. Firstly, simplifying the tedious process for property transactions involving NRIs. Currently, buyers must withhold tax at a higher rate, obtain a TAN and file ETDS returns. Introducing a challan-cum-statement system similar to residential transactions could streamline the process and reduce the burden on buyers. Second, enabling tax payments from overseas bank accounts. Presently, tax payments must be made through Indian banks, making it cumbersome for NRIs. Allowing payments from foreign accounts would enhance convenience. Third, improving e-verification by extending OTP options to foreign mobile numbers. This change would simplify tax filing for NRIs, reducing paperwork and eliminating the dependency on Indian mobile numbers. Lastly, facilitating tax refunds to overseas bank accounts. Refunds
Hello and welcome to NDTV Profit. A very good afternoon to all the viewers. You're watching Profit Buzzers. I'm Hiral Dadia and with me is Somit Sarkar. Somit, good afternoon. Clearly, a fall in terms of markets is what we are seeing. A crack coming in the last 10 to 15 minutes of trade, and it's absolutely interesting to see what's happening. We are below that 23,200 mark on Nifty 50, cuts of over 200 points right now. But if you see from the day's highs, you have Sensex, which has seen cuts of little over 1,100 points from the day's highest levels. If you see in terms of Nifty 50 as well, it's a 300-point cut coming in right now as we speak. Overall, let's just pull up Bank Nifty, 840 points is the kind of cuts that we are seeing from the day's highest levels. What's contributing? In fact, 23,111 is the low that we've hit in terms of the low on Nifty 50. The advanced decline ratio is absolutely in favor of the bears, with 35 declines versus 15 advances. And what's pulling us lower? Trent, Adani Ports, M&M, ICICI Bank, as well as the SBI Bank. These are the ones which are trading under pressure. In fact, ICICI Bank, Reliance Industries and HDFC Bank that are contributing the most. In fact, HDFC Bank will be reporting numbers tomorrow. So ahead of the earnings, the stock is trading under pressure. What's holding up? Apollo Hospitals is up in trade. Ultratech Cement is seeing gains of around 1.7%. PPCL also will be reporting numbers tomorrow. That stock is up around 1.7%. Tata Consumers as well as the HCL Tech, which are holding up. In fact, HUL is another company that will be reporting numbers tomorrow from the large cap. Let's just pull up HUL and see. That's holding on to gains as well, but 0.3% higher. Let's quickly pull up the sectoral indices and see where is the pressure coming in from in today's day of trade. There you go. Across, you're seeing a sea of red now. It's only FMCG which is holding on to gains of around 0.1%. But apart from that, real estate, the biggest loser, 3% downtick on that front. You have Bank Nifty and the PSU Bank Index, followed by Nifty Auto, Media and Infra, Oil and Gas that are trading under pressure. Let's pull up the broader markets, the mid cap and the small cap index, and see what's happening on that front, because interesting moves there. There you go. There is some bit of resilience, Somit, in terms of broader markets. You're seeing the mid cap 150, which is down 1.4%. And if you pull up the small cap 250 as well, 1.6%. But the cut from the day's highs is not as deep in terms of broader markets versus the large caps.
Well, yes, broader markets is showing some kind of resilience, as you were mentioning. But yes, FMCG is holding up. There is a defensives are playing out. But among defensives also, one stock that is down in trade, and that's Varun Beverages, despite the JP Morgan note that had come in trade where they had initiated an overweight rating. The stock is down around 2% in trade. And in the last 15 minutes, if you see, among the FNO stocks, it's largely Dixon Tech, Samvardhana Motherson, Nykaa, APL Apollo, which have led the fall in overall markets. Info Edge, Supreme Industries, all are down in trade that we are seeing currently.
Absolutely. In fact, to add to Somit's list, you have a Newgen, which is down almost 16 to 17%. Dixon, he already mentioned 13%. The cuts have deepened further. Zomato, 10%. And to mirror that, you have a Swiggy also, which is trading under pressure. So what's in store for a Swiggy is what we should be watching out for. Oberoi Realty post earnings and the brokerage notes, the stock is down 7 to 8%. MCX is also down around 7 to 8% on the back of earnings. On the gaining end, you have Medanta, which is up 6%. Avantel, a small player, but up 5%. Spandana is seeing some gains to the tune of around 5%, and a Century Ply, which is holding up to the tune of almost 5%. But clearly, it's a day where you're seeing a sea of red. How the second half of the trading session pans out is going to be interesting to watch out for from here on. And tomorrow you have HUL, BPCL, HDFC, 3 key earnings that will be reported as well. But let's quickly shift focus to the key themes for today. On number 1, realty companies, Zomato and Dixon Technologies. These are the names that we will be discussing on the back of an earnings impact.
Apart from that, we also have how will Trump 2.0 impact the sectors such as pharma and IT in trade. That is also something that we need to watch out for on the show.
And you have MSCI adjustments that will be taking place. Coforge, Paytm, Coromandel and Uno Minda that will be in focus.
Sugar stocks gain as government has lifted export ban on sugar for the year 2025. We need to watch out for how those stocks react in trade.
And what's happening with a Kalyan Jewellers? Motilal Oswal has gone ahead and dismissed the rumors with regards to the recent stock price crash goes. But why has the promoter pledged more? In fact, let's first move to the key theme that we're looking at in terms of earnings. Let's pick up the 2 real estate companies, Sunteck Realty as well as Oberoi Real Estate. Both of these are seeing divergent trends in terms of stock price performance. You still have a Sunteck Realty, which is holding up to the tune of around 2.5%. Oberoi Realty, which is down almost 8% in trade. In fact, Oberoi Realty, if I'm not mistaken, will be having its earnings call post-market as today. So that will be something we will be watching out for. But let me first head across to Anushi for her to break down both the numbers for us, Sunteck and Oberoi. Anushi, what has worked and what has not worked?
Hey Hiral, so firstly I'll start off with the good one first, which is Sunteck Realty in focus. Now they've reported a stellar set of Q3 numbers. If we see at the face of it, revenue saw about a 3.8x of a growth, EBITDA about 48 crore as compared to a loss of 15 crore, and margins stood at 30%. But do note that real estate companies follow percentage completion or project completion method. So now that we know that Sunteck follows a project completion method, so it is also an account of this that we are seeing a such spike in numbers. So it's a quarter-on-quarter phenomenon and depends on the project completions as we go forward on how they recognize the revenues, as to which we see the income statement numbers. What's important to notice is the kind of key operational metrics and how they've performed. If you look at the pre-sales number, that stood at about 635 crore, which represents a 40% of a growth. So this has worked out well for the company. Collections has seen a dip this quarter. So commentary on that would be something that we'll be watching out for. That was 23% down, but on a sequential basis, it's seen a 26% of an improvement. Now coming to the 9-month picture in terms of where the pre-sales and collections are concerned, we are looking at a 34% of a growth in terms of the 9-month pre-sales number, which is in line with the FY25 guidance of 30-35%. Net operating cash flow surplus is as a metric remains positive for the company, which stands at about 1,744 crore as compared to 1,432 crore in the second quarter. Now the total GDV, that's the gross development value, stands at 40,225 crore. We've seen a healthy pickup from FY24 levels of 26,645 crore, which is in line with the company's aim to take this number to 60,000 crore as we move forward in the upcoming years. This is on Sunteck Realty. overall a healthy set of picture that we are looking at, boosted by the kind of launches that they've made, and FY25-26 picture remains healthy with the GDP pipeline that the company anticipates to have. Now coming to Oberoi Realty, why it is under pressure? Now if you look at Oberoi Realty, they clocked in about a 144% of a growth in their pre-sales, but despite that they have missed the pre-sale estimates that were there for majority of the brokerages out there. This drop is mainly due to the velocity. The velocity has slowed down of ongoing projects. The key one being the 361 West over here, which has dipped to a four-quarter low this quarter. So on account of, what had compensated and led to this higher growth also, if we look at, is the Pokhran Road project in Thane that has led to the higher uptick in pre-sales value that we are looking at. But 361 West pre-sales estimates missed. On account of that is something which is the reason why the street is not taking it too kindly on what the result expectations are. Coming to the brokerage side of it, Axis Capital has a reduced rating on the stock and sees a 10% of a downtick. UBS maintains its neutral rating with a 11% of an uptick. Morgan Stanley equal weight rating with a 3% of an uptick, while Nomura is the one which continues to remain bullish with a 25% of an upside. In fact, they even mentioned that they do not read much into the velocity of the ongoing project slowdown in the third quarter, as they expect a better pickup, and this variation is something that we should not be reading too much into. So they expect a better pickup going forward in the other quarters. What we should be watching out for is the company's aggressive exploration of opportunities outside the MMR region. Now the focus is shifting towards the NCR side, so that's something that we need to focus on. There are upcoming project launches in Goregaon, Borivali and Thane. The timelines of these on when they'll be launched is something we should be tracking, and how the company, they had a last quarter, they had a substantial fundraise of the size of 6,000 crore. The proceeds are going to be used for land, for acquiring huge land parcels. So deploying those proceeds and the track of it is something we should be watching out for. So, and lastly, the con call today after market hours. So all these points that we've made on what we should be expecting is something that could be addressed in the con call today. So definitely focus would remain on Oberoi Realty.
Right. So thank you, Anushi, for getting us the details with regards to both the real estate firms. In fact, let me also welcome in Raghvendra Kedia, founder at Prosperity Advisors. Raghvendra, good afternoon and welcome to the show. Before I ask you with regards to what's happening with both these real estate counters, what are you picking up in terms of markets? The kind of reversal that we've seen right now from the day's highs, what is it that you're picking up?
Well, we believe that the overall seesaw movement in the market would continue, and it will be more specific to intraday movement, or let's say stretch to 3 days of good days, positive movement, and then 2 days of correction. So overall, on a week-on-week basis, market largely will be in a range bound, and we do believe that 2,300 on the downside for Nifty levels would be a strong support, and on the upside again 24,000. So it's a narrow range of around 5 to 6% where Nifty would be trading. But as you asked, what is the overall view? That we are heading for a time correction in the market, and the entire 2025 would be a lackluster year in relative terms as compared to 2024 or 2023.
Raghvendra, as you were mentioning that multiple brokerages were also mentioning that one should not read into much when it comes to Oberoi's Q3 pre-sales number. But do you expect Oberoi to overall achieve their FY25 guidance that they had given, and how are prospects looking like for FY26 at least? And also if you could give a color on the entire real estate space, because other than Suntec, all stocks are down in trade at least today, despite the fact that their financial performance has been pretty much in line with what they had estimated at the start of the year.
Absolutely agree. Where Suntec has been rewarded very well. Well, the major problem with Suntec was its sales numbers going down in the previous few quarters. And if you see, there has been a massive U-turn where the sales have been up by 40%. So that's a positive or a very pleasant turnaround. Their gross developmental value is also up to a similar significant amount of around 40%. And we see around a 12 to 15% jump in their earning per share, EPS. So there are a lot of positives in terms of the company is almost debt-free. Company has significantly reduced debt. So they have walked the talk in the previous few quarters. And now their sales, revenues, and EPS is going up. So Suntec Realty continues to be the top pick in the realty sector. But yes, there could be pain across the overall space where Oberoi Realty, Godrej Properties, or Prestige or DLF might see some kind of selling pressure or profit booking in the weeks ahead. So we do believe that Macrotech, Prestige, Oberoi could again be a sell on rise approach for these names, but Suntec Realty could be a buy on dips. Broadly, we are neutral on realty sector considering it's pretty domestic story with immune to the global macro developments.
Well, moving on, Zomato is another stock that we need to keep an eye out for. The stock is down around 9% after the company reported its Q3 numbers. Now, though the numbers were a miss on the street estimates and the commentary were somewhat positive where the management had upped their guidance, the street is quite concerned about the profitability of the company going forward. And we have Mahima joining us to give us all those details on why the street is very much worried when it comes to Zomato after the Q3 numbers.
Right. So, let's go about it this way. Let's talk about why and what is wrong with Zomato and why the stock is tanking so much. First of all, food delivery growth has, remained stagnant for the past few quarters. We're seeing that the food delivery QOQ is not growing much. This means there are trends being observed that people are moving towards healthier side of things. People are now, the kind of growth that we saw in food delivery in the first few quarters of Zomato when it was growing is not as much as we're seeing now. Now, in terms of losses being expanded, the company has said that they will now do the 2,000 dark store guidance that it gave for 2026. They're now going to complete it by 2025, which means they'll be high on capex and which will lead to losses for the next few quarters. They've said 2 quarters, but we'll have to watch out for as to how long these losses could extend. The third thing is competitive intensity is also putting pressure. We've seen that all of these platforms, the quick commerce platforms, are competing in big way and discounts are being offered at the cost of profitability. So profitability is kind of being impacted there also, and margins are also being impacted. In terms of valuations, for Zomato, valuations were never cheap. The current trailing PE also is around 528 times. So valuations is still a concern for Zomato. Moving on to the kind of brokerages that have come out saying as to their view with respect to how Q3 has panned out. In terms of UBS, they've maintained buy with a target price of 320. BofA has again maintained buy. So basically all of these brokerages have maintained buy, but some of them have also cut their target prices. I'll tell you which one. Macquarie has maintained buy with a target price of 375, but in terms, BofA has maintained buy with a target price of 375, but Macquarie has cut its target price to 290 from 320, but still maintained a buy. Nuvama has also maintained buy, but has cut the target price from 325 to 300, and Nomura has maintained buy with a target price of 290. So now the price range of target prices is between 290 to still 375, with BofA being the most bullish one. In terms of what next for Zomato, well, the execution of additional dark stores remains a key thing to be addressed. The execution of 10-minute delivery platform will also be something to watch out for, because that will also kind of have an impact on the cost of Zomato. Even the losses, they've said that 2 quarters of losses going forward, but we'll have to watch out for as to, going forward, what are their expansion plans and how long will the losses last. In terms of the company guidance of achieving 5% margin, when will this happen is a key thing to watch out for. And areas of growth apart from food delivery, now that the food delivery segment is getting stagnated, what will be the next areas of growth for Zomato will be something to watch out for. In terms of competition, will Zomato be able to outpace competition in terms of quick commerce when it comes to Swiggy, as well as their unlisted competitor, that is Zepto, which is doing very well in terms of the Zepto Cafe and the quick commerce space as well. And lastly, Blinkit gross order value growth of 100% for at least FY 25 and 26 is something that the management has guided. But with the kind of dark store expansion guidance that they've given, will this be achievable or not is something to watch out for.
Mahima, thank you for that. But what is happening to a Swiggy? If you can let me know in the next 35 seconds, I will, what is wrong with the Swiggy, because it's now nearing its IPO price.
Right. So, 3 quick things, because Zomato has now said that they've upped their dark store guidance. This will have a competitive impact on Swiggy. Swiggy will be forced to kind of, increase their dark store guidance also. And if they do that, they're already running into losses. They're still 4 to 5 quarters away from their profitability. So this might kind of elongate their journey towards profitability as well. And in terms of cash, Zomato is sitting on a cash of roughly 9,000 odd crores, but Swiggy does not have that much cash to implement the kind of and up their dark store guidance. And lastly, competition, like I said, is also putting pressure on a counter like Swiggy. So Q3 for Zomato is kind of weighing down on Swiggy as well.
Well, thank you, Mahima, for that in-depth analysis on what is happening with Zomato and Swiggy. Well, one thing that is for sure, markets are seeing a sharp sell-off, and we have Parag Thakkar, head fund manager from Fort Capital, joining us to give us some insights on what could be leading to this fall in markets. So, Parag, to start off with, the cues coming in from the global markets were quite positive. We also managed to get into the positive territory in trade. But what are the concerns in the market that could have led to this sharp sell-off that we have seen currently?
See, I will tell you, in my view, there is no broader concern because the dollar index, US 10-year bond yield, even Dow futures, Nasdaq futures are all behaving well. So basically, there is no such macro issue right now in the market. The issue can be specific and related to high PE stocks where narrative was going on, right? So even a slight disappointment in high PE stocks can lead to a big fall in those stocks, and that kind of thing upsets the market, and that kind of thing of course leads to some, I would say, capitulation in other stocks also. And I would take that as an opportunity to buy stocks like SBI, ICICI with a disclaimer that with a medium to long term view, and one can always take guidance of their individual advisors. But I would take this as an opportunity to buy stocks like SBI, ICICI, kind of stocks in this kind of a big fall, where the macros are actually positive today.
Right. So, Parag, Hiral, on this side, you're saying macros are positive, agreed. Is the market reading into something from the earnings that have come in so far, or from the expectations that are coming out? Because the stocks have been slightly under pressure, especially the ones which are heavily dependent on the numbers.
Absolutely. So basically, see, what I always believe in my investment philosophy is the more PE you pay, the higher the expectations are, right? So if you pay a 200 PE for a stock which is growing at 30, 40, 50%, if there is a disappointment of 5% here or there, also stock will correct by 30, 40%. And that is what is happening in the markets. And that is why I always tell people not to get carried away with the earning momentum which you are seeing on a quarterly basis. You have a view of an intrinsic value of the business in your mind. And no business in this world can grow at 100% for 10 years, right? And so you cannot be such high PEs. You cannot pay such high PEs for any business. And so this is bound to happen. This I was expecting from beginning, but it has delayed a bit. But now it has started to happen. That capitulation in so-called high growth stocks has started to happen.
Right. So given this fall that we are currently seeing in markets, any advice you are giving to your investors? Should they continue to stick with large caps or mid or small caps, and any sector specific ideas as well?
So as I told you, I remain very convinced on SBI, ICICI kind of names. Kotak, of course, reported excellent numbers. So BFSI is the space. Cement is another space where earnings have bottomed out. Yesterday on your channel only, TVS Motors gave good commentary. I would say that such high quality tried and tested names which are available at a reasonable valuation and 20 to 25% below their highs are the stocks to buy in such corrections.
Okay.
So banking, cement and very selected two-wheelers.
So, Parag, my last question coming to you is, how much further pressure are you expecting to see from current levels in terms of Nifty and Bank Nifty?
So I would say that, in my view, when the results of ICICI Bank and those kind of starts come on 25th or so, and then of course everything depends on budget, because Trump event is out of the way now, and that has not caused any major disruption in the macros of like dollar index and US 10-year. So now everything depends on budget. Of course, everybody would like to wait out till budget to buy new positions. But my channel checks are suggesting that even cement demand and two-wheeler demand has improved from 15 December and 1st January onwards as government capex has started. So I would say that I am bullish from economy perspective, and hence economy-related stocks which are falling today because of some specific reasons, like these high growth companies faltering on their earning expectations.
Well, thank you, Parag, for joining us and giving us your insights about the markets. Moving on, let's get in again Raghavendra Kiria, the founder of Prosperity Advisors. So, Raghavendra, firstly, to understand between this Zomato and Swiggy, any stock that you're advising investors to put in money given this sharp fall that we are seeing currently, because Swiggy is now trading again around their IPO prices. Zomato is still far away from their IPO price, and we have seen a sharp surge in the share prices of late. Swiggy has come near its IPO price. So any investment advice here between Zomato and Swiggy?
Well, these two companies are one of its kind in their own sector in terms of food delivery and the quick commerce space. So yes, valuations are supremely expensive, and that's a concern. But they have always been expensive, and they might continue to be at premium valuations in terms of P multiples to the EPS. So we have to buy these stocks with a pinch of salt in terms of on the valuation metrics. But yes, Zomato at levels of around 200, 190 could get attractive. Swiggy, another 5 to 7% correction, and to levels of around 415, 420 might look attractive in terms of we are looking at a buy on dip space. Well, a bigger threat, as your colleague mentioned, is in terms of growing competition. What if Uber Eats, which is in the similar business and a successful model across the world, comes into India? So that could be a threat to Swiggy and Zomato. Amazon has also indicated that they might actually go all in terms of the quick commerce business. So there's another level of competition coming from very established international global players, which might be a threat in terms to their market share, to margins and profitability in the days ahead. But until that happens, any dip can be taken as a buying opportunity. And you specifically asked between Swiggy and Zomato, considering the cash pile at which Zomato is sitting and the bigger pan-India presence, we would prefer Zomato at levels of around 200 as a better candidate between Swiggy and Zomato. So yes, it's a buy on dip, and we would prefer Zomato over Swiggy at any kind of correction.
In the Zomato over Swiggy and a buy on dip strategy at levels of around 200 probably is what you can look at. In fact, Ilara has put an interesting one that it seems like a pit stop in a marathon for a Zomato. So let's see what happens from here on. But moving on, Dixon Technologies. What's interesting, Somit, in the Dixon Technologies over here is brokerages are positive. There is no negative note that has come in.
Something similar to what we saw in Zomato.
Exactly. Yeah. And target price, in fact, there has been an upgrade on a consensus basis as well.
From 16,000 to 16,800.
So I think it was for all of us to actually find what are the loopholes and where is the issue in terms of Dixon Technologies, because the valuations is, I think, a major bummer over here.
Well, yes, valuation is one of the concerns, but then the big capital expenditure announcement that they did, obviously it will be subsidized by the government, but there could be some working capital block that could come in because it's $3 billion investment.
In fact, let's also go to Mihika. I think she's just pointing out a couple of points as to what is it that is actually putting pressure on our Dixon Technologies. The stock is now down a little over 13%. Mihika, over to you.
Dixon Technologies is heavily under pressure. This is despite revenues, EBITDA and net profit more than doubling on a year-on-year basis in Q3 FY25. Margins were stable and all of these metrics have beaten estimates. But in terms of what's dragging Dixon Technologies down, well, up first, brokerages have trimmed their FY25 estimates. MOSL and Nuvama have lowered their estimates by 8%. In terms of consumer electronics, this is a division which has been facing weakness in demand on the basis of seasonality. The revenue and operating profit contribution for this segment has dropped to around 6% in Q3 FY25 versus 17 to 19% a year ago. And this is a segment that is the second highest revenue contributor, and the total revenues are down 32% on a year-on-year basis. Brokerages are also cautious on valuations. The stock has gained 2.7 times in the past 1 year, and the current price to earnings ratio of the counter stands at 262 times versus the 5-year average PE of 97 times. We've also seen an increase on debt this quarter. Debt has increased to 361 crores as of Q3 versus 155 crore at the end of FY24, and the debt to equity ratio is also up to 0.15 times versus 0.09 times in March of 2024. And lastly, the street may not be taking very well in terms of the new joint venture that has been announced with the new for the new fabrication business, which could block some working capital going ahead. And there's also the possibility of the company's margins being under pressure pressure because of high competition of the Tata Group in the mobile segment, which is actually the segment that has been driving growth all this while.
Thanks, Mika, for getting us the updates. Raghvendra, how are you reading into a Dixon Technologies? Because everything looks absolutely rosy at the face of it. But what is it that the investors are not taking correctly? Is it the valuations, or are we talking about the capex that they are going to incur in terms of their fabrication business and the kind of pressure that the working capital cycle is going to see from here on? What would you look at?
Well, it's all of the above, Hiral, in terms of the concerns for Dixon Technologies. Broadly, if a stock is trading at P multiples of north of 200 times to its EPS, it's very difficult to make money. Any slip in the commentary or any earnings which are below expectations, the stock is actually heavily punished, which is what is happening if you are trading at P multiples of around 250 times to your EPS. That is what is happening in Dixon Technologies. Plus, their expansion plans might look rosy, as you very well stated, but there could be an aggressive expansion right now. And if there is competition from big established players like a Reliance or a Tata in this space, in terms of EMS manufacturing, then of course there could be some pressure in terms of their market share, profitability, and revenue. So it's an avoid. Even in this sharp correction of around 13% today, stock is trading at 15,200. But until and unless it falls to around 12,000 levels, it will continue to be an avoid, purely based on a very expensive valuation metrics and very aggressive expansion plan. So Dixon Technologies, we would avoid even at current levels.
Just to add on, the F&O positioning for Dixon Tech is indicating that the stock could most likely enter F&O ban tomorrow in trade. Well, with that, let's slip into a short break and we'll be back with more themes and more news on the other side.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for. No change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced.
Welcome back. You're watching Profit Buzzers. Let's quickly pull up all the sugar counters in trade. Yesterday also you did see a bump up to the tune of almost around 3 to 5%. Today you're seeing marginal uptick. You have the pack which is trading in the positive, but for how soon will the party continue is the question from here on, and this is on the back of the sugar export quota, which has the ban which was there in fact has been lifted as well. Now, how big a positive is this going to be? Let me welcome in Deepak Balani, Director General at ISMA. Deepak, good afternoon and welcome to the show. Absolute good news for the industry, taking into consideration the export ban that has been lifted. Number one, 1 million ton of export is what we are looking at. How do you think will it come and support sugar prices, because domestic prices have been under pressure?
Hi, good afternoon. So first of all, we welcome the decision by the government to allow 1 million ton export of sugar. I think this was always our demand for the last few months, that looking at the sugar balance sheet, looking at our opening stock of around 80 lakh tons and consumption estimate of around 280 lakh tons and almost maxed out diversion of around 40 lakh tons, we still have a lot of sugar in the country that we can at least export 10 lakh tons immediately, followed by 10 lakh tons more. So we are very happy that the government has considered our request and maintaining a balance between all the drivers, the domestic consumption, the ethanol program, government has also allowed export. This is going to give a very big boost to the industry and also liquidity to the millers, and which will ultimately help our millers to do the timely cane payments, which will inflow at least infuse cash flow in the rural economy. So I think that is very big positive coming out of this entire decision. The second very good impact of this decision will also have that if you see for last 2.5 months, the ex-mill price of sugar, specifically in Maharashtra, was hovering around between 32 to 34 rupees, which is much below the cost of production, which was in any way, impacting, hugely impacting the viability of the mills. So I believe this decision will also stabilize the domestic prices. The ex-mill prices will at least be corrected to some extent and be viable, enabling our millers to do the timely payment and also invest into expansion and maintenance. So I believe this is a very good decision and a very balanced decision benefiting the entire ecosystem.
Right, sir. So just wanted to understand, after this relaxation that we are seeing of 1 MMT, would India still be left with any surplus, and do you expect more relaxation to come in from the government side?
See, as I said, we opened the season with 80 lakh tons, and our previous estimate was higher. So July estimate showed that we will be producing almost 330 lakh tons, but that has that is likely to come down. Our second advance estimate is likely to come on 31st of January. ISMA is at the moment undergoing complete cane assessment and also the satellite imaging. So, but we believe that the production will be reasonably good, reasonably okay. And considering that the ethanol program, the diversion will be 40 lakh tons, and the government normative stock is around 55 lakh tons. So I think we still will have sufficient sugar. So 10 lakh tons as of now is a good thing. But having said that, maybe in the next month or next to last month, depending on how the crop is coming out, what is the production, I think 10 lakh tons will also. I think that is something which is still there.
Right. So tomorrow there's a meeting in Uttar Pradesh to decide on the state advised prices when it comes to sugarcane. Do you expect a hike to come in, and how much of that are you factoring in, and how much will it be negative for the sugar companies?
I don't have any information because the decision has not been made yet. So I believe whatever decision is being made as per the SAP is concerned, I believe it is very, very important to connect both the FRP, SAP with the MSP of the sugar and also ethanol rate. So because whenever the input cost goes high, I think there has to be a corresponding increase in both MSP and the ethanol rate. So whatever decision the government takes, it also has to make ensure that the formula is applied and accordingly the MSP and the ethanol is also corrected.
But internally, you must have estimated at least some kind of a price hike. If you could help us with any number that you're expecting that could come in as a hike here.
No, we have not really done any estimate as far as. So we are looking forward for some decision by the government, and only after the decisions are made, we will be able to comment.
Deepak, another question I have for you is in terms of the ethanol pricing. The government is likely to hike ethanol prices in FY25. What is your estimation from an industry perspective for B heavy and sugarcane juice ethanol, and for C heavy ethanol? What is that range that you're looking at?
See, basically, if you go back until 22-23 sugar season, almost for 5 years, government corrected the ethanol price, and there was a formula they applied which was increase in FRP and the cane payments. But unfortunately, in 23-24, there was a restriction which was brought due to a perception that sugar production may be less. And because of that, the price was not corrected. Only an incentive which was given for C heavy. Now for 24-25, we have requested that the same formula which was previously applied, so that formula could be applied with the revision of FRP this year to 340. And accordingly, we had requested for the juice to be revised to around 71 rupees and B heavy to be revised to around 65, 66 rupees. So we are expecting that the government will take some call on revision of the ethanol rate, because that also is a very, very important program for the government. And as you know, because of the very good policies in past of the government, we have been able to achieve 20%, almost able to achieve 20%, almost 5 years in advance. So I believe all the stakeholders have come and really invested huge amount of money in the ethanol program. And obviously, because of the visionary leadership of our government, I think this program is a success. And we hope that the conducive policies of the government, specifically on the pricing, will continue and it will help us.
Well, thank you, sir. Thank you for joining us and giving us your insights about the sugar industry post this relaxation of dues that we have gotten. Well, apart from that host of stocks that we need to keep an eye out for on the back of the MSCI February 2025 rejig that is expected to happen. Now, the announcement regarding this is expected to come in on Feb 12th, but the cutoff date based on which MSCI decides which stock to include, which stock to move from small cap to standard, and which stock to exclude has started, and that remains open from Jan 28th till Jan 31st. And MSCI on its own discretion will decide which date to consider as the cutoff date. Now, the adjustments regarding this, which is the flows and inflows and the outflows regarding this changes in the MSCI indices, will happen on Feb 28th. So, which are the stocks that we need to keep an eye out for? Firstly, as per Motilal Oswal, there are no stocks that would freshly get included in the MSCI Standard Index or the Small Cap Index. They are expecting 2 stocks that have a high probability of moving from the Small Cap Index to the Standard Index, and 2 stocks that have a medium probability of getting included into the Standard Index, which means moving out from the Small Cap Index and getting included in the Standard Index. So, Coforge and Paytm, these are the 2 stocks that have a high probability of getting included or getting moved from small cap to the Standard Index. And if that happens, then the inflows in both the stocks could be anywhere between 185 to 395 million US dollars, which is nearly 2 to 8 times the 20-day average volume. Coromandel International and Uno Minda have a medium probability of moving from the small cap index to the standard index, and if that happens, then the inflows in both the stocks would be anywhere between 150 to 160 million US dollars, which is nearly 17 to 19 times the 20-day average volume. Apart from that, we need to also keep an eye out for Zomato, because on the back of this fundraise, their weightage in the MSCI could increase by around 0.11 percentage points, which could lead to an inflow of close to 105 million US dollars. So keep an eye out for all the stocks. The cutoff date has already begun, and the official announcement regarding the changes will come in on Feb 12th. Well, let's also get in Sarvendra to understand how these stocks are looking like on the technical parameter. Sarvendra, any stock that excites you on the technical front, be it Coforge, Paytm, Coromandel, Uno Minda or Zomato after the fall that we have seen today?
Yeah, very good afternoon. See, the broad basket right now is declining. So if you look at the breadth in a slightly 15-20 day horizon, I think broadly the market is declining, and the percentage of stocks going down, I think it still is more than what we see as advances. So out of these four names, yes, I think 60-70% of the universe is falling. So if at all you look at that from that perspective, I think I would still say that out of four, three will fall and possibly one will rise. So the picking process becomes slightly difficult. But even if I have to pick, I think looking at the patterns, I will still go within these names with Coromandel. I think 1770, 1800 is a very good support going forward. So as long as we are holding those levels, I think we have a chance to scale back towards 1950 and possibly the psychological 2000 mark also. So out of these four, if I have to pick, it will be Coromandel.
Right, so Coromandel is the pick that Sarvendra is picking basis what charts are indicating. So that's what we are looking at so far in terms of the MSCI rejig. In fact, Raghvendra, from the names that Somit was mentioning, Coforge, Paytm, Coromandel and Uno Minda, any picks that you have, and what would you bet big on?
Well, we would go with Paytm. I think on the news front, worst is over for the stock, and we would still like it at levels of around 850. And if for any reason it corrects to levels of 820, it becomes a very good buy. But with this high probability of getting into the MSCI standard index, Paytm, it would be our top pick among the four names which are on the probable list.
Right, so that's with regards to where Paytm, and that's the view coming in there. But let's quickly shift focus in terms of Trump 2.0 impact on India Inc. Couple of sectors that we have been watching out for is pharma, IT, renewables, and so forth. In fact, we did speak to the management of Mastech as well, that is Umang Nahata, who said that he's looking at the Trump 2.0 with caution. He expects that there will be stricter immigration rules and a lot of AI-driven work will come in reducing migration levels. Let's listen into what he had to say first.
Last time when Trump came to power, the immigration rejection rates really skyrocketed from 4.5%. It went up to more than 15%. So I think we are expecting that there will be a little more strictness on the immigration side. Having said that, the business also is gradually again tilting towards more offshore. A lot of GCCs coming in, which are the global competency centers, which are based in offshore. A lot of AI-driven work is coming in, which also reduces the amount of skilled people. So it's a bit of a balance, but we're watching it with caution. There could be a reduction in people moving from India to US, which will also mean I think we're looking at it, hiring local US teams is also a part of the strategy that we're looking at. So it's with a little bit of caution that I'm looking at it right now.
So that's Umang Nahata. Raghvendra, how are you looking at the impact on the IT space, taking Mastech's management who's saying that immigration needs to be looked at with slight bit of caution? How do you see the impact?
Well, we would actually be very cautious. There has also been an indication that the corporate tax could be significantly reduced. And if that happens, then Donald Trump had a business background. So the possibility of that happening, which was also declared in terms of the election campaign, is high. Now, if there is any reduction in corporate tax across the US, the entire savings would actually percolate into IT projects, and which we see as a silver lining to IT companies. Strength in US dollar versus Indian rupee or emerging economic currencies is also taken as a positive for the IT space. So we are looking at the overall this new Trump 2.0 as a glass half full with water and half full with air for the IT space, where we believe that the strength in dollar and the corporate tax reduction of US corporates would actually pay for new projects and better revenues for the IT sector. There might be some concerns with the pharma, but Trump 2.0, we believe, would augur well for the software companies in India.
Right. Well, pharma is another sector that remains in focus with Donald Trump coming in the US, and we have Varsha joining us to give us detail about what would be the impact on the pharma sector with the political change that we have seen in the United States.
Thank you for that. So there will be significant implications for Indian pharmaceutical companies, offering both opportunities and challenges. But why we are actually speaking it, what's the contribution that Indian pharma companies has when it comes to US generic business? Let's see that. Indian companies now hold 46% of the US generics market, and India exports 8 to 10 billion US dollars drugs annually. Now, let's see what are the advantages under Trump's presidency. One is higher US tariffs on imports from China, Mexico and Canada may make Indian pharmaceutical companies more productive in the American market, but we all know that this is uncertain as nothing has been told about the tariffs right now. The USA has recently hiked the tariff on Indian certain medical devices of Chinese origin to 50%, and with Trump, the medtech industry does not expect any rollback as per all the analysts now. So there's a window of opportunity when it comes to Indian medical devices manufacturers to take advantage of the supply chain diversity that we are seeing. Also, the other factor which will be an advantage for Indian pharma companies is the lower drug prices by the new US government will be favorable for Indian pharma companies that produce low cost drugs. Weaker rupee will also further support them. And Trump's focus on reducing China's reliance supports pharma companies. We all know that all the Indian CDMO companies have been saying that China plus one will be the next leg of growth for them, and many CDMO companies have seen increasing inquiries from US and Europe when it comes to supply chain diversity. Then if I were to talk about the challenges, well, imposition of 10% tariffs on India on imports from US could challenge Indian generics exporters by affecting profitability, as they may not be able to pass on the increased cost to the consumers. And Indian drug makers are also worried about Trump's America's First policy, which could see a boost in domestic manufacturing and less need for Indian exports. And lastly, if I were to talk about the pharma stocks which will be in focus, which has US contribution, you have Dr. Reddy's, Lupin, Sun Pharma, Cipla and Torrent Pharma.
That was a fundamental impact that could come in when it comes to the pharma space. Well, Sarvendra, how are pharma stocks looking like on the technical front? Any interesting names?
Yeah, I would go with the index first, and I think broadly we are going to be in a 22,000 to around 23,500 kind of a range on the Nifty Pharma. So I think trading bets maybe yes, but nothing beyond say 10 to 15 working days is what I can see as of now. So I think I'll let this heat settle down and the patterns to slightly be more clear, and then possibly an upside pending maybe. But I still see that there's still 10 to 15 days of sideways to patternish movement, beyond which you will get more clarity. I believe that in 3-6 months, yes, if the Nifty Pharma holds 21,000, 21,200 on the downside, then you definitely have a possibility of putting up a new high. So 24,000, 24,500 is what I would put as targets. But I would see it slightly ahead in the future, around 3 to 6 months is what I would bet.
3 to 6 months is what is Sarvendra's bet as well in terms of these pharma names. But thank you, Raghvendra and Sarvendra, for joining us on the show and sharing the views. We'll quickly slip into a short break now, and whilst we get into the break, we'll bring you some views from Davos 2025. Welspun Living's Dipali Goenka and Bharat Ford's Amit Kalyani. What are their thoughts about Trump's bold calls on tariffs and the impact of possible policy changes on India Inc. Let's listen into that conversation, and that's a thank you from Somit and myself.
So I know the time's uncertain, and we don't know what's going to happen. But I think definitely India would be in a positive light that I feel very, very optimistic about. And you spoke about the tariffs and the impact on inflation. Well, I think there is an opportunity there to work with our global retail partners to see how we can get that under control. But I think overall, I would say, compared to the other countries and other democracies and China, of course, India holds itself in a good stead.
He's talked about a lot of things that can be very positive for the global economy. The first thing is about getting the geopolitical issues under control. So he's talked about getting Ukraine-Russia resolved. He's talked about, getting the Israel issue under control. I think those two will be a big mood booster for the whole world and reduce a lot of stress in the overall system. I think especially the Russia-Ukraine war will then, the end of that will then normalize the economic situation for a lot of European countries which depend on Russian oil and gas. Secondly, the whole focus on rebuild America, putting infrastructure back in America, focusing on building high quality infrastructure, playing catch up on the hard physical infrastructure, whether it's airports, whether it's better roads, bridges, power. He's talked about bringing a lot of power back into the US because of AI needing huge amounts of power for the data storage.
I present the budget for a historic
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only.
Cut right to that conversation.
Somewhat weaker, and China also has its own challenges. Now, in terms of what countries need to do so that we have more balanced growth in the world, I think it's pretty country specific, and it's going to vary country by country. In the case of China, there's a lot more they need to do on the property sector, bringing up domestic demand. In Europe, they have to take actions to raise productivity, get growth going, and so on. So at the same time, there are a lot of developments on the external front when it comes to geopolitical tensions, trade policy in the world. And that's something that governments around the world will have to, deal with.
Right. Well, we were looking at, you've also obviously mentioned India. It is a very large growing economy, but your words are cautionary, I would say. Growth in India also slowed more than expected led by a sharper than expected deceleration in industrial activity. A couple of years back, we were well above 7%. The target has always been 8% plus. What does India need to do to get back to those 8% plus levels?
Yeah. I mean, firstly, just to put things in perspective, India remains the fastest growing major economy in the world at 6.5%.
Yeah.
Now, the growth is lower than what we had initially expected, and that reflects the fact that in the second half of last year, 2024, we saw a slower start to public investment following the elections. Now, we expect that to bounce back, which is going to bring back some of the recovery. We're also seeing the rural sector consumption strengthening, which is something that we had expected that it would. But more generally, in terms of getting growth to higher levels on a more durable basis, I mean, India will have to continue to do some of the things it's doing, which is public infrastructure investment, keep at it, make sure that the timelines are met, improve the ease of doing business. Being able to buy and sell land should be an easier job than what it is right now, and plugging India back into the global supply chain in a much more stronger way, which will require, cutting back some of the tariffs that they have, which are quite high.
Yeah. The target for India, of course, is to become a $10 trillion economy, to become developed, I think, by 2047. The first target of $10 trillion in terms of the Indian economy, do you believe that's achievable in the finite future?
For 2047 is a long way off.
Yes.
And the world is not remaining stationary. There's lots that happen.
Sure.
Again, it is one of those, it's a good aspiration to have, and it's going to take much bigger structural reforms than what we've seen in the last decade.
The United States you've also written about, you've said in the report that underlying demand remains robust in the United States, reflects the strong wealth effects, a less restrictive monetary policy stance. With the new Trump administration coming into power, do you see a real consolidation of the US economy?
So, firstly, I think the US economy has been powering along for a few years now. US consumers are spending at a very healthy pace. The labor market is strong. Productivity growth has been actually surprisingly very good in the US. Now, what will come in the next few years depends on the details of the new administration. President Trump has announced a range of measures. We're going to have to analyze it. They're on multiple fronts, in immigration, on trade. So it's a little premature to comment on how that would work. I think what we already see is a lot of positive sentiment in the US. The stock market is doing extremely well. And, the US is now the most popular destination for foreign direct investment. It's getting a lot of foreign capital coming in.
Yeah. Tariffs is something which, from the United States, it certainly concerns us in India as well. I was speaking to Nadir Godrej yesterday, where he said that, in the field of agriculture, that could be an area of concern. With the new Trump administration, do you believe that tariffs could be, problematic in terms of countries like India?
Again, it's going to depend on the details of how they decide what kinds of tariffs to impose, the magnitudes of these tariffs. And of course, also we need to see the reaction of countries to it. Now, what we have seen in the past, of course, if there is a unbridled tariff war with countries imposing tariffs in retaliation, it does leave the world worse off. But for now, I think we should wait and see exactly what those tariffs may look like.
China, of course, the other huge economy, and you've written, and I quote, faster than expected net export growth only partly offset a faster than expected slowdown in consumption. What are the primary, how would you look at the China story? There is also the property market and stabilization of the property market. Has that been up to scratch or up to your expectations?
Yeah. Wait, Vishnu, in the case of China, domestic demand has remained weak. Consumer demand has remained weak, and that's one area where the Chinese government is focused on to try and bring back consumption spending. They've done a whole host of measures, including on the fiscal front and on monetary policy front, which is why we've upgraded the forecast for China for a little bit this year. But more is going to be needed to get money more into the hands of consumers so that they actually feel confident about spending it. In terms of dealing with unfinished homes that were sold previously, that is an issue that still needs tackling, because for a lot of Chinese, that's where their wealth is, and as long as you don't see them getting the homes that they paid for, that can be a very negative sentiment. So recognize that the government is doing a lot in terms of measures. More will be needed, more in terms of getting the private market economy also to be a bigger contributor. and also relying less on external demand and more on domestic demand.
Artificial intelligence, it's a huge theme over here. For the last couple of years at the World Economic Forum in Asia, there are all sorts of questions. Is it an enabler? Does it potentially take jobs? There is also the entire issue of equity and AI. So in the context of Asia, how do you see AI and growth?
Firstly, there's a lot of uncertainty still in terms of what AI will do for economies in the world. We have estimates of how much it can help in terms of raising productivity, and it's either 0.1 percentage point every year or 0.8 percentage point every year. Given that world growth is at 3% on average, if you get to 0.8, that's a large number, but we don't know that yet. And then yes, of course, there are the labor market effects. So if you look at India, for example, our estimate is that about 26% of India's workforce is exposed to AI, but about 14% will benefit from AI, and the remaining 12% will have more of a displacing effect. So a lot depends upon what gets done in terms of building digital public infrastructure, skilling the workforce so that they can use the new technology that's there. And also you need to have an environment for innovation, starting businesses, all of that to be able to make use of this.
Geeta Gopinath, wonderful speaking to you. There you have it, Geeta Gopinath telling us about the overall international situation, why there are lower than expected, perhaps, historical growth numbers. The India story, India is a very large economy, but a lot more perhaps needs to be done to get back to those 8% growth levels. China, the United States, and of course, artificial intelligence. I suspect that no one really knows where AI is headed going into the future. It's back to the studio.
Well, very interesting development and conversation to look forward to. But coming back to the markets, broader markets, seeing in peak today, we're looking at cuts of more than 1% in trade today. And one of the top contributors leading to this is Dixon Tech. This is on focus after the company posted its Q3 earnings, and the stock is down more than 13% today. Puneet joins us with more details. Puneet, what are we looking forward to the results if we see for Dixon Tech? Is it the valuations, the new foray into the semiconductor, which is causing a worry in the street? Break that down for us.
Well, thanks for that. So definitely it was a big beat in terms of Q3 results for Dixon Tech, 117% growth in its revenue. EBITDA also coming in at 3.8%, up almost above 100%, while profits were also up about 120%. But the new foray into the semiconductor space, especially for the component side, is something that's dragging the stock today. One of the key reasons is that the new foray the company spoke about in its conference call into display fabrications, specifically on the semiconductor component side. They've also mentioned that this is kind of like a reversal from the previous plan to just stick to non-semiconductor components, which are less capital intensive. But with this new move will enable the company to increase its addressable market in terms of the component side. Earlier, they would be only be able to address roughly 50% of the components that goes into, for example, manufacturing a smartphone. They've increased that to almost 90 to 100% now. But that is something that's not, the market is not taken very kindly off, and there are some key reasons why. The new foray might require a capex of about $3 billion or roughly 25,000 crores. Now, of course, the central government subsidizes roughly 50% of this capex, while the other 20% is subsidized by the state government. So overall, 70% of this 25,000 crores is subsidized by government schemes because, India is a net importer of all semiconductor components. But Dixon's share of the capex will be roughly about 7,000 to 8,000 crores. That's roughly almost 10 times its current annual capex for FY25, which is roughly 800 crores and has been over the last 3 to 4 years. And that might be something that will be, that's, the street has been mentioning that, this might put a lot of financial strain over the next 2 to 3 years when it might, require the high investments as well. Dixon has clarified some of the things that, they will not be the only, company to invest this. They will have a JV partner with a global fabrication company. They will invest half of the capex. So roughly 4,000 to 5,000 crores will be Dixon's share of the capex, but that's still higher by almost 5 times its annual capex. Apart from that, while I mentioned that this will increase the addressable market, and is something that Kaynes Technologies has also mentioned. It's a competitor in the EMS space. They are only foraying into the semiconductor component space for Kaynes Technologies. So that's one of the key things, and that's something that's putting pressure on that. Apart from that, of course, valuations have been known for the company. It's trading above its current PE of about 200 times, but it's expected to double its revenues in 2 years. So the price to earnings comes to about 105 times, still very pricey in terms of this market condition as well. Apart from that, they mentioned that any kind of margin support in terms of the non-semiconductor foray will only come in FY27. So FY26 is expected to be around 3 to 4% margin range as well. So overall, it's a negative move in terms of the financial strain on the capex, but this will help the company become by FY30. What's their plan is to become one of the biggest non-semiconductor as well as semiconductor components company in the EMS space. So it's more of a long-term view that analysts have also taken in terms of certain analysts have downgraded the stock. But overall, currently it's a negative based on the new plans to get into semiconductor components.
Okay, thanks for that, Puneet. Thanks for the comprehensive breakout on what is happening for Dixon Tech. But with that, let's welcome in our guest for today, Rajesh Agrawal, Head of Research of AUM Capital, joins us. Hi Rajesh, Dixon Tech is the standout stock in trade today. It's down over 13%, and it's not the numbers which are a concern, but it's foray in the semiconductor space. As my colleague Puneet was talking about, the higher capex number, 25,000 crore is the total capex estimated, of which 8,000 crore is what is Dixon's share going to be. What do you make of these developments? Are the valuations too expensive? Because we are seeing a rub-off effect on Keynes also, which is planning on a similar strategy going forward.
Good afternoon, Anishri. You said it right. The numbers were pretty good. In line with market expectation, I would say. Although the growth was slower, but we saw revenue growing by good numbers, bottom line growing by good numbers, margins were okayish. Even the mobile business, which contributed 67% in the previous quarter, has been gone up to 89% of the revenue in this quarter. Everything was going for good. They have made a recent JV with Vivo in December to enter into display fab manufacturing. These things are good, but the foray into semiconductor, which would require a huge capex, and the numbers would come, as your colleague said, from 2030 onward. There's a long gestation period, at least 4-5 years down the line. And not to forget the kind of valuation it's still trading at 3-digit PE. I think there is very little scope from these levels for a meaningful upside from these levels. Although there might be a bounce back because of the kind of cut which we have seen today, but for investment purposes, avoid at this point of time. Let the valuation cool down a little bit, then we can give a buy call. But at this point of time, it's a avoid.
Okay, a definite avoid with valuations remaining as a concern. But moving on to the next theme and focus is the swearing in of Donald Trump as 47th President of the United States. Now, there is a high chance that the tariff on solar modules will take place. How will this impact the solar markets in the domestic space is something that Mihika will be sharing with us. Mihika, over to you. What can you tell us about this?
The Trump administration has pledged a lot in regard to the US energy sector. They are giving more focus to drilling, less focus on clean energy, and there are talks about changes to the Inflation Reduction Act. And several policy changes could impact the solar module makers in India, like Waaree Energies and Premier Energies. The current status is most of India's solar module exports are going to the US, and this share has been rising for the last 1 to 2 years. Now, I'll divide the possible impact on the two companies in 3 different scenarios. Scenario 1 includes an imposition of tariffs by the US on solar imports and a reduction in the IRA or Inflation Reduction Act incentives. And these incentives were offered to US-based producers via tax credits in an aim to boost the US solar industry. But the impact of these two moves could be negative for Waaree Energies and Premier Energies as per Axis Securities. Potential scenario number 2 includes no change in IRA incentives and no imposition of solar import tariffs by the US, and this is a scenario that will be most beneficial for Waaree Energies and Premier Energies. And the last scenario is no change in IRA incentives, but an increase in import tariffs for solar modules by the US. This would be initially negative for Waaree Energies and Premier Energies, as exports from India will be less viable in this scenario, but it would be beneficial for these companies in the medium term because they are setting up US plants locally in the United States, and the higher possible module prices in the US could benefit these companies.
Well, thanks for that, Mihika. Rajesh, coming to you on these solar module makers, Fori and Premier Energies in focus. Now, of the three scenarios, what do you see about the Trump swearing in and now him being the president? What does this mean for the company's path going forward? And even on a fundamental basis, what is your take on these companies based on how they have been performing?
See, there is no doubt that solar and all these energy companies are going to be there for the long term. But the short term, there may be some kind of blips because of the kind of news flow which we are witnessing. Yesterday only, we came to know that Mr. Trump, as expected, has said that his focus would be on fossil fuels, and that's a negative for the entire renewable energy space as such, I would say. Major producers of modules like Wari or Premier would be get impacted in the short term because more because of sentiments rather than because of fundamentals. Because apart from US, there are other countries where they export. So I think these kind of drop in stocks, maybe Wari going down to around 24,2,500 or a Premier going to around 1,050 odd levels would be good levels to accumulate. We would wait for some amount of more correction going in these two stocks before adding.
Okay, so accumulation and wait and watch is the approach that Rajesh has. But thank you so much, Rajesh, for joining in and sharing your perspective on some of the key stocks and what's the way forward for them. Thank you once again.
Thank you.
Now, moving on, my colleague Sandhya Ravishankar caught up with Bharat Barai, who is the chairman of US-India Community Foundation, and began by asking him the impact of Trump's policy on H-1B visas. Listen into that slice of conversation.
I don't think that we are going to be affected as much. In fact, we might even get benefit because a lot of illegal immigrants, they have been given so much of consideration during the Biden era. I give you an example. So many Indians have been approved for conversion to green card who have been on H-1B visa. However, the waiting line now is extending almost 140 years. Now, instead of giving the quota to these people who are legal migrants, who have legal H-1B visas, who have been legally approved for green card, the number of visas that should have gone to them were given to Afghan refugees, the refugees who came from South. Can you believe so many hotels in New York which were run down, which are not being used? After these migrants came, illegal migrants, they have been put in these hotels at the expense of the taxpayers. They are being fed, and now they are also getting the permits to work. So when there are legal migrants who are waiting officially for all this time just to allow illegal migrants to come, put them in the hotels, give them food, and give them work permit, I think that doesn't sound right or fair. The other thing that was done at time of Obama was that so many people were given the lotteries. So when legal migrants were waiting for conversion to green card, he issued lotteries for people for Azerbaijan and Tajikistan and this and this and that. They all came to USA on green card, while people who are well qualified, who pay taxes, who contribute to US economy, have been waiting for years and years together. I give another example in our mandir. Till 2023, the priest who came on R1 visa, there was no waiting in that category. They usually, once they were approved for green card, will get it within few months. Now what has happened is in 2023, President Biden diverted that quota, which was meant for the priest conversion from R1 visa to the green card, to the Afghan refugees, to the southern Honduras refugees. So the priests who are in the mandir, Hindu priest, they have to go back because they have been waiting in line, and 5 years, which is the waiting time for two and a half R1 visa, they have to go back. So you can see that the policy that was exercised by Biden administration was very unfair to the legal migrants, and I hope that Trump will be able to fix it and tilt it more towards the legal migrant. So I think it will benefit people of Indian origin.
Well, fair enough, because, from what you're saying, it appears that the policies were pretty skewed. Now, Indians are largely, working in in software companies, and they're largely legal migrants. It's very rare for us to hear about illegal migrants from India. So I take your point, but do you see the H-1B visa rules changing either positively or negatively for Indians under Trump?
I think, of course, he has not spelled out what he will do, but knowing that so many industries want the H-1B workers, they probably will be remain same, or they will be positively affected. I doubt that they will be negatively affected. You know, in Republican Party, there are two contrasting views. One led by people like Elon Musk, who himself came on a student visa, then got converted to H-1B, and then became green card and citizen, and he has contributed so immensely that from a student visa worker, he has become the richest man on earth. So those are the people who are advocating H-1B visa, while there are some hardcore Republicans on the other side who think that they are taking care or they are taking away the jobs of Americans. But Trump has clarified that no, he is going to favor H-1B visas when it is appropriate. And I think the high-tech industries, especially artificial intelligence that is leading the charge in the United States, they are going to require a lot of H-1B workers. So I think it will be positively impacted because Trump wants to keep United States edge, especially using artificial intelligence, both in software as well as in hardware, to keep America at the top.
That sounds very good indeed, and I hope he certainly spells out his policies in the coming days. Now, what are you hearing about the visa norms for dependents and spouses? Because this has been a little bit of an issue, especially when it comes to elderly parents whose kids are abroad in the US. How do you see this panning out?
I think probably it won't be changed. There is so much of quota per year for each country. Now, this is basically a fundamentally flawed policy. To have a maximum of 20,000 for dependents for a country like Fiji or a country like India, I mean, a population of 1.4 billion versus a population of maybe a few 100,000. So we are going to try to lobby the Congress that the whole visa system for dependents should be changed, and it should be based on the population of the country. Now, granted that there are smaller countries that will come and protest, but it should be proportionate to the population of the country and not have the quota of 20,000 for a country of 1.4 billion versus a country of few 100,000. Let's see if that will change.
A lot to look forward to in terms of where the global markets are concerned and what Trump can bring to the table forward for not just USA, but for the domestic economies and other Asian economies as well. But with that, it's a wrap on this edition of the show. But do stay tuned to India Market Close coming up next.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
everyone. With Budget 2025 right around the corner, there is one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. It didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for Budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming Union Budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default.
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita. With me is Hiral Dadia, and we're going to quickly take you through what markets are up to at this point. We're seeing some pressure on the Nifty, and let's pull up the heat map as well. But it's been a very volatile day. Really, that is the highlight of the day. Look at those. The breadth of the market at the moment looking weak. Trend down 5. You're seeing pressure on banks as well, and SBI is down nearly 2, and ICICI Bank is down 2.5. Kotak Bank is down 1% as well. So when some of these financials, some of the heavyweight financials, take a bit of a knock, you will see that impact on the Nifty, and that's likely what we're seeing. What's doing well? Some defensives and cement really. Apollo Hospitals doing well, Ultratech doing well on the back of a constructive note. You're also seeing something, some of the infra plays, a JSW Steel, and some bit of positivity even on the FMCG counters. Let's look at some of those. Nestle doing well, ITC doing well, Britannia also doing well in trade. So that's really the texture. Let's pull up the advanced decline, highlight the breadth for you. It's a tough day. You look at the way in which the breadth has moved pretty much through the day till now, and you will clearly realize that it's been quite volatile in that sense. And very similar yesterday as well. There was quite a bit of volatility in the breadth as well yesterday. So that's how it's playing out right now. Let's look at the Nifty mid cap and the small cap indices. Of course, they are underperforming the benchmark today, and sharply so. 1.4% lower on the Nifty mid cap. The Nifty small cap index also down now 1.7. We're nearly at the lowest point of the day. 507 is the lowest point. We're just 50 points away from that. So will be interesting how the next hour and a half shapes up where markets are concerned. I want to look at the contributors on the Nifty before I hand it over to Hiral with regard to specific stocks. Look at some of the way in which some of the heavyweights are doing. ICICI Bank contributing 50 negative points on the Nifty. By the way, results for ICICI on Saturday. Reliance is the other one, which is dragging the Nifty by 28 points, 1% plus lower on a Reliance as well. SBI too is one of the other culprits. What's doing well? Yes, Infi is a heavyweight, but not really impacting the index in a big fashion. ITC and some of the FMCG stocks are doing well for sure. Let's pull up the sectoral heat map as well. Just have a look at the texture once. But Hiral, it's a day when any earnings where there has even been a slight bit of a miss is getting badgered in trade. And that's not just been the theme for today. It's been the theme pretty much for Q3.
Absolutely, and the reason why you're seeing that is because the valuations of all of these companies have soared to such levels that even the smallest or the minutest of the negative news is impacting the companies pretty strongly. In terms of broader markets as well, just look at companies like a Newgen. A 15% cut is what you're seeing on that one. Dixon, a 12% cut. In fact, Keynes has also joined the bandwagon with cuts of around 7 to 8% with regards to where Dixon goes. You have Zomato, which is down 10%. With Zomato, you have a peer, which is Swiggy, which is taking a beating as well. Motilal Oswal is down around 7 to 8% in trade. So that's the kind of pressure that is building in terms of markets. And what's holding on? Medanta, Paradeep Phosphate, Spandana, Avantel. These are few of the names which are holding up to gains in today's session from the broader markets. So interestingly, the way Harsh was mentioning, the minutest of the minute bad news is battering down the stocks pretty badly. And what's holding up is something which is not really material, right, in terms of the news. But overall, from a market's perspective, an interesting day of trade with the kind of cuts that we've seen from the day's highest levels, and then the recovery that has come in back again. And that's not only on the benchmarks, it's happening even in the broader markets.
Yes, you can see a bit of that happening in broader markets as well, especially in IT. Let's pull up the intraday IT, Nifty IT index, and you'll see the volatility that's there. Look at that. Just look at the way the index has behaved. Couple of times in the green and thereafter right now absolutely on the flat line, slight negative bias, but the way the index has behaved has been extremely difficult.
And with FMCG, you have healthcare, which has come into the support as well. Because if you see, when we started off the day, midday, you had only FMCG, which was resilient with gains of around 0.2%. You have you have pharma, which has joined the bandwagon as well to be in the positive. If you can just quickly pull up the Nifty Pharma Index, that will tell you, there you go. The pharma healthcare pack is now seeing gains of around 0.3%. So some positivity emerging. Now, whether that's a Trump 2.0 impact or not, we need to see. But right now, some moves coming in terms of Nifty Pharma as well. But let's quickly welcome in our guests. We have Kush Bora, founder at kushbora.com, as well as Nishchal Maheshwari, who's the CEO at I beg your pardon, institutional equities at Centrum. And you have Aditya Agarwal, head of research and investments at Invest4You, who will be joining in. Welcome to the show, gentlemen. Kush, first, let me come to you. The kind of volatility that we've seen with regards to markets today, we've seen a downtick of nearly around 800 points from the day's high on Bank Nifty, 300 to 350 points from the day's high in terms of Nifty 50. And a similar trend in terms of broader markets as well. What is your strategy if you have to look at Nifty and Bank Nifty now?
Hi, Hiral. First of all, very good afternoon. Hello, Nishchal. And a very good afternoon to all the viewers. Well, I think the trend is very clear. I mean, yesterday, in the morning show, we spoke of a sell-on rise kind of a market, while yesterday was a good day in terms of, market seeing some sort of a recovery. That is heavily sold into. But if you ask me, the star of the show yesterday and today is actually no stock. It's India VIX. If we were paying attention to that, then markets were rising, but India VIX actually closed with gains of 4% yesterday, climbing further on from there today as well. So there were hints that this rally might not perhaps sustain if the global cues were anything to go by, and they were, and that's why we saw some sort of a positive open. but that didn't last too long. At the moment, what I'm looking at is very clear, which is a sell on rise kind of a market. Any move closer to 23,300 to 23,500 band should be taken as an opportunity to sell. However, since like we've been speaking about, last week as well, this week also we're starting to see that, which is the 23,200 call and put. They're starting to see some sort of a triangle, straddle at play. Right now, it's the 23,300 call and the 23,200 put. So this could be the range where, on the downside 2300, on the upside you're looking at a 23,350 kind of a move. Within that, you could see spike in volatility, but very clearly sell on rise market. If the market breaks 23,000, then you could see a lower levels of 23,500 as well rather soon. But you could, there's a possibility that for a week or two, we might just consolidate with a negative bias.
And what about the Nifty Bank push?
Hi Harsh, I'm so glad you bring that up as well. Almost immediately in the conversation.
Always biased to banking, Kush.
oh yeah, of course, I didn't guess.
I believe we have Kush.
I am a little more cautious on the bank Nifty. We've been for a while, but I do maintain this that the volatility on this one is going to be way higher as we've seen in the last month or about month and a half. So the volatility, on either side is going to be higher on the bank Nifty. I think yesterday what we saw in the likes of HDFC plus whatever happened with Kotak was more of a short covering rally. Of course, Kotak was backed by result, but more of that. I think it is very likely that the bank Nifty might test and perhaps even break the 47,900 low that it had made just last week. So cautious on bank Nifty. But if someone wants to take an aggressive, volatile kind of a short trade, then bank Nifty is your index, because as I said, the volatility here is definitely going to be higher than the Nifty.
Right, so cautious call coming in terms of Bank Nifty from Kush. Aditya, welcome to the show. Are you also cautious in terms of Bank Nifty? And if yes, what is the level that you're tracking?
Hey, good afternoon, Neil. Good afternoon, Harsh. Thanks for on the show. I clearly believe, yes, I agree with Kush that there is weakness in the market, and it is becoming difficult to trade this market because today's trading session only, we were down 200 points, covered up that entire point gap, that correction, and then we are again down around 130, 140 points here. It is getting difficult and it is looking weak at the moment, and especially Bank Nifty, I believe, is on the verge of a breakdown from a bearish flag pattern. On the downside, immediate supports are close to about 48,600, 48,550. If that is broken decisively, I think the recent lows of 47,900 will also be taken out on the downside, and Bank Nifty can head to levels of 47,500. I think the biggest the index to watch out for where the correction can get deeper is the broader markets, the mid cap and the small caps. You're not seeing any kind of recovery there, and if that end of the market is to correct significantly, you will see a rub-off effect on the Bank Nifty and the Nifty as well. So slightly more cautious on the Bank Nifty, and then the broader markets, the mid cap and the small cap end of the market. Within Nifty 50, I think there will be pockets which might just hold ground because they have already witnessed significant correction previously. So Nifty 50 as a pack of total 50 stocks, I think some stocks will correct more, some stocks might not correct, might not see that kind of a correction. Overall, could be in a range between 23 to about 23,300 on the upside. But overall, markets do look choppy and weak. Doesn't look like it's bottomed out yet.
Okay, not yet bottomed out. Nishchal, your views, you believe there's still some room left for markets to bottom?
Yeah, definitely. But I just wanted to correct you guys. Basically, I've left Centrum around 6 months back, basically, and now I'm on my own. And that's why I just thought you should correct my positioning out there. Yes, I agree, basically. I think, basically, that a good accumulation zone is around 22,000 Nifty. That's a good place, basically, because at the moment you are still seeing on the fundamental side, after Trump's yesterday swearing in, I think now it is back to the basics. So the dollar still continues to remain strong. Rupee continues to remain weak. Interest rates are high in the US, and the interest rate cut is most likely not happening in January. And the first interest rate cut is likely to happen in the US is around May. So in that kind of scenario with a strong dollar, basically you are going to see pressure on all emerging markets. And it's just playing out in India again.
Nishchal, where do you see better value at this point? Because the broader markets have also corrected. So do you believe that value is still in the large caps or value is starting to show in the broader markets as well? And even within pockets, is there somewhere that you're starting to see better value?
So value has been there for a long period of time in certain sectors basically, but those sectors have not performed and they just continue to remain from value to deeper value. I think banking, FMCG are two sectors which have been value for some time, for the last 1.5 years, and it's just become deeper value. Those are the two sectors which I see. On the other side, basically, now I see maybe some amount emerging value in metals. That is a sector basically which has also corrected quite a lot now. So I think these are 2 or 3 sectors on the fundamental side which you can say that there is value.
Metals is a sector where Nishchal is seeing value. Kush, coming to you, what will your top picks be at the moment?
Sure. Just before that, a quick update on a couple of stocks that we've discussed recently, which is, Welspun Corp. We had discussed this late last week, and the second target on that one was 820. In the kind of volatility the market is witnessing, the stock did witness that volatility, hit the target, and then it's off, those levels. So if anyone's got that position, it's not a bad idea to book some profits because the stock has witnessed 5 positive closing sessions in the market like this. So Welspun Corp second target hit, that's an update. It's a book profit now if someone still holds. Also from yesterday, we discussed Apollo Microsystems. I think that was among the stocks, one of the stars of yesterday. We discussed this for a second target of 139. The stock hit a high of 155, closed with gains of 15%, a little more than that, and it's still trading at 145. So anyone did, listen into the conversation, buy this stock yesterday, then not a bad idea to take money off the table, at least for now. I think they're making handsome gains. Now, as far as the calls for today go, 2 of them, I'm still going with a mixed strategy of a long and a short, because I do find there are some areas, some pockets in the market which do continue to surprise us on the positive side. So Lloyd's Metal is a stock that we have discussed, in the recent past as well. The reason I bring it up is because it's still consolidating with a mild positive bias. So, in a market which is so volatile with a negative bias, the stock consolidating this way is actually a very healthy sign. I would reiterate the targets for 1455 and 1495 with a stop loss around 1375 levels. On the short side, again, a stock that we've discussed time and time over, which is PVR, but it continues to give, so why not? On the short side, the targets for this one are 1075, 1065, and 1095 is the stop loss. So Lloyd's Metal on the long side and PVR on the short side.
Aditya, your picks?
First, I'm going to buy and a sell. The first one is a sell call on Indigo. Looks like it's headed down clearly from here on the verge of a breakdown from a trendline support. If that happens, probably you'll see a sharp fall in the stock. So I'm going in for a target of 38.20 on the downside with a stop loss at 41.20 on the upside. That's a sell call on Interglobe Aviation. That's Indigo. The second is a buy on Colgate-Palmolive. I also am of the firm believer that FMCG from here on will see a significant upside, as Nishal was pointing out. So Colpal within that pack stands out for me. So I'll be a buyer in the stock for a target of 29.50 on the upside with a stop loss on the downside at 26.50.
Right, so those are picks coming in Colgate as well as a sell call in terms of Indigo. But shifting focus, you have the sugar pack, Harsh, that is in focus. You have the government which has gone ahead and lifted the export ban with regards to sugar season 24-25. What is interesting over here is that this comes in after 23. So a long gap where they were not allowed to export. The support that they will get in terms of where pricing is concerned is the key that we need to understand over here. And secondly, SAP prices tomorrow will probably see a revision because UP is expected to have a meeting. And thirdly, you have the ethanol pricing aspect, which is going to come into consideration as well.
Yes.
So 3 aspects where sugar is important for us. In fact,
sugar cane prices here.
Absolutely, that's the SAP prices that we're talking about as well. In fact, let's welcome in Atul Chaturvedi, Executive Chairman at Sri Renuka Sugars, to discuss more. Mr. Chaturvedi, good afternoon and welcome to the show. I'm sure it's a welcome step with regards to the export ban that has been lifted. We are talking about 1 million ton of exports. Firstly, how does this actually augur well in terms of sugar pricing? Because that is what was under pressure in the domestic markets as well.
No, you're absolutely right. In fact, the domestic values of sugar were under tremendous pressure. And this 1 million tons of export allocation will definitely ensure that the domestic values get lifted up. The only caveat in this is the export clearances or the allocation which the government has done, they should not withdraw it midway if the still values go up. And in fact, the objective of this was essentially that the domestic value should go up because mills were suffering big time. So I think it's a welcome sign, and the mills are definitely going to be welcoming this. And as far as the international values are concerned, so this is largely negative international values. But having said that, I think this talk of exports happening from India has been around for almost more than a month. So I think the international values have already factored in a million ton of Indian exports. So you could probably see a little bit of a bounce back on the international values, because whatever has to happen has happened. And the other good thing which has happened is that now the uncertainty has been removed. So now there's a certainty, otherwise it was too much of speculative activity was happening on the strength of India exporting or not exporting. So I think that would be all past now. Yep.
And so Harsh also joining in. So I wanted your quick take. How is this going to impact your numbers in FY26? So what kind of a change in numbers do you see, both with regard to value as well as volume, as well as maybe total revenue?
No, I'm afraid we are in a silent period, so I'll not be able to share any Renuka numbers with you. But having said that, my take is that the domestic value should go up by about 2 to 3 rupees a kilo, and they have already started inching up. So that should be positive for our overall revenue and profitability as well. And that would be true for all sugar factories, I would believe so.
Okay. Yeah. The other aspect I want to talk to you about is with regards to where SAP prices are concerned. There are reports indicating that tomorrow there's going to be a government meeting in UP as well. How are you looking at it? What is it that you're baking in? Because I'm sure the industry is not in for an increased SAP price because automatic pressure comes in terms of your costs. But what is your read?
In fact, honestly speaking, the prices had already been jacked up by the central government by roughly about 250 rupees a ton. So I see no reason why the prices need to be readjusted because of SAP or something. But SAP is only relevant as far as UP is concerned. Maharashtra and Karnataka, there's no move on those lines. And I'm sure the industry in UP is also resisting these moves, and the government there is quite practical. So hopefully they should probably desist from increasing the SAP values. So but we'll have to keep our fingers crossed because these are political decisions. One can't be too sure about them. Yeah.
And very lastly, Mr. Chaturvedi, in terms of the budget, any expectations that you have from the industry perspective? One, specifically ethanol is something that everyone is eyeing pretty closely, and there could be an increase in terms of prices. What is your take and what is your expectation?
As far as the budget expectations are concerned, I think nowadays industry doesn't have too much of an expectation from the budget, because most of the decisions actually get taken during the course of the year administratively. So our only request to the government is the ethanol prices need to be jacked up to the level of maize ethanol. Maize ethanol is about 71.86 rupees per liter, and we see no reason why cane juice ethanol should be around 65. So this is a demand of the industry for a very long time. And the other is increasing the minimum selling price, or MSP as we call it in our parlance, which was fixed about in 2018. And after that, about 35% of the cane values have actually gone up, or FRP as we call, has gone up. But still MSP, which has been fixed at about 31 rupees, has still not been increased. So these are two demands of the industry which are pending, but whether they'll be taken up in the budget or before the budget, we really don't know. We've been...
we'll wait for it. We'll wait for it. Absolutely. Thank you, Mr. Chaturvedi, so much for joining us on the show and sharing your views. So that's what is on the cards and how the export ban that has been lifted could be benefiting the industry. But let's quickly pull up Adani Energy Solutions on the screens. A 25,000 crore Badla Fatehpur HVDC project is what they've won. This is the largest ever order win for the company. The project will actually evacuate 6 gigawatts of renewable energy from Rajasthan to demand centers in the north. Taking this order into consideration, their order book will now stand at around 54,761 odd crores. And they will commission the project in the next 4.5 years on build, operate, own and transfer basis. So that's what we're picking up so far with regards to where Adani Energy Solutions is concerned. But let's quickly slip into a short break. Lots more lined up on the other side because markets have been absolutely volatile. So we will get you more strategies that you can trade on. Please stay tuned.
I present the budget for a historic...
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may come out with different changes in different sectors and how it may impact these sectors.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know Your Company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with.
Welcome back. You're watching India Market Close on NDTV Profit. Let's just quickly pull up Nifty 50. We are hovering around that 23,150 mark, cuts of around 0.8% coming in there. We did hit a low of around 23,111. Some bit of a bounce back that has happened to the tune of almost around 50 points right now. Advanced decline ratio absolutely favoring the declines on Nifty 50 with 36 declines coming in on 14 advances. What's putting pressure? Trend 5% down. Take Adani Ports, ICICI Bank, NTPC as well as SBI which are under pressure. What's holding up? Apollo Hospitals is up in trade. BPCL ahead of numbers is seeing a good move. Ultratech Cement, Tata Consumers as well as JSW Steel on Nifty 50. Let's pull up Bank Nifty as well as the sectoral heat map as well, because you had FMCG, which was the only sector which was in the positive. You have Pharma, which has also joined the bandwagon. Bank Nifty, there you go, is 1.3%. But in terms of the sectors, you have Pharma as well, which has gone back. But real estate, the top losing sector, followed by energy, banks, PSU banks, consumption, as well as media. If you see in terms of the broader markets as well, that is absolutely interesting because the cuts are and the movement is absolutely in tandem with the benchmark indices. 1.5% on the mid-cap index and the small-cap index, which is also seeing cuts of nearly 1.8%. But moving on to our new segment, Heard on the Street. That's what we are going to bring to you daily. We all know there's always a lot of chatter in the dealing room about what's buzzing and why. From today, in fact from yesterday, NDTV Profit has been bringing you all that and more with my colleague Somit Sarkar. Somit, what is it that you've heard today and which is absolutely important for the markets now?
Well, real estate, as you were mentioning, it's one of the top losers, sectoral losers in trade, and macro tech is definitely contributing to that. But what I understand after checking with multiple dealers is that there is some active buying interest seen in the HNI and the DI desk when it comes to macro tech. The stock has underperformed the index. The valuations appear cheap, and multiple triggers are expected to come in going forward, like they're entering new areas. Also, their lands are quite undervalued at this moment, and they could also overshoot their pre-sales guidance for FY25. That's what dealers are indicating. Apart from that, it's Dalmia Bharat. Macquarie came out with this note in the morning where they had upgraded a host of cement stocks. For Dalmia Bharat also, they had an outperform rating with a target price of 2062. We are seeing strong volume action in this counter. Overall volumes are more than 3 times their 2-week average, and what I'm understanding is that strong delivery-based buying has been seen in this counter in trade today. Now, when it comes to private banks, we are seeing some kind of a buying interest coming in specifically in the names of Kotak Mahindra Bank. In fact, dealers are indicating that there is a shift of investment that is happening among large players when it comes from ICICI Bank to Kotak Mahindra Bank in trade, some buying action that we are seeing. And lastly, it's Welspun Corp. Large HNIs have been accumulating this counter at lower levels. The stock is expected to be one of the major beneficiaries of rising crude oil production in the US market. Now, traditionally, if you look at US has been importing importing pipes from South Korea, Canada and Mexico, and if a tariff is imposed, definitely it will be positive for Welspun Corp coming in, and this baby drill program that Trump announced yesterday, this could meaningfully be positive for this oil pipe manufacturers, and this could also help them gain market share from the other mentioned countries.
These are going to be interesting names, and one addition I have for you in terms of Macrotech. What I was picking up a couple of days ago is their latest acquisition, which is the land situated in terms of Jutara Road, where they paid around, I think, 900 to 1,000 odd crores for acquisition. They've already managed to sell around 8 to 9 flats, each valued at around 150 odd crores.
Well, definitely they're going to overshoot their guidance.
Exactly, because they've already the amount that they've paid is already recovered. Now the additional flats is going to be a bonus where they don't really need to worry. So 100% in terms of what we're picking up probably should match up, and it's going to be interesting to watch out for on that front.
The company will also be reporting its numbers this week.
And you've got a buzz across real estate. We've seen a large correction in some of the real estate counters, and what we've also seen, and if we can pull up that chart, let's pull up maybe the 1-month chart of the Nifty Realty Index. Try and zoom in on that before we go and ask a quick question to Aditya with regard to Macrotech. Let's actually, there you go. So that's the 1 month, that's the 1 month, is that the 1 month? Yes, that's the 1 month chart. 14% down, Hiral, in the last 1 month on the Nifty Realty Index. So warrants possibly some amount of buying. Aditya, are you constructive real estate and Macrotech in particular?
Not really, Harsh. Actually, I believe there is more correction in offering as far as real estate stocks are concerned. Very few pockets within that space can look attractive. Maybe a Godrej Property or an Oberoi Realty. These are the only two names that stand out for me. Otherwise, as an overall pack, I believe there is more correction in the offering. Maybe we'll see a healthy correction both on the real estate, and if we talk about Macrotech developers specifically here, I think 1,050 is something that can be seen on a lot of Macrotech developers easily from here on. So that's about 100-point correction minimum that I'm looking at, and if that is broken, maybe a 970 can also can't be ruled out as well. So overall, as a real estate pack, I'm not too bullish at the moment. I would wait it out for some kind of deeper correction and then a consolidation, then maybe look at any of these names. And if I have to buy anything, like I mentioned, the top two bets for me are Oberoi Realty and Godrej Properties.
Right, Godrej Properties, Oberoi Realty, two top bets for Aditya. In fact, let me also get in my colleague Anushi, who's actually decoding what's happening with the Oberoi Realty in trade. I mean, clearly the stock has been under pressure. What is it that you're picking up so far, Anushi?
Right, Hiral. So now if you look at the financial metrics number, they have remained majorly, we are seeing a good set of numbers, but it's the key operational metrics wherein we are seeing some kind of pain. That is what is reflecting in the stock performance in trade today. The stock currently down about 7.6%. Now the company missed its pre-sales estimates. This is despite the 144% of a growth that we have seen in the third quarter. This is due to a drop in the velocity of their ongoing projects. Now now if you look at the street consensus, they were expecting higher sales in what they assumed in the 361 West project, which was on a 4-quarter low as well, if we are speaking about that. In fact, if you see the previous 3 quarters, they've clocked in a strong set of numbers. But the 144% of growth number that we are looking is on the back of the sales booking of the Thane project. It's a Pokhran-Thane road project that is saying. So 2,500 to 3,000 crore was what was the estimate in terms of where the pre-sales number is. We are looking at 1,900 crore of an odd number in terms of where the pre-sales are concerned. So higher bookings for the Pokhran road project, objecting to it, offsetting the kind of the number that we are looking at. But what brokerages make out of it? Currently, Axis Capital, they maintain their reduced call, and this is with a target price of 1,805. This is the most bearish case scenario that we are looking at, a 10% of a downtick, while UBS and Morgan Stanley have a neutral and an equal weight rating with a 11.4% and a 2.9% of an upside respectively. Nomura is the one with the most bullish on this stock performance. They are seeing a target of 2,500, which is more than a 25% of an upside. They said that despite the pre-sales estimates miss which has taken place in Q3, these are the kind of variations that can take place on a quarter-on-quarter basis, and we should not be reading a lot into what the projections have been for the pre-sales number. Of course, what we should be watching out for today is the company's growth strategy, which includes aggressive opportunities outside the MMR region. Other than that, the upcoming project launches in Goregaon, Borivali and Thane is something we should be watching out for. The timelines of those is something that we could adhere to what the management has to say in a conference call slated today at 4 p.m. Fund-raised proceeds. Now, if you go back and check, the company had made a huge fundraise, and the proceeds are expected to be used for acquiring huge land parcels. So what is the GDP potential of these land parcels is something that we should be tracking out for. And of course, the con call today is slated on, this is after the market hours around 4 p.m. So the commentary on what is happening in terms of where the 361 West project is concerned is something we will be tracking, and how the company is planning its FY25 guidance forward. So this is overall what we are seeing for Oberoi Realty in trade today.
Absolutely. The conference call today post-market hours becomes absolutely important for Oberoi Realty. In fact, let me also welcome in Chakri Lokpriya from Red Strawberry. Chakri, good afternoon and welcome to the show. Before we even get into markets, your read in terms of real estate, because clearly it's corrected quite a bit from its recent highs, 20% down, almost 15% down in the last 1 month. What would you advise and how are you looking at the space?
The whole real estate sector had moved in the last several months on expectation that, there will be some amount of inventory clearance had happened. The raw material prices had come down, and, and therefore their books were looking slightly stronger. As a result of all this, the valuations have run up, expectations are high. And so, with now interest rates are key for the stocks to move up or down. So against that backdrop, I think given the high valuations, I think we'll stay away from them for some time and wait for them to correct some more.
Okay, and Chakri, some of the smaller names within the real estate space, more skewed towards Bombay. For example, a Suntec is doing very well for itself. The 7% lower on Oberoi also we are awaiting commentary on. You believe that maybe some positive commentary could well turn your view on this one?
Both these companies are, largely dependent upon growing their order book. In other words, acquiring land parcels and then converting them. So the pace of that is very vital for these companies. And, the balance sheets are okay. Yes, they'll incur a certain amount of debt. Both companies are slightly different in their target clientele. Suntec has slightly better mix. So therefore, slightly better margin. But net, given both the stocks have run up in expectation of what they're supposed to do. And therefore, I think even for these companies, I would stay back because the pace of order book growth is very important. Land parcel growth is very important.
Right. Kush, your view on real estate?
Very similar. Haven't been too optimistic for a while. There are very few select pockets, and that too not in the developer space, that are doing well. Once again, Anant Raj, this is one stock which has a slightly different angle to it as well. That's the only stock, if you see, has had a standoutish performance. Other than that, a lot of these names have shown some spikes but fizzled out. So I would stay away from these pure developer plays. Technically also, all of them in fact haven't really come to those oversold territories from where you could at least play for a trading bounce, right? So I will wait and watch. Anant Raj, because of a couple of things going for it, is the only one that stands out. Other than that, I think I'll stay away from some of these names.
Anant Raj stands out and stay away from some of these names. In fact, with this sector, Aditya, if I have to come to you, let's not take real estate alone. If you have to take real estate ancillaries then, how would you look at that space? Any topics or anything where you have a sell call on the ancillary side?
So, as far as ancillary space is concerned, it has again become very volatile and very stock specific. Sometimes stock do show potential and then it just fizzles out. If we talk about the Green Ply, Green Lamp, Century Ply, all of them are not bad. They do look interesting to me. But again, there has to be some kind of a deeper correction in them and then maybe I can look at it. If I talk about specifically one stock, Century Ply, something that for me stands out definitely, and I would be a buyer here. At least look to buy the stock on declines, if not at current levels, maybe closer to about 750, 800 is where I would look to buy the stock. I'm looking at a target of 1,000 plus on Century Ply. The same holds true for Greenlam. I think this is also one stock, Green Panel, I'm sorry, which looks interesting to me. On declines, maybe stock can be bought around 300 odd levels and can be looked at on the upside. Closer to about 400 odd levels. So definitely the ancillaries stand out for me, not the pure play developers. Within that, Century Ply is the top bet, but maybe you can look to accumulate the stock slightly on decline. The tile stocks are not doing at all anything. Look at Kajaria, look at Serra, look at Somani, all of them have underperformed. I will wait out for some more time before I venture into any of these tile stocks.
Okay, yeah, as we're speaking, Hiral just highlighted we've just slipped below 23,100. So that's the other thing to keep your mind on. But let's take a look at the top 3 stocks on our radar today. Varsha gets us that list. Varsha.
Thank you, Harsh. Let me start with Suntech Realty, wherein the stock is buzzing on the back of Q3 numbers. Let's see what stood out for this quarter. The pre-sales were up 40%, collections were up 26% quarter on quarter, but down 23% year on year. While the net operating cash flow surplus improved to 1,700 crore versus 1,400 crore in Q2. They are targeting 30 to 35% growth in pre-sales for FY25, and they aim at 60,000 crore GDP potential in upcoming years. Next on my list is MCX, wherein revenue is up 5.53% at 300 odd crores, while margin at 64% versus 63% last year. Well, we do have Morgan Stanley on MCX, wherein they've maintained underweight with target price of rupees 3,715. They say that the Q3 core EBITDA was in line, higher SGF contribution cost, PAT miss. This will be the first quarterly call since the new CEO joined, and they await commentary on her outlook on product launches, cost, etc. While they find Morgan Stanley find current valuation stretch given low conviction on sustainability of revenues. Then on my list is you have
NDTV ऊपर कर दो भैया NDTV.
Mela clearly giving his views, but in terms of what what's the kind of impact the Kumbh Mela would be having as well in terms of India Inc. There is a bit of an audio glitch that we are picking up right now. We will come back to it in terms of Mr. Gautam Adani's commentary at the Kumbh Mela. You have media which is present over there waiting to take his views as well. So that's with regards to the commentary that we're picking up from Gautam Adani. Though we were not able to hear it, we will come back with it in terms of what he has to say. But very quickly, let's just pull up the markets. We are again at the day's lowest levels. 75,700 is what the Sensex has tested. Let's just pull up Nifty 50 on the screen right now. Just a quick Nifty 50. We have broke the 23,000 mark, and if I'm not mistaken, June was the month in 2024 we had seen these kind of levels in Nifty 50. In fact, let's just quickly hear what Gautam Adani had to say at the Kumbh Mela as well. We'll quickly listen into that conversation.
माँ गंगा का आशीर्वाद लेना उससे ज़्यादा कुछ नहीं है।
सर, एक महाकुंभ तो हो गया, बताया जा रहा है कि जीत की शादी है, तो क्या उसमें भी देश दुनिया से लोगों का एक महाकुंभ आएगा? क्या क्या तैयारियां हैं?
नहीं, देखो ऐसा है, जीत की शादी 7 फरवरी को है। देखो मेरा उछेर और एक्चुअली हमारी कार्यशैली जो है एक कॉमन पर्सन की तरह है, सामान्य वर्ग की तरह है, और जीत की शादी मैं यहाँ जीत भी आया था तो वो माँ गंगा का आशीर्वाद लेने ही आया था। और जीत की जो शादी है बहुत ट्रेडिशनल की तरह से, बहुत सिंपल और ट्रेडिशनल वे पे होने वाली है।
क्या सेलिब्रिटीज और जाने माने अधिकारी भी आएंगे वहाँ से?
क्या वो सेलिब्रिटीज का महाकुंभ होने वाला है, ऐसा समझ सकते हैं?
बिल्कुल नहीं होगा, ये बहुत ट्रेडिशनल वे पे फैमिली के अंदर ही होने वाली है शादी।
सर एक सवाल और है, आप उत्तर प्रदेश काफ़ी बार आए हैं, आपका काफ़ी बिजनेस इंटरेस्ट भी है यहाँ पे, एक बार फिर आप यहाँ पे रिलीजियस रीजन की वजह से, तो हाउ इज इट टू बी
नहीं, जो ऐसा है कि उत्तर प्रदेश में जो अपॉर्चुनिटी है वो बहुत ज़्यादा है। इतनी 25-27 करोड़ की आबादी है और डेवलपमेंट की जिस दिशा में उत्तर प्रदेश सरकार काम कर रही है उसमें अदानी ग्रुप का कंटिन्यूसली योगदान रहेगा। तो हम लोग कमिटेड है उत्तर प्रदेश में ज़्यादा से ज़्यादा इन्वेस्टमेंट करें।
थैंक यू सो मच सर।
थैंक यू सो मच सर।
थैंक यू।
Absolutely looking at good investments in the state of Uttar Pradesh, taking into consideration the kind of development that they're seeing. And clearly he's indicated that there is going to be no Mahakumbh at his son Jeet's wedding of Bollywood celebrities. 7th Feb is what he's looking at, and they'd both come to seek blessings of Ma Ganga. So that's what we're picking up so far on a lighter note. But very quickly, Harsh, markets clearly slipping out.
Yep.
I think these are going to be interesting levels that we should be watching out for. We are breaking the 23,000 mark. Let's just quickly look, go across to Kush as well. Kush, 23,000 broken in terms of Nifty 50. What are you indicating, or what are you seeing from here on? Further pressure?
For sure. We did speak of 22,500. I'm not surprised by the direction of it. I'm only mildly surprised by the intensity of this move. One just thought that perhaps 23,200 straddle might hold on, but that's giving way. I think there's no point holding on to long positions if anyone still got them. But yeah, I mean, if we close below the 23,000 mark, then you could actually consider, break of a support, a breakdown of the support, and a further short positions for levels of 22,750, 22,500 as well, with 23,300 thereabouts being your stop loss. So we did speak of sell-on rise and the kind of cautious note that the market is sitting on. But yeah, as I said, the intensity of it is slightly surprising, not the direction.
Intensity surprising. Let's pull up the contributors also. Try and see what's really contributing to the fall. And let's pull up even the heat map. Gives us context on, there you go, just a huge reversal of sorts. We had almost another 10 odd stocks sitting in the green till just about an hour or so back, and now we've got that sharp reversal and the breadth looking sharply weaker as a result of that. So clear pressure coming through. Let's also pull up the Nifty Bank. There you go. The advanced decline also not looking pretty at all. Now more than 4:1, nearly 4.5:1. And the Nifty Bank, there you go, 1.8%. Even that one is sitting at its day's lows. So here, not a pretty picture. Let's actually even look at the broader markets. Let's try and mark those out as well. Is the gash as bad? At least the last percent or so has really been steep. There you go. The Nifty mid cap also 2% lower now, and the Nifty small cap 2.2. Yeah, so it's been 0.5% across the board at the very least. So yes, looking tough at this point. 3% lower on ICICI, 2.5% lower on Reliance, 0.5% plus on HDFC Bank. But with that, Aditya, Kotak, after the kind of move it showed yesterday, what's the sense like today? Obviously a muted sort of move, but what's the sense like on Kotak?
It's back at the upper end of the range, Harsh, and we know that 1925, 1930 happens to be the upper end of the range, and stock time and again hasn't been able to take that out. But I think this is time when Kotak should take that out, given the fact that it has seen a massive underperformance, and if fundamentals do support the stock a bit, I think this could be one stock, a dark horse within that entire Nifty 50 pack that I was talking about. Some might hold ground and then see an up move. Kotak could be one of them. So 2200, 2400 is what I'm eyeing on Kotak. But again, it's not a trading bet at all. It's more of a positional trade that one has to take. So two levels that to watch out closely. One is 19 1925, 1930 kind of a level. If that is taken out, then you latch on to Kotak Mahindra Bank. Or maybe if it corrects all the way back to 1800, 1780 kind of a level, then you latch onto the stock. At current moment, maybe you can just wait it out for either a breakout or a pullback to support levels to go long on Kotak Mahindra Bank. But yes, I do believe this could be one stock to keep a very close eye on, and you can have a good up move coming in the next 1 quarter.
Kotak Mahindra Bank, a stock to watch out for. HDFC is one which is contributing to the kind of cuts that we are seeing in today's session. On Bank Nifty with the ICICI Bank, and you have HDFC Bank that will be reporting numbers tomorrow as well. So watch out for this price pretty closely. But moving on, one stock that is cracking in trade today is Dixon Technologies. It's very interesting, Harsh, to see a Dixon Technologies because the earnings optically don't look bad at all.
Yeah.
Brokerages also have been positive in terms of their coverage, and on a consensus basis, you've seen a target price upgrade that has happened to a certain extent, right? So it's interesting and a really difficult task for a researcher to understand what's actually going on. In fact, Puneet has done the crunching in terms of what actually went wrong with the Dixon Technologies. Puneet, over to you. A 14% cut right now.
Well, that's right. You know, it's seen under pressure, but as you rightly said, Q3 earnings were a beat across all fronts. Revenues grew 117%, profits were up almost 120%, and they maintained their margins of about 3.8%. That was a positive. But let's look at the bull as well as the bear case of what might have, cracked the stock in trade today. They've of course they are looking to enter into the semiconductor foray of components, specifically into display fabrication that will expand the market for the component side. It's important to know that the company had previously mentioned and guided they will only look at the non-semiconductor components for electronics that they manufacture. Now, of course, they're entering the semiconductor foray as well, and this will be very capital intensive. And that's why the capex for their share only will be roughly 7,000 to 8,000 crores. Overall, the company has guided that this new foray will require 25,000 crores in capex over the next 3 to 6 years, of course. And out of that, roughly, a lot of it is subsidized. So let's look at the second key aspect of the bull and bear case as well, that while, they are going to set up a joint venture for display fabrication, which will take half of the capex from the company's side, it's still expected to be roughly 5 times its annual capex. Currently, for FY25, they've guided between 600 to 800 crores. Assuming that, the display partner has a 50-50 share in a joint venture with someone like a Dixon Tech, it will still have to, commit roughly 4,000 to 5,000 crores of capex just for this one venture. It's 5 times its annual capex currently, and that will, put a strain on its financials as well as its working capital as well. The other aspect is the pressure on its return on capital employed. It's roughly over 40% now, and the new unit will have lower return on capital employed as well. Currently, when you look at the third bull and bear cases, of course, the mobile segment has been, growing over 150 to 200% in each of the last 3 quarters. This quarter also was roughly 190%. But the other segments, such as consumer electronics, as well as the home appliances segment, has been affected majorly. Consumer electronics down 32%. While on an overall revenue basis, it's only 6 to 7%, but on a margin basis, it's above, roughly about 25%. So that has been, affected due to weak demand. And finally, on valuations, like while the new foray of the company will give company double-digit margins, much higher than the 4% that they do currently, it is of course going to be very capital intensive. On the bear side, while it might not be a direct correlation, the valuations is something that's another thing to watch out for. After the correction is somewhere trading around 78 times price to earnings for FY26. They are expected to double their revenues in about 3 to 4 years. So the price to earnings goes down by half in that aspect. But the new foray is something which has brought more questions than answers, does expand the addressable market, but pressures on the capital, on return ratios, as well as capex will be something to watch out for going forward as well.
Thanks, Puneet, for getting us these details, because this is an interesting take. In fact, Chakri, let me come to you. Would you go with the bull case or the bear case for a Dixon Technologies? Because with this, you have a Keynes also, which is trading under pressure.
The core electronics business is actually kind of projected to grow at such a fast pace, but that growth rate has slowed down quite dramatically. And that's largely cyclical in nature. But when a company's whole valuation is dependent on really, really fast growth, and that's electronic growth slows down, and then the stocks will correct, which it's correcting now. And on top of that, then you have the semis. Semis is a great business, but capital intensive, very long time gestation periods for them to break even. So given the stock is so expensive, given its existing business, I'd rather stay away and wait for it to correct some more.
Right, so that's with regards to Dixon Technologies. Kush, very quickly, if you check the F&O position as well, the MWPL for a Dixon has gone above 100%. Do you see a possibility of it ending the F&O ban tomorrow?
Possibility. If it ends there, it's a certainty. This is going to go in the F&O ban. If that's how it closes, and in all likelihood, it just might. Also, just technically, I think the support zone for this one comes in at 14,500, 14,600 thereabouts. Tomorrow, if you don't see a follow-through move, then I think that this just might turn out to be a buying opportunity. But don't preempt because the markets are also in a bit of a tizzy, and so is the stock. Very bad combination. So hold up. But if it does hold up around the 14,500 mark or so, then this dip might just turn out to be buying opportunity. That's a medium-term support zone for the stock.
Okay. So those are some views coming through with regard to Dixon Tech, but on the sidelines of the AIBI annual convention 2024-25, my colleague Charu caught up with the founder and managing director of Prime Database, Prithvi Haldia and Pranay Haldia, who talked about India's IPO exuberance and on valuations of IPOs. Listen into a slice of that.
Last few years have been extraordinarily good for the IPO market for two reasons. One is that the secondary market has been either buoyant or stable. Because an IPO market requires a stable secondary market or a buoyant secondary market. If the secondary markets are in bad shape, then IPO will not happen. We have seen that historically. Because if there is no interest in the secondary market, people will have very little interest in buying new stocks. Number two, the reason is that a lot of companies that had been matured by PE and VC investors or who have gone through one or two business cycles are now entering the market. So gone are the days where you could think of a greenfield project or think of an IPO today and do an IPO tomorrow. Now, these are all companies which have been in the business for the last 5, 7, 10 years. There's a lot of money which has come in from private investors, VC firms, and so there's a lot of due diligence which has gone through, a lot of governance has gone through. So these two factors have actually led to the current growth. Also, most of these companies have been cautious about their pricing. So while there have been some accusations that IPOs are overpriced, etc., we have found that most IPOs actually are listing at a premium. Now, when the returns are good, you find more investors coming in. That would lead to more IPOs. So this is a cycle which will go on. So as buoyant secondary market, good companies entering the market, listing at a premium, these three things will take the markets to a different high. So what we've seen last year is phenomenal, but what we could see in future could be mind-boggling.
Well, as the presentation also showed this morning that in comparison to industry peers also, a lot of IPOs have been fairly valued. But I think the proof of the pudding lies in not just the day of listing, but also the post-listing performance. And, the average gain on listing in the last year has been close to 30%. But even if you look at, the performance of IPOs subsequently, IPOs continue to trade upwards, and the average gain that they've given is close to 50%. In fact, we did this analysis recently wherein we looked at IPOs from 2019 onwards, and what we found was that on an average, IPOs which came out in the year 2019 have given an average return of 500% till now. So, I think there's a lot of negative commentary around valuations. I think we have to be cognizant of the fact that no company or merchant banker wants the IPO to fail. So the pricing of the IPO has to be kept in a manner which is attractive and which attracts a subscription. Now, if there is even 1x demand of the IPO, it means that there was enough demand for that IPO at that particular price. Obviously, after it gets listed, a stock becomes, an IPO company becomes like any other listed company, whose share price will go up and down on the basis of how the company is performing, how the sector is doing, etc., etc. So, to continue to judge an IPO 6 months, 1 year, 2 years later on the basis of its IPO price also is slightly unfair in my view.
This January, the world will come together at the World Economic Forum at Davos to bridge differences because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
It's nearly time for Budget 2025, and what that means is that there are a lot of proposals that are coming through to the Finance Minister, and among them, there are proposals from the mutual fund industry as well. I'll talk about three key changes that they are suggesting. One is a rollback in the tax rates that was announced last year. Of course, last year, the capital gains tax, long-term and short-term, was increased to 12.5% and 20% respectively. The mutual fund industry is saying a rollback to the previous rates would be beneficial because it would incentivize more investors to come through and invest, and those people that have come into the investment fold into the mutual fund industry over the past couple of years will be rewarded for their patience and for their investments. The second proposal has to do with the tax treatment on debt mutual funds. Currently, all capital gains emerging from debt mutual funds are taxed at slab rate, and what that means is that depending on which income slab you fall in, if you're in the highest tax slab and you're paying 30% on the income above a certain threshold, your gains from debt mutual funds are also taxed at 30%. That wasn't always the case. Long-term capital gains came into effect after a period of 3 years, and they were taxed at 20% with indexation benefits. Of course, that doesn't remain the case anymore. So the mutual fund industry is asking for a rollback to the previous tax treatment because they say that the debt market in India is growing, is emerging, and it needs to be incentivized. The third change that they're suggesting has to do with the income distribution schemes. Of course, there are two types of schemes in mutual funds. One is the growth scheme, where all gains are reinvested by the fund manager. And in the second case, which is the dividend distribution scheme as it used to be called, the income is distributed on an ongoing basis to unit holders. Now, the thing is, income above 5,000 rupees that is distributed in this manner will have to have tax deducted at source, or TDS, as things stand right now. And the mutual fund industry is suggesting that this threshold be raised to 50,000 rupees, and they expect that this will benefit a lot of people because they won't then have to have tax deducted at source. Of course, there are more proposals that they've made, but we'll see what the finance minister takes up when she presents her budget for 2025.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy?
Welcome back. You're watching India Market Close here on NDTV Profit. Let's take a look at Zomato now, because that one has been under pressure since the morning and 10.5% lower now. The stock has taken a bit of a beating. Street found the delivery giant's third quarter numbers a bit too bitter, as profits have fallen nearly 60% on a YOY basis. And Mahima is here, who tracks the space closely, to understand what exactly has gone wrong, Mahima, for Zomato.
Right. So a couple of things that are not working right now for Zomato. Let's break it down one by one. The first one being that they've kind of raised their guidance, saying that they will do the 2,000 dark store limit by FY26, which they now said that they'll do it by FY25. But before that, food delivery growth has been stagnant for them for the past few quarters. In terms of the losses that are expanding on the going out business, that is also growing every quarter, and this going out business also includes their ticketing business, which is seeing the expansion in terms of losses. The elevated capex that I talked about earlier, that they've kind of revised their guidance. They'll now do 2,000 dark stores in 2025, which will lead to an elevated capex, and this will lead to losses, and this will go on till the next 2 quarters is what the management has said, but it'll be a wait and watch situation as to how these losses pan out, over the next, few quarters. Even the competitive intensity is kind of, going to impact the profitability and margins. There's competition coming in from Swiggy, which is a listed player, and in the quick commerce space, Zepto from the unlisted space is also, giving tough competition to the quick commerce space. Moving on to the next point, the valuations were never cheap for Zomato. Valuations right now, the current trailing P itself for Zomato is 528, and it doesn't get cheaper even by FY26 going forward. So these are the couple of points as to what is going wrong with Zomato. Now, in terms of the brokerage radar, all of these brokerages have still maintained their buy ratings towards Zomato, but a few have cut their target prices, and a few have also cut their EPS estimates because of the kind of expansion that is taking place. Now, UBS is maintained buy with a target price of 320, BofA with a target price of 375. This is the highest target price amongst all the brokerages. Macquarie has cut it down to 290. Nuvama has cut it down to 300. Nomura has maintained buy with a target price of 290. Now, what next for Zomato? Now that Q3 has not panned out very well, what next? First of all, the execution of these 2,000 dark stores will be something to watch out for. The execution of 10 minutes delivery will also be a key factor that will kind of determine as to how much the losses will go further or how much will profitability be impacted. For how long will the losses continue? This is a question mark. They've said 2 quarters, but we'll have to wait and watch to see as to how long they last. How long will it take the company to achieve the 5% margin mark? The company has said that they will achieve the 5% margin mark soon, but how soon will that be is a question mark. Moving on to the areas of growth with food delivery. Now that the food delivery segment has stagnated, we'll have to see as to what their next focus area is, which is quick commerce, where they're expanding. But that being said, we'll have to see with respect to the kind of execution that takes place. Now, how will Zomato outpace competition is also another question. We are seeing that intense competition in the quick commerce space is coming in from Swiggy and Zepto as well. Are Blinkit's growth targets achievable? They've said that they'll grow 100% in FY25 and 26, but will these be achievable with the kind of expansion strategy and expansion plans they have is a question mark. Now, in terms of Swiggy is also tanking on the back of how Q3 has panned out for Zomato. Let's see as to how this will have an impact on Swiggy. Now that Zomato has raised its guidance, dark store guidance, we'll have to see, because it will put a pressure on Swiggy at the end of the day. Swiggy is already running into losses, and if they also plan to compete with Zomato in terms of adding dark stores, it will be a tough task for them. And right now, if they are 4 to 5 quarters away from turning into profitable, it will take a longer time to turn into profitability for them. Plus, they have a disadvantage when it comes to the cash, because they have around 10,000 odd crores of cash versus that of almost 20,000 crores for Zomato. In terms of the Swiggy's market share, we've seen the last 2 quarters they've lost market share. In comparison to that also, we'll have to see as to how this quarter will pan out for Swiggy. In terms of the competition, again, like competition is being hurt by Zomato, Swiggy is also getting hurt, and margins and growth will also remain impacted. Swiggy is also juggling into too much at once, is something that will be on the watch out for, because they're getting into ticketing business, they're getting into the sports management business. So we'll have to see as to how they will execute all of these simultaneously. And like I said, at the end of the day, for both Swiggy as well as Zomato, execution remains very critical. So this is the overall impact as to how Zomato has panned out in Q3 and how this will impact Swiggy also, and talent war also persists for both of these counters going forward as well.
Okay, Chakri, firstly, thank you so much, Mahima. Chakri, your sense, Swiggy, Zomato, neither?
I would say neither right now. As trading at Swiggy is trading at a huge discount to Zomato. So if you have to buy, then it is Swiggy versus Zomato. And both these companies are the leaders. They, pretty much the two names in the game. If one of them expands dark stores, the other will. Quick commerce is not just restricted to these two. All the big boys, Amazons of the world, are also getting in. But Swiggy, they were, at the time of IPO, it was well known that they're going to take several quarters for them to hit profitability. So if you have to buy quick commerce, then it is Swiggy, because it's a far cheaper stock than Zomato.
Right, so that's with regards to Swiggy as well as Zomato. In fact, Aditya, let me come to you. I think we've just lost Aditya. Kush, on the charts, where are you seeing strength from here on? Because we are looking at, technical analysts are saying that probably Zomato could be a good entry level at levels of 200. So waiting for some correction there. But if you have to look at both these stocks, what would you say?
So, just before that, I know Aditya Shah is not here, on the panel today. But I would like to still congratulate him that, I remember this was around 270, 275 odd mark when he very boldly, as he always does, says, I'll buy Zomato around 200 levels. So kudos to him. And perhaps, the next time he's on air, you should ask him whether he'll buy it at these levels or not. But a splendid call by Aditya. I think we'll wait now. We were looking at 240 around, thereabouts as being a good support zone. I think once the stock retraces to those levels, or that is also the 200-day moving average, by the way. So that will be the first litmus test for the stock to cross. Once it moves higher, closer to 240, that's when you start to accumulate from a trading perspective. From a medium-term perspective, I think you should wait purely because the volumes on the downside, especially today, are significantly high. While 200, 205 remains a good support zone, it's important to see whether the stock respects that or not, especially in a market scenario like this. So don't be in a rush to buy. Let the dust settle. I think around 200, 205, there is a support zone. If that is respected, then this might turn out to be a very good buying opportunity.
Very interesting. You're right, Kush. Aditya did make that call, and I too was remembering him today morning, given the fact and given the manner in which the Zomato stock reacted today in that sense. Fair point. Now, Kush, if I were to ask you to take a technical call with regard to some of the private sector banks, you will have HDFC's numbers come out tomorrow. You already have had Kotak as a stock make a phenomenal move, and I'll come to Chakri on the fundamental side of it. But what's your sense like?
Pressure very clearly, but I'm still a little more constructive on HDFC Bank. Now, I'll give you the reason as well for that. If you see for a while the stock hasn't really done much for many years now, before breaking out, of that 1750 resistance band, the broad range for the stock used to be about 1550 to 1750. The stock is bang in the middle of that range right now. It's taking support at some of the key, support areas. Although it's struggling to hold on to the 200-day moving average. If you go by levels and not the moving averages, then the stock is very close to the support zone of 1600, 1620, which is the intermediate support zone. So I'm a little more constructive. If you've got a 6 to 12 month kind of a horizon, this once again might turn out to be a good buying opportunity. But that said, just before the event, just before the result, like Kotak surprise on the positive side and some of the IT stocks on the negative side, I don't recommend, making a result play or a result trade. So hold your horses. Tomorrow after the event is over, if the stock slips further but does hold above the 1600 mark, you might just get the stock a little cheaper. So I'm a little more constructive on HDFC Bank because it seems to have at least found its feet in the near term. So hold up that purchase for one more day.
Okay, and Chakri, your view, private sector banks?
Let them report tomorrow. I think, their loan growth will still be kind of weak, and that kind of actually baked into their numbers. So if it turns out to be that, a slowing loan growth, it's kind of the NIMs impacted, going down a little bit more, provisions kind of stable, then the stock will pretty much tread water and do nothing much. On the other hand, if you see like what happened to Axis in the case of poor numbers, then in that case, I think HDFC Bank can go down further. As far as ICICI concerned, so they'll get hit a little bit because of their credit card exposure. Consumer is weak, so therefore I'll still stay away from ICICI.
Kotak, Chakri, not constructive despite the numbers?
Kotak, has done its one-day bit yesterday after treading water for the last 2 years. The RBI removal ban will help it a little bit, but the valuations are quite expensive. So maybe it'll move gradually up, but valuation-wise, I don't see any much triggers in taking the stock much higher.
Chakri, one more aspect I was just looking at right now is in terms of the volumes. M&M, L&T, Reliance, ITC, HDFC Bank and Godrej Consumers. All of these names have had a huge block today. All of being nifty heavyweights. Does this give you an indication that probably we are going to get a heavy sell figure from FIs today and there's a high possibility of a yen carry trade?
It's fairly clear that the rupee is headed lower fundamentally for various reasons. Trump trade and tariffs against the BRIC countries will, take away from rupee trades and inter-BRIC trades. So given all that, imports will get expensive, etc. Tariffs slightly unknown. So I think the heavyweights will be the first port of call to sell. But within that, if you have to buy, I'll buy the pure energy ones, Reliance Industries, Adani Energy, because we are going back to fossil fuels, and these companies do pretty much that, and they would benefit from it.
Right, so that's the pick coming in. Adani Energy is what Chakri is looking at. But let's shift focus. The announcement with regards to where the February MSCI rejig is concerned is set to be announced on the 12th of February. Soman brings us the details on what is on the cards in terms of the rejig. Soman, over to you.
Well, we need to keep an eye out for a host of stocks when it comes to the MSCI February rejig. The announcement regarding the same will happen on Feb 12th, but the cutoff date to consider which stocks either move from the small cap index to the standard index or get included or get excluded from the MSCI indices, now that cutoff has actually started, and that is from Jan 28th to Jan 31st of 2025, and it's on MSCI's discretion which date they want to choose. So we need to keep an eye out for how the stocks are closing between these dates. Now the adjustment of the inflows or outflows regarding whichever stocks get included will happen on Feb 28th, so that's still time away, but now we need to focus on the cutoff date. Now as per Motilal Oswal, there are no fresh inclusions that are expected to happen in the MSCI standard index, but couple of stocks have a high probability of moving from the small cap index to the standard index, and couple of stocks have a medium probability of moving from the small cap index to the standard index. So it's Paytm and Coforge which have a high probability of getting moved from the small cap index to the standard index, and if that happens, then the inflows in couple of these stocks are expected to be anywhere between 180 to 400 million US dollars, which is nearly 2 to 8 times that 20-day average volume. Apart from that, it's Coromandel International and Uno Minda which have a medium probability of getting included or moving from the small cap index to the standard index, and if that happens, then the inflows could be anywhere between 150 to 160 million US dollars, which is nearly 17 to 19 times that 20-day average volume. Now, apart from these four stocks, we also need to keep an eye out for on Zomato because of the recent QIP, the fundraise that the company had done. The weightage in the MSCI standard index is expected to move up by around 0.11 percentage points, and if that happens, then there could be an inflow of around 105 million US dollars. So keep an eye out for these 5 stocks so far in trade.
Okay, so those are some stocks to keep on your radar. Kush, BTST for the day?
Harsh, it's an STBT today, and it's also on lines of what we were discussing a while ago, which is something from the real estate space, if not the developers, the ancillaries. Astral is a stock which has massively underperformed given negative returns for some time now, continues to reel under pressure. Although we are seeing some sort of a positive divergence on the daily charts, the volumes aren't really corroborating that. So I will continue to have a short view on Astral. Someone can use the January futures if they want to make this trade. 1455, 1440 are your targets. 1485 is where you place that stop loss. Just a quick update on PVR Inox. When we started the show, about 1085 was the level and 1075 was the first target. The stock's already very close to that. If someone's got a position on PVR Inox, listening to us at the start of the show, not a bad idea to put a trailing stop loss or maybe even take some money home, partly on PVR Inox. If you're a more aggressive short trader, then hold on for a target of 1065, which was the second target.
Right, so that's with regards to PVR Inox and Astral that you are watching out for. Chakri, I know, I shouldn't be asking you a BTST, but from a fundamental perspective, in the last 5 minutes of trade, what would be your top bet?
If you have to buy among the large cap, would buy Reliance Industries, because it's an oil energy company and stock is an inexpensive stock. Some of the parts will do well, but and then some of the energy stocks, NTPC, Adani Energy, these are all fossil fuel companies which will all benefit from whenever the market stabilizes.
Okay, interesting one. All right, some housing financiers also in focus actually, and they've also languished quite a bit, Chakri. Would they also be on your radar? Some of the mid cap to small cap kind of ones, an Aavas, an Aadhar, a Home First. They've done nothing for a while, and good strong growth, secured book in that sense. Would they at all attract your attention at this point? Is that something that would interest you?
You're right in terms of the valuations are good, but the loan growth is slowing. This is a sector which actually benefits from lower interest rates because 90% of all loans, home loans in India are all on floating rate loans. So against that backdrop, if an RBI cut comes sooner rather than later, that will be the catalyst, one of the catalysts, but consumer is in any case weak in the mid end of the segment. So mid and bottom end of, so given all this, I think, their NIMs will come down. Therefore, valuations will move down. So might as well wait a little bit longer.
Right, so that's with regards to where housing finance companies go. It's going to be an interesting day of trade that we'll be watching out for tomorrow as well. But very quickly, Harsh, just off the radar right now, HDFC that will be reporting numbers today. What is the key thing that you will be watching out for on that company?
Well, margins for sure, Hiral. If margin recovery is seen, and HDFC will report during market tomorrow, and that's going to be a very interesting one because you'll see the market reaction also come through at the same time. So any tweak in margins will likely help the numbers in that sense. Provisioning, yes, in focus, but the expectation largely seems to be that provisioning will be muted, and they'll give a solid quarter where asset quality is concerned. But if there could be a slip there, you could well see an adverse reaction on the counter, and that I think is what Chakri also said. But I think the margin number is going to hold the key here.
Absolutely, the margin number is going to hold the spotlight in tomorrow's day of trade, and you have a BPCL and a HUL also that will be reporting numbers tomorrow. So we'll be watching out these three stocks pretty closely. But let's put the spotlight on the cement sector. Macquarie has actually put out a note with Ultratech as their top pick. Anushi joins in with the complete report. Anushi, over to you.
Hey Hiral, so we are looking at a couple of changes in terms of the cement stocks and how they've upgraded some of them and what the rating changes are. Starting off with Ultratech, they've upgraded to outperform rating from neutral stance with a target price hike to 11,868 versus 11,564. Ambuja, another upgrade we are looking at in terms of the outperform rating from a neutral, but the target price has been cut from 620 to 618. Very small revision that we are looking at. Coming to ACC, upgrade to outperform again. This is with a target price of 2,425, revised from 2,508. However, on the downside, we have counters like Ramco Cement, which has been downgraded to underperform with a target price of 785, and Shree Cement, for that they maintain a neutral rating. Dalmia Bharat also, the rating has remained unchanged at a maintained outperforming, but target price of 2062. Now what they're saying is that the demand supports the price hikes which are expected, Ultratech remaining as a top pick. The demand recovery is also on the cards with price hikes to drive the margin expansion picture from the second half of this financial year going forward, which is the second half of this lows that we've seen in this last 2 quarters. Capacity consolidation and cost focus will bode well for the industry growth as well. So some of the key factors is margin expansion on cars that we should be focusing on. Ultratech remains as the top pick, with Ambuja also looking at a outperforming rating.
They've had a decentish day in comparison to where the market has gone, and therefore some of these in focus. But what to watch for tomorrow, and it's going to be a packed day, especially during market. You're going to see HDFC Bank, we spoke about that, declare numbers. Outside of that, there's going to be BPCL, Coforge, HUL, the other one. And HUL's commentary with regard to rural will be something everyone will have their eyes out on, and it will also determine the way in which FMCG performs maybe in the latter half of this week. Persistent Systems also will be the other one which will declare numbers. In terms of corporate action, you'll have Havells, which will come out or has its record date for interim dividend, 4 rupees per share, and stocks where there may be some amount of lock-in expiry. One will be Wari Energies, 1% lock-in expiry going to happen, and you'll have Deepak Builders and Engineers, where a 4% lock-in expiry will happen. So if you own any of these, you might want to watch out, because these were some of the other changes as well. But Hiral, you know, just in terms of the way in which we're expecting the move with regard to where markets are concerned, the broader markets are seeing a larger and a sharper correction. What should an investor do at this point in terms of SIPs? Should you hold on to SIPs at this point? Should you keep your SIPs?
I think SIPs any which ways are a long-term bet.
Correct.
Right? Nothing that
we got this question on our podcast, and
exactly,
hence we kind of,
in terms of the volatility. So that should not be a deciding factor with regards to SIPs, because risks is something is what SIPs help you mitigate. But 2 stocks, Wari Energies and Deepak Builders and Engineers. From that, I'll pick up a Wari Energies, 1% exit lock-in tomorrow. Kush, very quickly, what are charts indicating with regards to Wari Energies, because that stock has moved quite a bit?
Very limited data here on that one, but I think as long as the 2600, 2595 support zone is maintained, you could continue to stay on long in this one.
In fact, Chakri, coming to you in terms of HUL, Coforge and Persistent System, 3 stocks that will be reporting numbers apart from the ones that we've mentioned. Your top pick and the one which you'll expect a good result.
Yeah, it would be, I think, Coforge and Persistent, they have the tailwind of a recovery in IT in the US. On the other hand, HUL, maybe 2-3% growth, volume growth with no pricing power and expensive valuation. I think stay away from HUL.
Okay, so stay away from HUL is the commentary coming in. Thank you, Chakri, and thank you, Kush, for joining us this afternoon and giving us your views and perspective. Last minute or so to close to what has been a difficult market, at least today. Let's pull up the intraday chart. You'll see the weakness evident, 1.3%. We are obviously off the day's lows, maybe 70 odd points off the day's lows. But nonetheless, you have seen a sustained weakness and volatility. So not looking good, at least where the benchmark is concerned, as well as where broader markets is concerned. The heat map, if we can very quickly on the Nifty, there you go, just about 9 stocks in the green. You're seeing some traction in FMCG. Apollo Hospital standing out really on a day like this. But what's not done well, pretty much the entire universe. You look at the number of stocks sitting 1% plus in the red, 28 stocks out of the Nifty 50 50 stocks on the Nifty 50 are sitting in the red, so a majority of them sitting 1% plus lower. So clearly not a good day. You're looking at pressure on the Nifty Bank. If we can pull that one up, we've closed for the day, but the Nifty Bank is where some part of the drag is coming from, 1.5% lower on the Nifty Bank. The Nifty IT, if we can quickly pull up as well, intraday, and flattish kind of a day for the Nifty IT, but a very volatile day. We've closed 1% plus lower on the Nifty IT. We're trading flat, and then thereafter we've just fallen off. So IT is where some of the weakness has come from, at least in the last hour or so of trade. Let's look at also the advanced decline, the breadth, and the breadth is of course very difficult. But by the time we've closed, we're sitting at 4:1 in favor of the declines. The broader markets underperforming the index, so you're seeing 2% lower on the Nifty mid cap, the Nifty small cap even worse, around 2.1% odd lower. So pain and pressure there. Let's look at the sectors once before we cap off and talk about specific stocks. No sector spared. The Nifty FMCG has also slipped in the red. The metals index, which was doing decently well, the healthcare index, all of them in the red now. Nifty Realty is where the real pressure is coming from, 4% lower on the Nifty Realty index. So some real correction that we're seeing there. Nifty FMCG too, down around 1/5%. You're seeing pressure on the pharma index, 1.3 odd percent lower, and the Nifty auto index also 1.6% lower. So all of those also not looking good. Let's look at the BSE 500 top gainers, top losers, and those are some names you'll want to keep in mind. Vinity on the back of potential opportunity coming from the US and changing regulation there. Dixon Tech on the back of numbers, even so Zomato. Kalyan Jewelers, more shares pledged by promoters, but 8.5%, warranted or not, questionable. MCX down 8.5% on the back of numbers again. Oberoi on the back of numbers, and Motilal also down 7%. It's been in the news for a while now, and that one also facing some amount of pressure. But with that, from Hiral, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.
I present the budget for a historic.
Hey everyone, with Budget 2025 right around the corner, there's one question on everyone's mind. Will this finally be the year salaried individuals get some much needed income tax relief? Let's dive into the story behind the tax slabs, the rising cost of living, and why economists are calling for reforms. First things first, Budget Day is set for 1st February 2025. Expectations are sky high, especially among salaried individuals. But before we talk about predictions, let's rewind a bit. The first big moment for taxpayers was back in the Union Budget for FY 2020-21. That's when the government introduced an optional personal income tax regime with lower tax rates but fewer deductions. Remember that? It shook things up for taxpayers who had to choose between the old system with deductions or the new simplified one. Fast forward to 2023 budget, Finance Minister Nirmala Sitharaman made some tweaks to the new tax regime, expanding 2 income tax slabs and increasing the standard deduction from 50,000 to 75,000. Sounds promising, right? But here's the thing. it didn't touch the old regime at all. So what exactly is standard deduction and why does it matter so much? Think of it as a fixed amount you can subtract from your taxable salary. It's meant to help with everyday work-related expenses. While it's been raised over the years, the question is it enough to combat the rising costs we're all facing today? Did you know the standard deduction was actually scrapped back in 2005, but it made a comeback in 2018 at 40,000, and since then it has been climbing steadily. Now economists have a big ask for budget 2025. Cut income tax rates. Why? Lower taxes means more disposable income in your pocket. That extra cash could boost savings, increase spending on essentials, and even revive demand in sectors hit by sluggish consumption. Sounds like a win-win, right? In fact, during a recent pre-budget meeting, experts suggested exactly this to Prime Minister Narendra Modi, arguing that it's time to ease the financial burden on taxpayers while stimulating economic growth. As per an NDTV Profit exclusive, the upcoming union budget could bring significant income tax relief with potential modifications to the new tax regime. Sources suggest the government is considering adjusting personal income tax slabs and reducing tax rates for incomes up to Rs 10 lakh to boost disposable income. The new tax regime, which restricts exemptions and offers fewer deductions, is already the default option for taxpayers, with 72% having shifted to it. Notably, the July budget increased the standard deduction to 75,000 and revised both tax slabs and rates. Under the new structure, income up to 3 lakh is tax-free with progressive rates ranging from
Hello and welcome. You're watching Market Express and I am Aditya Rao. Let's get straight into the show with some market updates. Benchmarks end lower amid broad-based weakness throughout the day, and Nifty ends above 23,000 mark, whereas Sensex ends below 76,000 level, and broader markets outperform the benchmarks. It was a sea of red on Dalal Street. All sectoral indices end with cuts, with consumer durables and realty cracking over 4%. It was followed by PSU banks, media and auto. Rupee strengthened against the US dollar to 86.29 at open as US President Donald Trump takes the office. Donald Trump takes office of the US President, marking a fresh term of his government. The 4-year term will usher in a fresh round of tariffs, policy changes and bilateral decisions. Trump's appointment completes a triumphant comeback for a politician who survives 2 impeachment trials, a felony conviction and 2 assassination attempts. The new team entrusted with delivering Donald Trump's agenda is taking shape, with several contentious hires in his proposed administration. Suze Wills takes as the White House Chief of Staff, whereas Tulsi Gabbard picked for the Director of National Intelligence. Robert F. Kennedy takes oath as Health and Human Services Secretary, while Pete Hegseth is the Defense Secretary and Kash Patel is picked as the FBI Director. A new era of Donald Trump rule kicks in. Trump signs executive order for government workers to be in office 5 days a week. Trump seals the deal for withdrawing from the Paris Climate Treaty and likely to impose 25% tariffs on Mexico, Canada on Feb 1. Trump signs pardons for approximately 1,500 people charged with crimes related to the Jan 6, 2021, and Trump signs order creating DOGE, or Department of Government Efficiency, the Elon Musk-led advisory group tasked with slashing government waste. Trump's 2.0 can have an impact on series of sectors, especially on solar module makers. Currently, most of India's solar module exports are to the US, and therefore there are some potential scenarios that arise from Trump taking office. First, imposition of tariffs on solar imports and reduction of inflation Reduction Act incentives, and that can be negative for companies like Wari and Premier Energies. The second scenario can be no change in IRA, which will then be positive for the company. The third scenario is increase in import tariffs for solar modules without change in IRA. Oberoi Realty is trading under pressure. The company misses its pre-sales estimates, achieves 144% in pre-sales growth, which was still below major brokerage estimates. The company says that the estimate miss is on the back of drop in velocity of ongoing projects. The growth in pre-sales was on the back of only on account of higher bookings for Pokhran Road project. Dixon Tech is another stock cracking under the pressure. The company announces strong numbers with the mobile segments driving the revenue and margins. Mobile segments form 89% of the revenue for Q3. Brokerages trim FY25 estimates citing demand weakness in consumer electronics division. Brokerages are cautious on valuations as the debt is on a rise. L&T stock rises despite muted Q3 results. The company's consolidated profit after tax falls 2% year-on-year, and credit costs continue to weigh. Provisions increase 30% on sequential basis. On the other hand, 100 crore of contingency provisions have been utilized. Remember, the company has guided for a difficult time in Q3 earlier. The stock of Zomato takes a knock following Q3 results. The company in its analyst call spoke about the key takeaways of the third quarter. Zomato says that the company elevated capex leads to losses in Q3. Additionally, the company will report profits once business is out of expansion phase. Zomato says that the company sustains core customers despite competition. However, the rising competition will prolong a war for talent. Along with it, on opening of new store in same neighborhood impacts the margin. Suntec Realty shares soar after the company's collections improve quarter-on-quarter to 53%. The company identifies pipeline of projects with a gross domestic value of 38,000 crores. Brokerage firm Macquarie downgrades Mankind Pharma stock to underperform, cites weakness in core domestic business and execution of BSV acquisition. Additionally, the exports topping out and earning challenges is why the firm is bearish on the stock. D Development stock surges 7% after increasing capacity of Gujarat facility. The company announces the commission of second phase of its manufacturing plant in Anjar, Gujarat. The plant's capacity has increased by 9,000 million ton per annum and making it its operational capacity to a total of 12,000 million ton per annum, and the facility will primarily cater to the jobs of oil and gas sector. Bondana Engineering bags 88 crore rupees order from KPI Green Energy for BOS items supply and services. The project involves the supply of BOS items and services for EPCC works at the Wagra, Amod and Rajkot locations. The order is to be completed within 90 days from the date of receipt of the purchase order. Kolte Patil Developers stock jumps after the company Q3 business update. New area sales collection jumped 15% to 567 crore versus 493 crores year on year, and the stock has been on a downward trend and hit 52-week low earlier. Responsive Industries stock jumps after the company announces plans to diversify its product portfolio. The company says it introduces wood plastic composite flooring. Aditya Birla Real Estate stock plunges over 3% after the company reports a consolidated net loss of 42.4 crore rupees versus the profit in the quarter ending year ago. The realty index experienced cuts around of 4% in weak market, and the stock takes a beating amid loss in Q3 and the broader market challenges. Speaking of earnings action, South Indian Bank reports a jump in the net profits in Q3. The lender reports an increase in the bottom line. On the other hand, bank's asset quality improves from the previous September quarter. South Indian Bank's asset quality improved sequentially with the gross non-performing assets improving to 4.3% from 4.4% earlier, while the net NPA also improved to 1.25% from 1.31% in the last quarter. Adani Energy stock edges higher after recovering from the day's low. The company secured a 25,000 crore Badla Fatehpur high voltage direct current project, and the project will evaluate 6 gigawatt of renewable energy from Rajasthan to major demand centers in North India. Customs duty rates on the range of imports of goods will be rigged, and from electronics to medical devices, the government may rise customs duty on the imports of certain finished goods. The move aims to boost domestic manufacturing and export competitiveness. Higher custom duties on goods helps attract more investment in the government, and the government may discuss dispute settlement to resolve custom-related matters. A possibility of US tariffs on Indian exporters does not mean concern. Bharat Forge's Vice Chairman and Joint Managing Director Amit Kalyani as they will be managed by the country to prevent inflation, according to him. However, the Indian economy is not growing at a pace it needs to grow, he said, and the tariffs are a wait and watch. Kalyani said that, adding that he is overtly concentrated, but it is needed to spur demand. Amid rising global trade and geopolitical tensions, India's positioning is stronger than ever in offering more opportunities and values creation, according to McKinsey's Gautam Kumra. India has followed strategic opportunism by not aligning with one side, keeping options open and remaining flexible. If India can sustain this balance, it will serve its interests well. Kumra, chairman of McKinsey, as challenges such as immigration, trade tariffs and supply chain disruptions must be carefully managed, he said. A net summary is that there is more opportunity for value creation, Kumra told NDTV Profit at Davos. The cut of dates for MSCI February 2025 index kicks in for what will come into effect from February 12th. No fresh inclusions are expected. In fact, 2 stocks, Coforge and Paytm, have high probability of moving to a standard index from the small cap, and 2 stocks, Coromandel and Uno Minda, have medium probability of moving to standard index from the small cap index. India's sunshine sector, renewable energies, is poised for a stellar growth in 2025. The stocks in the major sector are trading at a higher valuation, and the valuation trend is higher due to strong rally over the last 2 years. The rally achieved on the back of the order wins, robust execution, and overall euphoria. Sugar sector stocks remain in focus after the government lifts the export ban for the sugar for the year 24-25. The government approves 1 million ton of exports for the sugar year 2024-25. Remember, the domestic sector prices remained under pressure until December 2024. The exports will be led by Maharashtra and Karnataka-based mills. Sugar mills have been hit by higher sugarcane prices, accompanied by lower recovery rates, and the need of the hour is to uptick in the domestic sugar prices to offset rising costs. TVS Motor has just unveiled its electric three-wheeler at the Bharat Global Mobility Express. K.N. Radhakrishnan, the director and CEO, says that the company is not late to the electric three-wheeler party, and the EV penetration in the electric three-wheeler segment is 21 to 25%. The company invests 125 crore rupees towards the EV Max. Capital market regulator SEBI is actively considering a platform to allow share allottees in a public issue to trade the security even before the formal listing. Chairperson Madhavi Puri Butch, in an event on January 21, said that the regulator is exploring the introduction of when listed securities trading, allowing the shares to be traded between the close of an initial public offering and their official listing on the stock exchanges. Oil Minister Hardeep Singh Puri says that government may achieve 20% ethanol blending in gasoline by February. This comes after the government's plan to expand ethanol blend in gasoline. Business magnate Gautam Adani will participate in Mahakumbh 2025 in Prayagraj on Tuesday. The massive spiritual event is seeing millions of devotees gather for the for the grand religious festival in the city of Uttar Pradesh. Gautam Adani visited ISKCON temple and the iconic Baba Hanuman Mandir. At Bharat Mobility Expo 2025, Kinetic Energy announces that the company will invest 177 crore rupees in the phased manner through convertible warrants. Promoters will infuse 55 crore by March 2025 and the shareholding will increase to 70% from 59%. The company aims to grow revenue by 8 to 10 times to 1,000 crores by 2029. Negotiations between General Electric and HAL for local manufacturing of the F414 engines has hit a snag. The price of manufacturing 99 F414 engines in India was earlier agreed upon at $1 billion, but now it has approximately been at $1.5 billion, with a difference of 500 million. The sudden increase in price caused delays in finalizing the deal as price negotiations remain ongoing. Delhi-based IVF chain Godinam IVF that has mulling a fresh fundraise files an initial public offering or IPO. The fresh shares are 1.84 crore, whereas the founders plan to sell 25.3 lakh shares in IPO. 14 Naxals were killed in an encounter with the Chhattisgarh police at near Chhattisgarh-Orissa border on Monday. The Chhattisgarh police stated, adding a member of the Naxal group who had a bounty of 1 crore rupees on his head was killed in the encounter. The Mamata Banerjee government challenged the trial court's life imprisonment order against Sanjay Roy, convict of RG Kar rape and murder case in Kolkata, demanding that he be given the death penalty. China's frugal young adults accelerate saving and raising economic risks. The frugal trend that began in China during the economic disruption of the pandemic and deepened amid the crisis in the property market is intensifying as Gen Z shuns government calls to spend, and doubles down on saving. On China's Instagram-like Red Note, many under 30s are swapping notes on how to spend less and office launches and shop on the cheap. The Bank of Japan is expected to rise interest rates on Friday, barring any market shocks when US President-elect Donald Trump takes office, a move that would lift short-term borrowing costs to level unseen since 2008 global financial crisis. A tightening in the policy would underscore the central bank's resolve to steadily push up the interest rates, now at 0.25% to near 1%, a level analysts see as cooling nor overheating Japan's economy. Prince Harry's legal battle against Rupert Murdoch's British newspaper group goes to a trial at High Court in London. The royal is seeking a ruling that senior figures knew about and covered up the widespread wrongdoing. Harry, along with former senior lawmaker Tom Watson, is suing the news group papers over alleged unlawful activities carried out by journalists and private investigators working for its papers, The Sun and the defunct News of the World from 1996 until 2011. A new controversy has emerged in upcoming ICC Champions Trophy that is set to happen in Pakistan and Dubai. The controversy started with India reportedly objecting to print Pakistan on India team's jersey. India is set to play their Champions Trophy games in Dubai, though Pakistan remain as the official hosts of the tournament. Here's some update from Australia Open. World number 2 tennis player Alexander Zverev advances to semi-finals after thrashing Tommy Paul in the first quarter-final. Earlier, Paula Badosa beat Coco Gauff in the first quarter-final of the women's singles at Rod Laver Arena. After being stabbed multiple times during a robbery attempt, Saif Ali Khan has been discharged from Lilavati Hospital today. His wife, Kareena Kapoor, was seen accompanying him at the hospital. The Income Tax Department conducts searches at multiple locations linked to the prominent filmmaker Dil Raju, chairman of Telangana Film Federation Development Corporation, on the charges of alleged tax evasion. Sources reveal that the raids were conducted across 8 locations, including the homes of Dil Raju's family members. Thanks for watching Market Express. That was it in the today's edition. There is lots more left on NDTV Profit. Keep watching and stay updated.
This January, the world will come together at the World Economic Forum at Davos to bridge differences, because the stakes have never been higher. Collaboration in an intelligent age. In a Trump 2.0 and Modi 3.0 era, this becomes the primary agenda. And the tallest leaders in the business and political world will try and get answers to the most pressing questions. How do we fix a fractured global economy? How do we combat climate change and create a future of opportunity for all? And how does India navigate the opportunities and challenges of 2025? Join me, Neeraj Shah, as we bring all the action from the World Economic Forum for the month of January to your homes, only on NDTV Profit.
Well, Budget 2025 is around the corner and Macquarie has come out with its budget estimates or expectations on each sector. The first sector is the banking space. They do not expect favorable treatment for deposits, and possible capital infusion for PSU banks and insurance companies might take place. Moving on to the next sector, NBFCs is the counter. Credit guarantees similar to SMEs for MFI sector can be expected. In the insurance company space, that is the next sector to watch out for, no change in tax rates or any product or any corporate profit tax rate change can be expected in this budget of 2025. The next sector to watch out for will be cement and metals, where they are expecting announcement on import duties to restrict imports on certain metals and certain materials. Moving on to the auto space, outlay for PM E-Drive and PLI can be expected. Policy initiative to drive localization of key EV-related parts can also be expected. The next sector in focus would be the consumption space. Mid to high single-digit increase in cigarette taxes can be expected. The budget, interim budget which was announced last time did not have any tax rate change in cigarettes, which is why we did see an uptick in stocks like ITC and VST. But this time you could see mid to high single-digit increase in cigarette taxes. Reduction in taxes for low middle class consumers could take place, which could boost consumption in the rural as well as the urban spaces. Moving on to the next space, jewelry is the space where no reversal of custom duty cut on gold will take place. In last budget, there was a custom duty cut announced on gold, silver as well as platinum. There will be no reversal on this as per Macquarie. Moving on to the next space, pharma and healthcare, potential support for higher R&D via tax reduction can take place, and PLI for anti-diabetic and weight loss medication could also be one of the factors that the budget might consider. And modest increase in allocation for Ayushman Bharat is something that Macquarie is expecting from the pharma and the healthcare space. Infra is the next space. Capex allocation for key ministries like railways, roadways, etc. Can be expected in this budget, and announcements around additional dedicated freight corridors can also be expected in this budget 2025. Defense is another area where initiatives to boost defense exports can be expected, and announcements around that will be expected, and initiatives fastening domestic defense equipment procurement could also be one of the things to watch out for in this particular budget. Lastly, in terms of power, green energy thrust to continue. Steps to promote initiatives across the value chain, that is to promote green energy, might also be seen during this budget. Oil and gas is the last counter where Macquarie expects that OMC's compensation for LPG under recoveries might be seen. So these are Macquarie's expectation on different sectors as to how budget may,
Nifty Sensex end at lowest level since June crash, both ending over 1% lower. All sectors end in the red, with realty and consumer durables ending over 4%. A day of losses for Dixon Tech. Shares dipped nearly 13% in today's session. This is despite the Q3 earnings beating estimates, with revenue, EBITDA and net profit doubling from the previous year. More IPO scrutiny on the cards. BSE CEO Ramamurthy says stock exchanges must filter and promote only financially viable and credible companies. In a bid to promote domestic manufacturing and ease trade, the Finance Ministry is expected to tweak custom duties on certain items, including consumer electronics, medical devices, in the upcoming budget. This is an NDTV Profit exclusive. We at NDTV Profit are focusing on what the everyday consumer expects from the Finance Ministry. We bring you discussions on topics like inflation, education and more in the run up to the 2025 Union Budget. What does India Inc. and top global businesses leaders gather of Trump 2.0 as the 2025 World Economic Forum continues in Davos? NDTV Profit brings you discussions with top voices from across the spectrum. Hello and welcome. This is Profit 360 on NDTV Profit, and I'm your host Himakshi Bahuguna. Along the next half an hour, we'll bring you the latest on the markets as well as national and international news. So viewers, there was a bloodbath on D Street as benchmarks ended in the red, with the Nifty closing around 23,000 levels and the Sensex down nearly 1.60%. All sectors closed lower, with realty taking the biggest hit, down almost 4%. PSU banks and the auto sector also dragged the markets down. Harsh joins in with a wrap of all the action on the bourses today.
Well, markets seeing or continuing to see pressure now. We've headed and we've tested 23,000 today. We slipped below it briefly, but we saw a 50-odd point recovery thereafter as well. So markets closing around 70 to 80 points above the day's lows, but we are precariously lower, around 1.5% lower where the index is concerned, the Nifty 50 index. Broader markets seeing more pressure, and along with it, we're also seeing large amounts of volatility. If you look at the intraday chart on the Nifty, you'll see how volatile it has been through the day. The other one is with regard to the breadth of the market. It's a tough one. 4:1 in favor of the declines. So certainly pressure across the board. Any stocks where earnings have not really met expectations are really coming under pressure. We saw that with a Zomato today. Saw that trickling onto Swiggy as well, Zomato's numbers. And we saw also some other stocks, something like a Paytm, something like an Oberoi Realty, see lots of pressure. In fact, the Nifty Realty Index was the largest sectoral loser today on the back of that, 4% lower again in trade today. It's entered deep correction territory now, the Nifty Realty Index. In terms of which other stocks really stood out, within the Nifty 50 pack, Apollo Hospitals really stood out 2% higher. But what didn't do so well was a Trent, down nearly 6+% in trade. So some FMCG counters did okay-ish in trade today, something like a Britannia. But outside of that, you saw pressure across the board, especially among the heavyweights in the banking sector. And in fact, the Nifty Bank was also down roughly 1.6% in trade today. The Nifty IT, if you look at it intraday, plenty of volatility, and then we saw a bit of a weakness there in the IT index, 1.1% lower, sharp correction in a very short span of time, maybe 15-20 minutes, and that reflected on the Nifty 50 index as well. We spoke about the broader markets and how they did, just specific stocks. Let's pull those up. The BSE 500 top gainers, top losers list, that's in front of you. Have a look. Those are some big movers in trade today. Kalyan Jewellers making that list on a very recurring basis now.
Thanks, Harsh, for that market wrap. Now, Dixon Tech hit a 10% lower circuit even after the company's Q3 beat estimates, with revenue and net profit doubling. But why was this decline seen in the stock today? Puneet joins in to explain the reason behind the stock's downswing. Puneet, over to you.
Well, thanks for that. As you rightly said, the company saw 117% growth in revenues. EBITDA was also up 120%, while Pratt also grew by roughly about 120% in Q3. But the conference call commentary and one specific bit of the company looking to enter semiconductor components, that has not, fitted well with the investors, and we see the sharp downward reaction today in the stock today. Now, the company has mentioned that they will be looking to foray into display fabrication, which is part of the semiconductor components theme. Now, previously the company has stated they will only venture into the non-semiconductor components, which is not as very capital intensive. And that's one of the key aspects today. So it's a reversal of strategy for the company compared to the previous quarters, and hence seeing the strong downward reaction. Now, what's important is that, the new semiconductor foray, the company has said it will require a capital expenditure of about $3 billion, or roughly about 25,000 crores. Currently, there are some central as well as state government schemes which incentivize roughly about 70% of the total capex. Even removing that part from the 25,000 crores, Dixon's share of capital expenditure over the next 2 to 3 years will be roughly about 8,000 odd crores. That's roughly 10 times its current annual capex of about 800 crores, and that's where the strong reaction has come from. This will impact the company's financial picture as well as the return ratios of ROCE as well as ROE being one of the key downward reactions to it. In terms of the management also did speak to us and try to alleviate some of these concerns by saying that out of the total 8,000 crores of capex, roughly half will be done by its JV partner. They are looking at joint ventures in this particular semiconductor component scheme, but it's something that will still be higher. The capex will still be higher by roughly 5 times of what it did in FY25 and FY24 as well. So that's one of the key things. Entry into a new segment of semiconductor components might not foray well for the company, at least for today. But over the long term, the management has guided this will increase the addressable market for components and revenues eventually to follow through as well.
Right, Puneet. Thanks for bringing us those details there. Now, at the Association of Investment Bankers of India event, Sundararaman Ramamurthy, MD and CEO of BSE, emphasized the need to promote financially viable and credible companies for IPOs. He highlights how a collaboration now with market regulators would enhance market quality. Listen in.
Only such of those companies which are financially viable and technically feasible should be permitted to come. SMEs have been doing a great job. Even these 1,000 which have gotten listed have shown to the market how SMEs can contribute a lot in the listed area as well. And that's all because of all of you. When you have done that, you need to ensure when such growth happens, 2 things are inevitable. One is noise, and second is when you sow seeds in a farm to grow crop, weeds are inevitable. You need to know how to address noise and how to address de-weeding of weeds. Only good projects should be taken up. When there are good projects, They may have good intention with good paperwork. They will sail through easily. If it is good intentions with bad paperwork, exchanges and regulators are happy to help you. Don't permit anything unethical. Don't permit any third person to come in the way of telling you that he can help you in SME sailing through. You have any concerns about anything, directly approach the exchange officials. There is no need for middlemen. What is good for the market can only sail through. This process may initially take some time. Bear with it. There is no shortcut to success.
Viewers, from the same event, my colleague Charu caught up with founder and managing director of Prime Database, Prithvi Haldia and Pranav Haldia, who talked about India's IPO exuberance and on valuations of IPOs. Listen in.
Last few years have been extraordinarily good for the IPO market for two reasons. One is that the secondary market has been either buoyant or stable. Because an IPO market requires a stable secondary market or a buoyant secondary market. If the secondary markets are in bad shape, then IPO will not happen. We have seen that historically. Because if there is no interest in the secondary market, people will have very little interest in buying new stocks. Number two, the reason is that a lot of companies that had been matured by PE and VC investors or who have gone through one or two business cycles are now entering the market. So, gone are the days where you could think of a greenfield project or think of an IPO today and do an IPO tomorrow. Now, these are all companies which have been in the business for the last 5, 7, 10 years. There's a lot of money which has come in from private investors, VC firms, and so there's a lot of due diligence which has gone through, a lot of governance has gone through. So these two factors have actually led to the current growth. Also, most of these companies have been cautious about their pricing. So while there have been some accusations that IPOs are overpriced, etc., we have found that most IPOs actually are listing at a premium. Now, when the returns are good, you find more investors coming in. That would lead to more IPOs. So this is a cycle which will go on. So as buoyant secondary market, good companies entering the market, listing at a premium, these three things will take the markets to a different high. So what we have seen last year is phenomenal, but what we could see in future could be mind-boggling.
Well, as the presentation also showed this morning that in comparison to industry peers also, a lot of IPOs have been fairly valued. But I think the proof of the pudding lies in not just the day of listing, but also the post-listing performance. And, the average gain on listing in the last year has been close to 30%. But even if you look at, the performance of IPOs subsequently, IPOs continue to trade upwards, and the average gain that they've given is close to 50%. In fact, we did this analysis recently wherein we looked at IPOs from 2019 onwards, and what we found was that on an average, IPOs which came out in the year 2019 have given an average return of 500% till now. So, I think there's a lot of negative commentary around valuations. I think we have to be cognizant of the fact that no company or merchant banker wants the IPO to fail. So the pricing of the IPO has to be kept in a manner which is attractive and which attracts a subscription. Now, if there is even 1x demand of the IPO, it means that there was enough demand for that IPO at that particular price. Obviously, after it gets listed, a stock becomes, an IPO company becomes like any other listed company, whose share price will go up and down on the basis of how the company is performing, how the sector is doing, etc., etc. So, to continue to judge an IPO 6 months, 1 year, 2 years later on the basis of its IPO price also is slightly unfair in my view.
Now let's shift to motor space. TVS Motor unveils its electric three-wheeler at the Bharat Global Mobility Expo. My colleague Tushar spoke to the Tata Motors Director and CEO K. N. Radhakrishnan. Listen in.
Starting from superior comfort, connectivity, excellent range, and impressive acceleration, quick charging, and overall, in my opinion, they will get the best TCO. And best earning potential for the customers, including the fleet operators. And this product will be available in markets like UP, Bihar, J&K, Delhi, West Bengal immediately. And in the next 3 to 4 months, it will be available all India. Like I said, this has got the best range, best pickup, and excellent in terms of charging time, and many car-like features like LED headlamps, tail lamp, connectivity, and Smart Connect, which is coming from TVS.
US Kinetic Engineering's MD Ajinkya Firodia is raising a 177 crore through investment, which will increase the shareholding to 70%, aiming to grow the revenue by 8 to 10 times. Listen in.
So as you correctly said, we are raising 177 crores. Over the last decade, we have turned around our plant. We've made it a profitable, growing company in auto components. We are raising these funds, 90% of these funds, about 166 crores by promoters themselves. So there are trusts, Arun Firodia and Jayashree Firodia trusts that are investing the majority of these shares. There's about also a 10 crore investment coming in from our friends and family and other well-wishers, high net worth individuals who have shown interest to partners in our growth. As you saw that this will take the promoter shareholding to 70%, and I think a investment of 180 crores is a lot of investment for the next 3-4 years and can definitely propel us to grow from 161 current 150 levels to 1,000 levels. Our debt to equity ratio is also very in control, 0.5. It will become even further. So as we progress in building the companies, we will, and we need more money, we can approach the banks, or we can also approach strategic or financial partners for doing that. So we would be open for that, but maybe in a couple of years.
US Budget 2025 is expected to tweak custom duties on certain items, including consumer electronics, medical devices, move to promote basically domestic manufacturing, ease trade, and make export further competitive. Shimi is joining us with more exclusive details.
Government is considering to increase the custom duty on the imported finished goods ranging from consumer electronics to medical devices. Sources telling us that electronic items such as washing machine, dishwasher, which currently attracts basic custom duty of 10%, may see a change in the duty, and it may go up. And in fact, in the medical devices and equipment which is being mainly imported from Vietnam, such as BP machine, oximeter, could also see increase in the custom duty. Meanwhile, government is also sort of examining to lower the custom duty on the components and the input materials of these items, and we've been given to understand that the intent of the government is to sort of support domestic manufacturing, and at the same time, with higher custom duty, it will help to increase the entire investment, ease of doing business, and also the export competitiveness is what the government is looking at this point of time. Meanwhile, the review of the custom duty structure is also underway. In fact, rate rationalization of the custom duty is being considered. They are talking about how to sort of reduce the rate slabs to maximum 5 from the current 12 to 13 slabs at this point of time. Besides, they are also sort of discussing and deliberating upon to having a tax settlement, system to reduce the custom related pending matters. So overall, the review of the custom duty structure is there, which we will see some sort of announcement there as far as the plan goes. And on the duty side of it, we will see some modification and tweaking in clutch of items in the upcoming budget.
Thanks, Shrimi, for getting us those exclusive details there. Now, from gold tax expectations and education fees to tax reduction, what does the consumer anticipate from the upcoming budget 2025? Sesha is bringing us a ground report from Delhi.
Union Budget 2025 is just a few weeks away, and today we are here in Chandni Chowk in Delhi on the ground to hear from the people what they expect from the government, especially as inflation, a pressing issue that continues to burn a hole in their pockets. Now, let's start with Mr. Verma. He's a small business owner. Thank you, Mr. Verma, for taking the time. Tell us how inflation has affected your business and what do you expect from the government?
जी, इस बजट में हम लोग ये चाहते हैं कि किसी की भी तरीके से जो टैक्सेस की मार हमारे व्यापार पे पड़ रही है, जैसे 10 से 12% इस वक्त टैक्स चल रहा है हमारे गोल्ड के ऊपर, तो वो हम चाहते हैं कि गोल्ड पे वो कम हो, जिससे सोना थोड़ा सस्ता हो और आम आदमी की पहुंच में हो, क्योंकि आम आदमी की पहुंच से बाहर हो चुका है सोना। 80,000 रुपये पर 10 ग्राम का रेट चल रहा है इस वक्त दिल्ली में, जो कि आम आदमी की पहुंच से बहुत बाहर है, और 3% GST भी इस पे लगती है।
Acha, thank you so much. Now we are joined by Mr. Gupta. Thank you so much. Please tell us how is inflation affecting your family, your household budget?
Like regarding inflation and expenses, it's almost double the expenses what we are suffering, what we are paying from last like old couple of years. Like let's say अगर बच्चों की स्कूल की उनकी फ़ीस थी, पहले उनकी 5,000 10,000 महीने की फ़ीस थी. Now we are paying almost 20,000 in terms of food expenses, traveling expenses, flight tickets, anything whatever you compare, anything जो भी कुछ भी आप करना चाहेंगे, almost सब डबल ट्रिपल कॉस्ट पे आ रहा है. It's very hard for us to survive like this, and कैसे हम लोग अपनी livelihood को जिएं करें, it's very hard for us. I mean like government अगर ने कुछ अच्छा decision नहीं है, it's very hard for us to survive.
Right. Next, we have Mr. Jain. Sir,
from Ministry of Railway.
Right, sir. And sir, tell us how has budget, can bring relief for pensioners?
टैक्स स्लैब एक होनी चाहिए. जैसे हम लोग को जो पेंशन मिल रही है, एक बार टैक्स उसमें कटता है, उसके बाद जो पेमेंट मिलती है, कुछ भी एक्सपेंस करते हैं, हर चीज़ में टैक्स, लाइट में टैक्स, हाउस टैक्स, वाटर टैक्स, तो इसको एक बार होना चाहिए टैक्स जो भी है.
You was in a CII panel discussion with Sanjeev Puri, Rajiv Memani and R. Mukundan. They shared CII's recommendations for the upcoming budget. CII believes that the new tax regime may not focus on reducing tax rates, but has suggested lowering personal tax rates for lower and middle income individuals. Additionally, they highlighted the importance of improving the ease of doing business. Listen in now from that conversation.
Yeah, so I think the new tax regime that is likely to be tabled in the Parliament, that is focused much more on simplicity and reducing compliances, reducing litigation, taking out obsolete provisions. It's not focused that much on reducing tax rates and everything else. But so I think so they're two different things. So I think the reduction, or if any benefit that has to be given from a tax rate standpoint, I think that has to come through the normal budget mechanism. What CII has recommended is, to look at some reduction in personal tax rates, especially for lower to middle income people.
So certainly, I think growth has to be the key focus. In fact, it will probably be the only way which will differentiate and push us ahead to address other issues. When you talk about equity, employment, I think that becomes an extremely critical step to do. We are seeing positive tailwinds now, especially in some sectors like renewable energy, electronics. I think we should give that continued momentum. Also, the focus on infrastructure spend we should continue with that focus, because it has a huge multiplier effect. In addition to that, I think this point Sanjeev mentioned about plugging into global supply chain, that's one clear way how we can sort of bring positive momentum to manufacturing. Electronics has clearly benefited from that. If you see one sector which is plugged into international supply chain has been electronics, and with the changed geopolitical situation, whatever may be, I think we have a unique opportunity to actually up our game. In this regard, I think CII is highlighting the need to improve the ease of doing business. A lot of work has already happened at the center. Now this has to move beyond center and coordination between center and state.
US business magnate Gautam Adani visited the Mahakumbh in Prayagraj today, where millions of devotees have gathered for the grand religious festival. The Adani Group chairman toured the ISKCON temple and iconic Bada Hanuman Mandir. Earlier on January 9, the Adani Group and ISKCON collaborated to serve meals to devotees at the event. Speaking to the media, Adani expresses joy at attending the Mahakumbh and thank the event's management.
नहीं, आज मैं यहाँ प्रयागराज की भूमि में आया हूँ. एक बहुत अद्भुत अनुभव हुआ. मैंने भी ऐसा सोचा नहीं था। जो यहाँ आके जो अनुभव मिला है वो आम और नहीं है। नहीं, आप एक देखो तो यहाँ की जो व्यवस्था और भव्यता जो बनाई हुई है, तो मैं सच्चे दिल से प्रधानमंत्री नरेंद्र मोदी जी और मुख्यमंत्री योगी जी, ये अपने सब भारतवासियों की तरफ से मैं उनको धन्यवाद दूंगा।
Viewers, as the world closely watches Trump's return to the White House, the question on everyone's minds is, what does Trump's golden age mean for the world? For more on this, tune in to The Big Question at 6 p.m. today evening. Now, viewers, with that, that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
I present the budget for a historic
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profit's research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is the outlook as rosy as the company claims? Know your company, powered by NDTV Profits Research, shines a light on the biggest stock market movers. Know your company at 11:30 a.m. Monday through Friday, only on NDTV Profit.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Do you really know the company you invest in? What's the picture behind presentations and claims? Is Hello and welcome to KYC, a brand new show at NDTV Profit. In this fast-paced world of stock markets, investors are bombarded with information, but what they often lack is a deep, comprehensive understanding of the companies they invest in. Know Your Company is a show designed to give regular investors powerful, actionable insights into the fundamentals of a single NSE-listed company every day. Well, today we're talking about Canfin Homes. This is a relatively smaller NBFC, well focused in housing finance, and of course in terms of its borrowing mix as well. It's about 64% is coming in from construction. That's followed by maybe 7% from mortgage and loan against property, which would also include something like a flat and resale, along with renovations could include several of the other aspects. In terms of branches, this is essentially a Southern Indian based NBFC with 60% of its branches there, but it does have a significant presence in the western and the northern markets too, where it has about 16% and 14% presence respectively in terms of its overall branches. Moving on in terms of its assets under management, to give you a better breakup of that, about 80% comes from housing, and housing CRE comprises another 10%. So 90% of its assets under management are as far as housing goes, and the balance will be from LAP and mortgages and top up, etc. So what we usually do under all circumstances is that, well, we rate the company on several parameters, and while we do talk about the net interest income, we talk about the balance sheet, the way things pan out when it comes to your operating metrics, along with, of course, shareholding pattern and the street credentials. We tend to rate these companies on all these parameters and eventually get the score coming through. To take us through some of these aspects, we are also joined by Harsh, who's going to help us with at least some of these. So Harsh, welcome to the show and good morning. Thanks, to you as well.
Good morning.
Let's start off with your income statement. How has that panned out and what are the ratings we're giving it to it?
So the AUM size is roughly 35,000 crores. So it's a fairly small size, right, in terms of AUM. You have larger housing financiers, something like a Bajaj Housing, which is 1 lakh crore plus. You have LIC Housing. And of course, then you have HDFC Limited's book, erstwhile book, which is now part of HDFC Bank, which is the largest at this point. You also have SBI and some other banks which have now started taking sizable positions within the housing finance space. So not only is competition going up, but if you're on a low base, it's fairly easy to grow.
Yeah.
And therefore that number, 16.5% on top line, that's what's not looking very enthusiastic, just from an opportunity size perspective. So while it's a very healthy growth number, and I would ideally maybe have even possibly given it a thumbs up, but the only reason that held me back from giving it a thumbs up and give it a neutral, because the opportunity size is so large,
right?
And therefore you would want a smaller housing financier, sub maybe 30,000, just sub 40,000 crore, to grow at a faster clip. Right. But it's grown at 16%. and that's how it's shaped up over the last 3 years. You're looking at provisioning also largely muted, and that's a big positive in my opinion. And profit after tax therefore has gone up by 18.5% over the last 3 years. So a neutral rating only on the fact that you would want it to grow its top line slightly better than what it has actually done.
Right. Well, for a company this size, as Harsh was mentioning, we usually tend to see, well over 20-25% growth in terms of your top line as well as your bottom line. But the company seems to be missing a bit just in this case, which is why we're going to go with a neutral rating here. As once again, Harsh has already mentioned. I'm going to talk about the balance sheet very quickly. And when it comes to the assets under management, as I was mentioning, the majority does come from housing. It has grown from 22,000, a little over 22,100 back in FY21 all the way through FY24. Currently stands at a little less than 35,000 crores. It's not a bad growth. We'll certainly give you that. But given the size and given the low base, it could have been much better. Of course, there are certain challenges when it comes to an NBFC, which is actually a public sector undertaking. And well, if you consider those challenges, sure, you could also, say that this is a reasonable growth rate. But if you do, compare it to several other players which are in the market at the same size, this kind of growth would potentially just give you a neutral rating, which is why we're also giving this a neutral one. But how are things looking when it comes to operational metrics, Harsh?
Yeah, so operational metrics looking decently healthy. So you're looking at yields at just a shade below 10%. Now, what really stands out here is that you're a pure housing finance player, right? And therefore, a large part of the book is housing and mortgage related. But you also have loan against property as a component of the book. But the component is very, very small as part of the AUM. And therefore, to maintain the yield of around 9.8%, a steady spread, and the kind of ROA that it's seen, a slight increase in the ROA trajectory, certainly augurs very well. Even your borrowing cost has actually gone up as a result of the fact that Can Bank has reduced its shareholding in Canfin Homes, and therefore you're seeing a sharp rise there, likely due to that. But they've still been able to maintain their spreads, they've been able to balance it out well, they've been able to keep their margins decently well, and they've been able to therefore do well on the operational side of things, which is why we've given operational metrics, that metric we've given it a thumbs up. Of course, again, very, very correlative to income statement, but nonetheless we've given this one a thumbs up, largely borderline to positive on both of those metrics.
Okay, so I just want to make a correction here that I had mentioned that this is a PSU. It isn't, because it's actually held by Canara Bank. It is not held by the President of India, and hence it may be considered as not a PSU entity anymore. But I want to talk about a handful of other aspects as well, and we can perhaps talk about the asset quality metrics too. And in terms of your gross NPA ratios, we have certainly seen an improvement. There's no doubt about that, because we've back in FY 2021, the gross NPA ratio stood at around 0.91. It has gradually improved, and while FY23 and FY22 years were really good, there was a little bit of deterioration, yet as compared to FY21, it's a better ratio, currently standing at around 0.82. Similarly, when it comes to your net NPA ratios, again, it is an improvement if you consider how things have panned out from FY21 through FY24. But there were 2 years where, pardon me, things were considerably better at it, and that's the reason why we'll give this a thumbs up, because we have seen a gradual improvement, even with a little bit of volatility. FY24, of course, will be a year where there could have been some changes. But if there is anything else that you'd like to add in terms of your asset quality metrics, Harsh?
Yeah, it's just a low base, right, Agam?
Yeah.
So when you're looking at the last 3 years, the asset quality has bounced back and normalized off a very, very low base. So that's one. Second is that if you look at the last 5 to 6 years as well, your NPA ratios have been very, very healthy. They've been sub 1%. And therefore gives you that comfort that asset quality, despite everything that's happened with shareholding as well as with regard to the way in which the leadership changes, etc., have panned out, has sustained in that sense. And there's been no deterioration. There's not been any marked deterioration with regard to where asset quality is concerned. That's how I would look at it.
All right. Well, there you have it. So that's as far as your key financial statements are concerned. Let's move on and talk about shareholding now. And in terms of shareholding, when it comes to promoters, that is Canara Bank specifically, that continues to hold around 30%. Moving on, when you consider, institutions specifically, so you have mutual funds, you have, their shareholding stands around 22%. Besides that, individuals also hold 19%, which is also quite curious. But then foreign corporate bodies and bodies corporate also have a fairly decent holding of Canara Bank. And which is why at this point in time, the reason why we want to give it a thumbs up is because the holding for this particular NBFC, that's Canfin Homes, pardon me, is fairly rounded and fairly diversified, which actually doesn't leave too much room for a lot of manipulation in this case, and which is why we're giving this a thumbs up. But we're coming then down to how the street is viewing this particular company. Harsh, let's talk about valuations.
Well, yeah. So let's talk about it actually. So let's pull up the valuation picture. There you go. You have Canfin Homes at 2.2 times price to book. You have PNB Housing at around 1.6. Of course, PNB Housing yet to turn a corner fully, so maybe that slightly discounted valuation may likely be fair. LIC Housing at 1 time and Home First. Then you have those entire bunch of housing financiers, right? You have Aptus, Avas, Home First, all of them growing at a fairly healthy clip. All of them more efficient than some of the tier 2 ones like a Canfin, like a PNB, like an LIC. And all of them doing much better in that sense, even where valuations are concerned, because your ROAs are just a very different picture there. And even your margins are a different picture, and even your growth is a very different picture. So those three metrics take those valuations at 4.4. We're giving this a neutral because it looks like a fair valuation when you're looking at the top rung, fast growing housing financiers versus the second from top, something like a Canfin, PNB, LIC. Largely this one looks well placed in terms of its valuations as a result of all of those metrics.
All right, let's move on, talk about street coverage then, and this is the final one which is on our radar with respect to the ratings. Well, we have about 14 analysts out of the 21 which have a coverage on Canfin Homes with a buy rating, and the consensus price target stands around 952, which entails about a 33% upside from current market levels. So all in all, the street is positive. It's